that and who should be investing in that, and therefore that raises separate questions about the cuts and changes to FEMA funding, frankly.
Yeah, I'm worried about the cuts to FEMA. FEMA first is supposed to coordinate all the federal government response, and you need the federal government when a big event happens because it's beyond any particular local or state entity. That said, it's gotten too big, so FEMA should be refocused, and it shouldn't be spending $40 billion a year. We also need to improve, though, to your point, resiliency at the state and local level. We have to encourage those states to invest in resiliency. And we did a study with the Chamber of Commerce. It's a 13-to-1 payoff, so it's a good deal. Like if you invest in it, you just have to make it a priority. And then I think longer term, we need to privatize the National Flood Insurance Program. The U.S. taxpayers shouldn't be paying $25 billion a year to handle that. We should be able to spread that cost more effectively across society, which will then encourage people to invest in resiliency.
So how would you privatize flood insurance in this regard? And I ask because, as you know, we have certain states where there is almost no insurance market, or the insurance market is super tough because the economics don't make any sense.
Yeah, I think, well, on flood insurance, that's all mostly done by the federal government. To privatize it, you'd probably have to take a decade. I mean, the federal government's losing somewhere north of $5 billion a year, and so to think that you could privatize it tomorrow just wouldn't work. And at the same time, you'd have to give those customers who are going to have to pay more, because if you're losing money, someone's got to come up with the $5 billion, if not the federal government. And so you'd have to take probably a 7 to 10 year period to kind of wade in and change the pricing. You'd have to make it more risk-based, so people aren't doing exactly what you described as rebuilding the same house in the same place 3 times, and then all the rest of us pay for it. So, I think if we don't bring market forces to bear on these catastrophe problems, we're going to continue to act like we're surprised when, to your point, these happen all the time. And it will encourage us to invest that money in improving resiliency.
Okay. Tom Wilson, CEO of Allstate, want to thank you for joining us this morning. Appreciate it.
Thank you, Andrew.
Coming up, how the markets are preparing for second quarter earnings. That influx, which is going to hit soon, could give us a lot of idea about the future, tariffs and everything else. Later, Treasury Secretary Scott Bessent on the latest tariff deadlines, negotiations with trading partners, and much more. That's at 8 a.m. Eastern. Squawk Box returns in just a moment.
It is just before 7 a.m. right now on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross, working along with Joe Kernan and Becky Quick. A lot going on after this long July 4th weekend. Among today's top stories, President Trump saying he has now signed letters to 12 countries outlining the various tariff levels they would face on goods they export to the United States. He didn't name those countries set to receive the letters. Meanwhile, Treasury Secretary Scott Bessent saying countries that don't make trade deals by August 1st can expect tariff rates to return to the levels announced back in April. And he's going to join us at 8 a.m. Eastern Time to discuss all of this. And Israeli Prime Minister Benjamin Netanyahu is going to meet with President Trump at the White House. That's happening today. The meeting comes after Israel and Hamas resumed indirect talks on a ceasefire in Gaza. And forecasters expecting more rain in the flooded areas of central Texas through tomorrow. The death toll from the flooding now topping 80 people, with more than 40 still missing. Back.
All right, let's take a quick look at the markets following that holiday weekend. The futures this morning a little bit lower, with the Dow futures off by about 35 points. The S&P futures down by 18, the NASDAQ off by 95. We did have both the S&P and the NASDAQ set new records once again on Thursday, the last trading day of the week. If you check out Treasuries this morning, you'll see that the 10-year is slightly higher. The yield is slightly higher at 4.35. The 2-year is a little bit lower at 3.87. Those stronger than expected jobs report numbers that came out on Thursday did push yields higher immediately. And if you're watching oil prices this morning, they're a little higher as well. I think the last tick for WTI actually unchanged at this point at $67. Brent is up by about 0.6% to 68.72 with that OPEC meeting coming this week. Let's get over to Dom Chu. He's been taking a look at what's on the food and pre-market this morning. Hey, Dom, how you doing?
Good morning, Becky, Joe, and Andrew. We are keeping a close eye on some of the analyst notes out this morning that are causing some gyration. First off, though, some news. Tesla shares in the pre-market, a S&P 500 laggard amid fresh strife between CEO Elon Musk and President Trump after Musk announced he would try to create a new political party. So that's one thing. Then a Blair downgrade to market perform from outperform, not really helping the shares at all. Blair cited Trump's spending bill and the elimination of tax credits for buying electric vehicles, but also the reduction of corporate average fuel economy fines, which set standards on emissions for certain types of cars. Tesla received credits for its cars' lack of emissions that it would sell then to gas automobile manufacturers. Now, due to that reduction, Blair says the profit from those credits are at risk. Tesla shares on balance with all of those catalysts, they're down roughly 6.5%. Causing a lot of that NASDAQ downside. Meantime, Constellation Brands higher after an upgrade to buy from holdover Jefferies, citing an attractive price to earnings multiple after extended pullback for those Constellation shares. They've shed more than 30% over the course of the last year. And they're also saying the company's strong balance sheet outweighs a temporary pullback from consumer spending. So Constellation up about 0.75%. CrowdStrike also falling after a downgrade to neutral from overweight over at Piper Sandler, saying the recent run-up in the stock has stretched the valuations. Piper's praising CrowdStrike's CEO George Kurtz for the company's turnaround following that major outage last year. But, you know, CrowdStrike shares still down about 1 1/3%. Becky, I'll send things back over to you guys.
Okay, Don, we'll see you in just a little bit.
You got it.
New highs across the board recently. Let's talk markets with Amy Wu Silverman, RBC Capital Markets, head of derivative strategy. We've had a lot of our favorite technicians on. They're dead wrong. We've had a lot of the fundamental people are wrong most of the time anyway, but most of the ones we've had, no one was looking for a quick rebound from the April lows to all-time highs. And then, you know, more of the same talk about revisiting the lows and the momentum's waning, and it's not, you know, here we are. Did you think we'd see it this quickly? What were you? I remember when you were on, you were talking about, you look to see whether there's hedges for either, continuing upward moves or downward moves. Were you seeing something that indicated we get back so quickly to all-time highs?
So I'll tell you, the thing that the options market has been saying pretty consistently is short-term, relatively complacent, didn't see those hedges, but longer term, when you think about that term structure, Joe, still has remained high and sticky. And to me, it's always two things. It's kind of timing, and then it's positioning. And, you know, the narrative has been, retail's been kind of right on this, buying every dip, even through Liberation Day, and institutional investors remain wary. And essentially what I think has continued to happen is you get caught off guard and you think about every single instance like this since COVID, And what's the risk? The risk has almost always been to the right tail, to not jumping in quickly enough, to not participating, which is why I think that rally from Liberation Day was so fast and furious.
We're in July, which is a great month, almost all, but it's also liquidity is much thinner, and you say that there's pothole. What do you call them? Volatility potholes or something?
Volatility potholes, yeah. For someone who doesn't drive, I like driving analogies.
You don't
so.
drive. You let other
No.
people. You have a driver.
Well, I've been living in the city for 20 years, so and soon robots are going to drive us around. So I haven't kept up on it.
So they may still hit the potholes.
That's true. That's true.
So it could be anything, right? And that would cause a little bit of a drawdown. But is the overall momentum still indicate higher prices?
It always makes me think, like, where did we sit a year ago? And if you remember, August 5th, we had that huge volatility pothole.
What was that one?
It was, well, that's the funny thing, right?
Economic indicator,
The fact that you kind of are like, wait a minute, what was it? Kind of tells you
I'm trying to remember what happened
about.
last. I'm like that.
I hear
what
you.
happened yesterday. So.
No, I hear you. It was basically poor economic data, but what was interesting about it is you had essentially the same situation you're kind of having now, which is typically seasonally lower volatility month, lower liquidity, folks are on vacation. And so what was surprising about it, this was also related to the yen unwind, but it was the idea that, like, why would this one thing create this huge spike to, VIX in the 60s? I think we're at risk for something like that happening again this summer, but what I think investors have learned is when you get those potholes, you actually use that to jump back in. So you get that velocity just like you did on April 2nd and you did August 5th of last year, but then what have people been trained to do? You jump back in because that was your opportunity that you didn't get when you missed the momentum from a few months ago.
Now I'm remembering. That was the highest the VIX got.
For a long time. Yeah, since 2020, essentially.
Right, and
Yeah.
it was nothing compared to, Liberation Day or or at least didn't seem like as big an event as we had. And that was just economic worries.
It was, which essentially triggered, and to me, a lot of it, honestly, was this liquidity vacuum that we are now, to be clear, going into. July, August tends to be when, the market makers, they're there, but it's not necessarily the people who are, like, usually the ones doing it. And so I think you're at risk for those volatility potholes, but I think what's interesting about it is for some institutional investors, this may actually be the opportunity that they have missed since Liberation Day, since we got that big rally post the big sell-off, and perhaps, when you think about positioning, it's not as intuitive as I think people think with just the nervousness around hedging.
So this next volatility pothole, and you have no idea what it's going to be. Could it be tariff related, or are we all at this point? People don't respond as much, whether it's because either we're learning that it's a carrot, and it's either a carrot or a stick. It's one or the other with President Trump and what he's doing. I don't know whether the tariffs ever are as bad as he has threatened. Maybe that never does happen. Maybe it's all about trying to get these deals. But if there is, let's say that he decides, okay, I'm doing it this time. They're going in effect. These people did not come to the table. This is when it starts. It's going to be, much higher than ever before on tariffs. Would that be a volatility pothole this time?
Or does it depend on how many countries he
Or how
hits?
many hits?
Certainly, but I'll tell you that the way the markets are pricing right now is very much Trump taco is alive and well. I mean, that's what the market is pricing. I think the risk to that is there's actually this inflection point that has nothing to do with what he's going to tweet about and do going forward. It's what the impacts are already from the past. And I think the big debate among investors is, have we seen the impacts or not? And when you look at the volatility term structure, that pricing is saying we haven't actually seen the impacts of what has already happened, meaning companies built up inventory and that's why things still look okay, but they're not going to look okay a few months from now. I think that's the debate where we're going to get in trouble, not necessarily anything he tweets, about BRICS or about China going forward. I think people are very inert to that, but the inflection point from that data, a lot of people are still waiting for.
When do you know when to expect it? I mean, that's been the waiting for.
We're going to give up pretty soon.
The term structure of options in S&P, IWM, and Qs is that they're elevated about 5 to 6 months out from here and remain elevated. So I can't tell you if that's right or
This is
not,
like-
but yeah, but that is when you look at the kind of the dot plot of volatility, that's where the nervousness is sitting.
And we got, could be inflation or it could be unemployment. It could be either one. And I remember this thing that we had on Thursday, which was weird that it was on Thursday, the jobs
Last week,
report.
yeah.
They keep tripping.
After ADP, then I was sure that, all right, they're fine. This is going to be, because the previous jobs report, oh, if it's not in this one, it's going to be in that next one. And then again, it wasn't there. Is it definitely the next one?
And look, I think the truth is no one knows, right? You can talk to the CEO of a company and they'll say the same thing, which is we're not sure. And then what you bring into play with that is obviously the rates dynamic if we start to get that, which is why I kind of agree it could be a waiting for Godot, but that has been very consistent from the options market
Weird
this whole
that
time.
we're doing it with inflation and labor. We're doing it. It's like there's
And-
the dual mandate. We're
And we
doing it
run
on
out
both
of
sides.
goods, right? When you have a goods crunch that causes the inflation, if it ever happens.
Yeah. So we'll see. Look, what I would say is we're near all-time highs. The cost of your projection is incredibly low to the point where, that Thursday number, we are pricing like a half standard deviation from just average moves, not even taking into account what's been going on with tariffs. That's just like a historical level. And so stuff like that always makes me think about,
Well,
the
okay.
levels.
Is it going to be? Is the big surprise that it's? Oh no, this is horrible. Is it going to be inflation or growth slowdown? Which is it going to be?
It's hard to me, I think it could be more interesting
Maybe it's a
on
little
the
bit of
growth
both.
side.
or
Yeah, it
something.
could be a little bit of both.
Or neither.
You
You think it's a growth slowdown more than an inflation story,
I think it could be interesting.
and not a growth slowdown as a function of an inflation story?
It could be, but what I will tell you is whenever I think about these questions, it brings me back into the big question of, well, what's Mag 7 and AI going to do? Because it comes to this idea of, we had this big pillar of U.S. exceptionalism, which got questioned as we, rejiggered these tariffs. And to me, that hasn't really come to fruition.
Because your view is as long as all of these big tech companies continue to spend,
It's a math thing. It's like it's numerically, it comes down to this concentration risk issue. We keep talking around it, but if they're gonna be okay, I don't see how the market is not okay. We can talk about broadening all we want. We can talk about equal weight versus outperformance of market weight, but Andrew, it's like, if they're gonna be okay, the math is gonna be okay. That's just the numbers of
It'd
it.
be a bad thing to miss.
yeah, but it's fascinating that 7 companies effectively are going to prop up the rest of the whole operation.
Has it not been happening the last decade? I mean, like
The
what would
question
be
is,
different about
but
that?
is it propping up? It's propping up the market. The question is it propping up the whole economy?
Maybe.
It could be.
Let's be half full. At least we have those 7. They got 0 everywhere else. So
Well, those 7 are driving
Right.
other.
Yeah, no, and there's I hate to use the phrase trickle down, but there's a trickle down effect across the board.
trickle down's all we have, my friend. Just be glad. Hopefully, it's not trickle down government. Thank you.
Thank you.
Good to have it.
All right, when we come back, expanding investor access to the private markets. We've been talking about that a lot the last week here on Squawk. Ben Miller, the CEO and co-founder of Fundrise, will tell us about investing in some of the hottest names in technology before they go public. This is for accredited and unaccredited investors, and we'll dig into that. And then later, New York City Mayor Eric Adams will join us with the latest on his re-election campaign and his reaction to the Democratic primary results. That's coming up at 8:30 a.m. Eastern Time.
He's in studio, I think.
He is.
We'll
Squawk
give him a
wants to
big
be right
hug.
back.
Go, Mayor Adams.
Restrictions apply.
All right, welcome back, everybody. Vanguard, Robinhood, and new entrants like Republic are attempting to expand investor access to the private markets with new products. And joining us right now is another player in this space, Ben Miller. He's the CEO and co-founder of Fundrise. He launched the Fundrise Innovation Fund back in 2022, offering both accredited and non-accredited investors access to 22 private companies, including names like OpenAI, Anduril, and Anthropic. And Ben, I want to thank you for coming in today. This is something we've kind of been exploring over the last week. We did have the co-CEO of Republic on last week to talk about tokenization. The SEC chairman was on Wednesday or Thursday of last week. Explain how what you do is different than Republic, because you've basically said Republic may be flouting some of the laws with what they're doing.
I mean, it couldn't be more different. But so our approach is we went in the front door with SEC. We said we need to democratize investing and created the first registered venture fund. So our venture fund is SEC registered, anyone can invest in it, and then our fund invests in private tech companies like Ramp, Databricks, Canva, like any other venture fund. Because the problem is that these private tech companies need to focus on innovating. They can't deal with democratizing investing or crypto. And so we made it really simple for them. We're one investor on their cap table. We're just like any other venture fund, except for our capital comes from the public.
And so there's underlying ownership stake for everything that the public is buying into in your fund, which is a little like the tokenization, except for it's not a token. This is actual ownership through a fund that's been registered with the SEC. Do the companies like this? Do they have problems with this? And I ask only because OpenAI has not been very fond of what Robinhood is doing in Europe with access to its European investors.
Yeah, I mean, when we write a check into the company, like we're on the cap table, like we're just like any other venture fund. What the crypto tokenization is doing is totally different. I mean, it makes no sense to me, honestly, because what you're doing is you're taking something that's inherently a long-term investment and making it something you can trade 24/7. And that basically is not how you innovate. If you think about what a private tech company is doing, they have setbacks, they have drama. The last thing they want to have happen is their stock just plummets overnight in the crypto exchange.
Are your investors locked up for a period of time?
So our fund is quarterly liquidity. So it's an evergreen fund. I mean, the way to think about it is this is the battle happening in the public markets. Right now, there's this conflict between day trading, speculating, betting, and long-term passive investing. So we're taking the passive investing approach, low fee, long-term, evergreen approach, and that's really the difference between the sort of tokenization and.
Can I ask you just a broader philosophical question?
Mm-hmm.
Okay, so we have private companies, we have public companies.
Right.
The real distinction more than anything else is a disclosure story, right? And we've created rules in this country so that we say private companies are private because they don't have the same disclosure requirements that public companies do. Yet, public investors, retail investors, have access, it sounds like, to your fund. Mm-hmm. Increasingly, some of the big mutual funds, by the way, have access to some of these private companies inside, wrapped up, so BlackRock and Vanguard and others have actual access to some of these things. And yet you can't buy them directly. And the question is why? The question is whether we should be changing the rules completely so that folks can actually get real access to these things or not. If they do, should they have the same rules on top of them as the private companies effectively making everybody public? If you could rewrite the rules in a sensible way, what would they be?
Yeah, I mean, the challenges of the last 20 years, companies don't want to go public anymore because the public markets have changed so much. It's become much more of a casino.
Right.
And so these private companies, they need to focus on staying private, focus on innovating. I mean, OpenAI is just changing the world, right? So on the other hand, like look at Mag 7. If Mag 7 had not been public, if they'd been private companies, the total return for the last 15 years in the S&P 500 would have been 5% a year. So can you imagine the wealth creation that would have been lost if those companies had stayed private? So there's a real big, this is a serious problem. I mean, if we don't figure out how to get these companies either investable or public, then you're talking about trillions of dollars of lost wealth for the American
But the
public.
question is, with something like what you're doing, does that prolong the path for any of these companies to go public, first of all? And second of all, do you feel like you've done due diligence for your investors?
Yeah, I mean, our companies, if you look at the list of companies we've invested in, right, it's literally the list CNBC put out of the top 50 private tech companies in the world. Our top 6 companies are your top 6 companies. So it's not really a challenge of what are the best companies. The challenge is actually access to those
But are
companies.
you doing your own due diligence?
Yeah, of course, we're.
Besides picking up our list, right?
Yeah.
You're doing your own.
The thing is that we're a tech company. We have 225 people at the company. We're a customer of 80% of the software we invested in. I mean, we have 100 software engineers. We understand the companies we're investing in. It's not a question about are these great companies. Clearly they are. It's a question of how do you get access to them, and should access be limited only to the super
What
wealthy?
do your software investors, or software engineers do?
Well, we have 2 million customers at Fundrise. We have apps, APIs. We have a lot of software in the company, and so as a result, we use AI, we use Databricks, these are all these pieces of software that allow us to diligence the companies before we invest.
Do you consider yourself the gentleman's Robin Hood to some extent, like long-term holders of this stuff?
I mean, we're like the vanguard of tech. I mean, it's much more about long-term passive than day trading. I mean, there's a big difference.
And your goal would be what? I mean, these companies, you go to them and cut the deal? Do you have any companies come to you?
Yeah, man, I go to the company right now. I'm trying to get to Waymo. So if Waymo's watching right now, I think that it would be great if we could bring our 2 million customers to Waymo's benefit. We invested in Ramp, and we sent out investor update to all of our customers, and it was the most successful marketing campaign in Ramp's history. So it really is a symbiosis between having millions of customers
But
and
back to
having
this idea of pushing off the time when any of these companies will have to go public. Do you think you extend that timeline?
I mean, we're part of that trend. I mean, I feel like the problem is that being public has a lot of negatives, and what I care about is America owns the next generation of technology, and
Right.
so what encourages that is what matters.
So the question is, how do you? I mean, ultimately, Paul Atkins, who was sitting where Joe was sitting last week, who's now running the SEC, was saying we got to fix that. He said we got to make IPOs and being in the public markets great again. Right? That was his phrase. Now, there's a question mark about whether he's going to ultimately regulate tokenizing these things or all of that kind of stuff, or even what you're doing. He thinks, I believe, and I want to speak for him, that if he could fix the public market piece of this, he would effectively crowd out, frankly, from a market's perspective, what you're doing. And
Yeah.
what everybody else is doing in terms of staying private longer, right? He would try to shift that balance rather than regulate all the folks who are doing all this. He would say, I'll let them keep doing this, but what I really need to do is fix this other thing over here. I don't know if that's the right answer.
I mean, it would be great. I mean, I've cleared something like 100 separate SEC registered offerings, so I have a good sense of what it takes, and it's really burdensome. It's a lot better now than a few years ago, but the reality is it's not just about the public burden, the regulatory burden of being public. The private capital markets are now massive. I mean, they're trillions of dollars. They're not going to go away. It's really a question of why are they private? It's because they can execute, focus. They don't have to worry about their stock going down. When their stock goes down every time, a model hallucinates or a rocket blows up, that affects every employee at the company, and morale drops. I mean, you really want to focus on the long term, and the public markets, they're not always the best place to do that.
All right, Ben, want to thank you for coming in. Obviously, this is a bigger question and a bigger issue, but we appreciate your insight.
Yeah, thanks for having me.
Fascinating. Thank you. Coming up, we're going to talk about America's deficit reckoning. We're going to check out some of the independent analysis of President Trump's budget plan and how it could impact markets. And Elon Musk wants to start a new political party. He's calling it the America Party, but investors see that as another bump in the road for Tesla. The stock trading lower this morning. We'll talk about that when Squawk Box returns.
Tom.
Welcome back to Squawk Box. Futures have moderated the losses. We actually did see the Dow just briefly in the green, but it is back down this morning. Treasuries, got to say they've been fairly well behaved in terms of yields, whether that's for good reasons or bad reasons. That's the ultimate questions. But obviously, the passage of the in President signing the big bill, we're not at 8% yet on the 10-year. Let's check out oil, which has rebounded a little bit this morning. Actually, it's now down 66.90. Gold, take a quick look, and then we'll look at Bitcoin, which are both a little quiet this morning. Gold off about 1%, and Bitcoin was up a little more earlier, but it's up about 0.25% right now.
Okay, meantime, last week Elon Musk threatening to start a new political party. Now he says the America Party has been formed. Musk didn't provide details, but has now vowed to boost his political spending to unseat lawmakers who voted for the bill. In a long post on Truth Social yesterday, President Trump wrote that he's saddened, he says, to watch Elon Musk go completely, quote, off the rails, essentially becoming a train wreck over the last 5 weeks. And he said the one thing that, quote, third parties are good for is the creation of complete and total disruption and chaos. In other Musk news, a new piece in the Wall Street Journal outlining the challenges that Tesla faces in China. Those include rising competition from Chinese EV makers and a hit to Musk's reputation, they say, as a partner for Beijing and Washington now that the relationship with President Trump has soured. You can look at shares of Tesla down about 6.5%. That piece in the Journal, though, is fascinating because it talks so much about things I didn't even know about. So some of these cars in China have things like what are called selfie cameras. So that's like a new thing that people like. They like to have a refrigerator in their car so they can put drinks in the car.
I have to have a bed so I can sleep.
There's all sort. No, but apparently this is the future of cars in China already has all sorts of features and functionality that apparently Teslas and other vehicles and clearly U.S. automakers are just
base.
super far behind. Apparently there's lots of screens. People like to watch movies. Hopefully not driving, but screens everywhere. There seems to be just a huge amount of more quote-unquote tech in the cars in China than what Tesla has. And apparently Tesla, folks at the Tesla factories in China would call back to the headquarters in Texas and say, hey guys, we need to upgrade what we're doing here to compete with what's happening, because culturally this is what the folks in China want. They want the selfie camera, they want the refrigerator, they want all the stuff. And apparently it's been very sort of a slow roll in terms of the response they're getting.
Right.
And it's apparently taking a real hit to market share in China. Tesla really was one of the most advanced players. And you could argue, by the way, that Tesla helped build the EV market in China.
They were in more trouble.
But this is what the Journal details this morning. So it's pretty.
So you see the Rolls is coming out in 2035. It's the 103EX. I saw pictures of it. It's a concept car, autonomous, electric, luxurious lounge chairs. And silk carpeting.
The lounger?
Yeah, and it opens with a.
Yeah, but that's like a decade from now.
Yeah,
You guys are doing it basically
right
already.
now.
Already.
Explain this why do you want the selfie camera? What is that?
Because folks in China love to take a selfie. They love a
What's the
Don't you
selfie.
have a phone?
No, the car takes a picture of who's in the car.
Yeah, but the car has
Like
a camera
I don't want-
built into the thing, and people press the button and they take the selfie.
It's like a
Okay.
photo booth?
It's like a photo booth.
Moving photo booth?
I'm not paying more for that.
No. And what happens when it
You don't have to. Apparently, folks in China are doing it regularly.
Okay.
Coming up, Israeli Prime Minister Benjamin Netanyahu is set to meet with President Trump today at the White House. The focus is expected to be on ending the war between Israel and Hamas. Former White House foreign policy advisor Dan Seymour is going to tell us about that process and any sticking points that could come up during that conversation today along the way. Squawk returning with that after this. Welcome back to Squawk Box. President Trump will meet with Israeli Prime Minister Netanyahu at the White House today. The focus is expected to be on a ceasefire between Israel and Hamas. Joining us right now for more on all of it, Jan Senior is the former policy advisor in the Bush administration and host of the podcast Call Me Back. What do you think is going to happen today? What do you think's really? Where are the fault lines in this conversation?
I think that what we are going to see this week is how much is possible once the biggest threat to all U.S. allies and U.S. interests in the Middle East is severely weakened, which is Iran. Up until now, there was this ring of fire around Israel, this what we call the Seven Front War. There was pressure on the Gulf states, the Sunni Gulf states in the region. There was pressure on the U.S. There was pressure on international shipping. We all know all of this. The head of the snake was Iran. And for the first time, people have been talking for decades. President Trump has been talking about it now for about a decade. Prime Minister Netanyahu has been talking about it for almost 4 decades, that until you deal with Iran, you can't deal with the region. This is the first time, since at least I've been following Middle East affairs, that Iran is really severely on its back foot, and then opportunities open up. So what could those opportunities be? First of all, a possible ceasefire deal. I do think we're going to make Israel and its mediators that are right now negotiating in Doha are going to make real progress on that. I don't know if they'll be able to announce it this week, but I think, because there's some important details still being worked out. But
what do you think those details are that are at odds?
What is clear that there's real movement on is the possibility for some kind of ceasefire for about 60 days, in which Israel would get back 10 living hostages, approximately, and somewhere in the range of 18 of the deceased hostages that were killed, the bodies. And then the question is, and then some Palestinian prisoners would be released from Israeli prisons. Then the question is, what obligations will Israel have in the deal to get more humanitarian aid into Gaza, and whether or not this is going to be on a path towards the conflict actually ending, the war ending, Israel's actually committing in this 60-day process. At the end of the process, they're going to be on a path to ending the war. And then what Netanyahu said before he left Israel yesterday is, if that's the case, Hamas cannot remain in power. So that is like the big issue, and I think they're negotiating that, and that Hamas is looking for some kind of commitment from Trump that if they begin this process and it's a phased release, some hostages get released, that it actually continues and it just doesn't stall before they get to the end of the ceasefire. But I want to say, I also think look out for news about normalization between Israel and some other country in the region. I think we are going to see, I don't think it's going to be Saudi. No, it won't be Saudi yet. I think keep an eye on Syria. Okay. I think the Abraham Accords now are going to get new life. The first time they've gotten real life since they were originally signed in 2020, where new parties will be coming in, partly because the region is now not living under this hegemon. There's possible hegemon, which was Iran.
October 7th was a reaction to that and trying to prevent Saudi Arabia from coming in. What's the reaction to more countries coming in? Is it pushed through at this point?
Yeah, I think that if you're Yahya Sinwar, the architect of October 7th, on October 6th, if you had told him the night before the operation that you're going to launch this war against Israel, and in less than 2 years, Iran's entire proxy system in the region that Iran had been investing years and billions of dollars in is going to be collapsed. Hamas largely wiped out, Hezbollah totally wiped out, the Assad regime, which was a proxy state of Iran's, had been in power for 53 years, collapsed. Houthis still a nuisance, but not like this persistent threat. These militias in Iraq and elsewhere in the region severely weakened. I think Sinwar would have been told, stand down. Would have been told by Tehran, don't do it.
So tell me
it's not worth it. So, and oh, by the way, at the end of this process, more countries will be normalizing with Israel, not fewer. And Saudi Arabia, I don't think Saudi Arabia is imminent, but I think the direction of travel is only going in one direction, which is I think Saudi and Israel are ultimately going to normalize.
What do you know or assume about the capability of Iran to build a nuclear weapon? How long?
So nobody knows. I don't believe anybody truly
probably
knows.
Not months. It's at least years.
I think it's years, just based on the following.
Why don't you know more? You've got contacts with everybody in Israel.
Well,
doesn't the Mossad know?
Well,
not that you would know automatically.
Yeah.
But
let me explain. I think that if you look at the what the inputs that go into building a nuclear bomb, right? You need the expertise, the nuclear scientists. You need the infrastructure. You need the facilities, Fordo, and then you need the ingredients, the enriched uranium, the highly enriched uranium. We know many, not all, but many of the scientists in Israel have been killed, so the knowledge has been systematically wiped out. We know the infrastructure has been decimated. The question is some of the ingredients, like this highly
We know
enriched
the
uranium.
infrastructure was decimated.
Yes.
Because we
Yeah.
either obliterated or...
Yeah, the infrastructure was the question is, did they get out some 400 kilograms of highly enriched
You
uranium
think
and
that
move
the
it somewhere
buildings
else?
300 feet
Yes.
down were destroyed?
Yeah, I mean, to the point that they can't be used anytime soon. And keep in mind, the centrifuges in those facilities that are used to enrich the uranium are highly, highly fragile. They're highly delicate.
Yeah.
Every nuclear physicist you talk to says they are susceptible to the least bit of vibration. The moment they're subject to a little bit of vibration, when people walk into these facilities, they're like on tippy toes because they don't want to damage these things. The idea that you drop what was the equivalent, the U.S. dropped what was the equivalent of like a third of what it dropped on Hiroshima. I'm not exaggerating. I think that, let's just say there's probably a little bit of vibration.
Dan, what did you make though of those reports of internal analyses, I should say, that suggested the worst case scenario was that we actually didn't get it?
I think that scenario means that they're probably months away versus years away. Look, my view on this is the Iran operation, both Israel's role and the U.S. role, accomplished two things. First of all, at a minimum, it set back Iran's nuclear program. We can debate whether or not it's months or years. It was set back, and the IAEA, the Europeans, and the U.S. all believed they were weeks away from being able to dash to a bomb, and possibly days. So no matter what, I think this was a success on that front. The second thing is, it demonstrated to the world that Iran is crawling with Mossad operatives. Israel's intelligence in Iran is extraordinary. So now, and so you think about it, Iran's doesn't have a conventional military anymore to speak of. It's lost its proxy system, which is how it was wreaking havoc in the region, and its nuclear program is at worst set back months versus years. But Israel's eyes now are in there and on top of it. They have total control of the skies. I mean, so this
How
is like,
long do you think they have total control of the skies?
economy is decimated, and there's internal opposition inside the country. So the state of Iran, the regime.
But then
is
what
a
happens?
fraction of
But
what
then
it
what
was.
happens?
What happens going forward? So there's one of three scenarios. One scenario is the regime falls. Second scenario is that the regime doesn't fall and actually, which is something the Trump administration is talking about, is Israel, the U.S., and Iran negotiate some kind of deal that is like a version of the JCPOA, except not with a regime on the march, but a regime that is severely weakened. So it's actually a deal that's favorable to those interests that are fighting against proliferation. The third scenario is neither of those two, and it's just a weakened regime. Think of a country like Yemen or Oman, just no longer the threat, the menace it was in the region, just like a weak regime kind of limping along inside the Middle East. Any one of those scenarios is preferable to what
Okay,
the
how does that
U.S.
change the
and
dynamic?
Israel's been living with for the
So
last
therefore,
decade.
and then how do you think the Gaza situation resolves? I don't even know what the word resolves means in this context.
Yeah, I think the I think the success in Iran is an inflection point for Israel to basically declare victory in this seven-front war. It's not to say it doesn't have to be on guard. It doesn't mean doesn't have to be alert. It doesn't mean it doesn't have to take military action from time to time in the region, including in Gaza. But it's an inflection point for Israel now to make some meaningful, take some meaningful steps to winding down. The real question: Israel's going to maintain a security presence in Gaza no matter what. Okay, it's not going to reoccupy Gaza, but Israel. Even Hamas is acknowledging that Israel's going to have to stay in the Philadelphia corridor. The question is, who's going to run the civilian government in Gaza? And that's not clear yet. I do not believe an Arab country is going to step in, and I don't think the Israelis are going to accept the Palestinian Authority. So is there someone else who can step up and kind of run civilian affairs?
Okay, future of Bibi Netanyahu as the leader of Israel.
Look, he doesn't have to go to elections before the deadline is October of 2026. I think he's in a much stronger position today than he was before. I think if I had to predict today, he will go to elections, not immediately, by the way. There's this talk that he would go to elections soon after the Iran operation. I don't think he'll go soon. I think he will wait, because even if he goes to elections, it takes 3 months before the election actually happens. A lot can happen between now and then, whereas right now he's a pretty stable government. But when he goes to elections, I think he will make the elections about normalization with Saudi Arabia. that he's the person who, quote unquote, defeated Iran.
So when do you think
and
that'll-
he's the one who could normalize with
So
Saudi
when does that
Arabia.
happen?
I mean, when would the normalization happen, or the election?
The election.
Sometime, in the next year. But I would say on the outer end of that. Like I think he's not going to call elections for a while. I don't think he's in a rush to call elections. I think he's in a pretty strong position right now. He's got a pretty stable government. No need for him to rush to elections. But the elections will be about normalization of Saudi Arabia, which means if he's elected, I think his government would look a lot different than his government today. It would not be as hardline and right wing as it is today.
Dan, thank you. Fascinating.
All right, when we come back, we do have two big interviews coming up, both in the next hour. Treasury Secretary Scott Bessent will be joining us at 8 a.m. Eastern Time, less than 15 minutes from now. And New York City Mayor Eric Adams coming up at 8:30 a.m. Squawk Box will be right back.
Set.com.
And coming up, America's deficit reckoning, analyses of President Trump's budget plan and how it could impact the market and the economy. And then we'll talk more about this with Treasury Secretary Scott Bessent, be our special guest, on trade talks, tariff deadlines, big beautiful bill, taxes, all that at 8 a.m. Eastern. Squawk Box coming right back.
Welcome back to Squawk Box. President Trump's budget plan sparking some concerns about adding trillions to the deficit over the next decade. Leslie Picker joins us right now with more on America's deficit reckoning. This is a special report exploring the consequences of letting America's fiscal health worsen. Leslie, good morning.
Good morning, Becky. Thank you. Our focus here is not how to fix the deficit, but its consequences. Independent analyses have said the new budget plan will add trillions of dollars to the deficit over the next 10 years. The White House has disputed those figures, and the bond market remains in wait-and-see mode. Already, though, America's deficit is more than 6% of GDP. That's about 63% higher than the average level from the past 50 years. Former Treasury Secretary Robert Rubin, who we interviewed before this latest tax and spending plan passed, said we are on the, quote, cusp of this uncharted territory we've never been in before. Given, though, that the U.S. can't really go bankrupt, I asked him what a debt crisis would even look like. Why should anyone care?
Well, nobody knows what it looks like. We haven't had one of those. But I think what it looks like is rapidly escalating interest rates, a deep concern about our economy and our markets and interest rates around the world. Instead of global capital coming into the country, which it has now for such a long, long period of time, global capital moving out of the country. And then a very serious, at least potentially, a very serious adverse effect because of all of that on our economy, on growth, on standards of living, and the economic well-being of average Americans.
So-called monetizing the debt or printing additional dollars to ensure that the U.S. makes its payments would have far-reaching implications on the markets, the economy, and even international relations. To learn more, watch our full special report, America's Deficit Reckoning, which you can find at cnbc.com/deficit reckoning or by following and listening to Squawk Pod wherever you get your podcasts.
All right, Leslie, stay right here. We want to bring in another voice to this conversation as well. Peter Bookvar is the Chief Investment Officer at Bleakley Advisory Group. He's also a CNBC contributor. And let's start with just a couple of points. First of all, yields right now in the Treasury market are pretty calm. No serious concern about this. In fact, equities were higher on the idea that this would actually boost growth. Where do you come down on that, Peter?
Well, it's one of those situations that it doesn't matter until it does. I try to figure out, okay, when does it start to matter? It may not start directly in the Treasury market. Maybe it shows up in the dollar. Maybe it shows up in what we've seen in the price of gold, that investors are beginning to question. Now, domestic investors have actually been given a gift with higher interest rates, because more and more over the past 10 years, the U.S. deficit has been financed by U.S. domestic buyers, whether that's the saver, whether that's the Fed, whether that's the banking system. The foreign ownership of U.S. Treasuries has gone to about from 50% 10 years ago down to 30. So it's a question of how do they behave in response to our deficits. But it's not just us that has the issue. Japan has an issue. The UK has an issue. And this global bond police is driving around the world's neighborhoods, not just in the US. So yes, will it matter at some point? But maybe it gets reflected in other things before there is a response in the Treasury market.
Obviously, running a big deficit like this, big problem. 6.2% is one that we've built up over a lot of time. Leslie, I'll ask you what you heard from people about whether they thought this tax bill should get passed. And then, Peter, what you think would have happened if the tax bill didn't get extended?
Well, I think most people who are considering themselves deficit hawks would say that this was a good opportunity to find a way to really chip away at the deficit in more of a pure play fashion, kind of similar to the conversation we had with former Treasury Secretary Robert Rubin, where in the 90s they really went kind of line by line in the budget to see what was the best way to kind of be more fiscally disciplined. Most people we talk to, though, and I think it's important to note this, that they don't want necessarily a balanced budget. Nobody really wants to pay off all of our debt. The importance is really reining it in so it doesn't start to crowd out other areas. It doesn't create a situation down the road. And when we say down the road, this could be anywhere from next month to 20 years from now. To Peter's point, we don't know kind of when this could be an issue, when this exactly will create some sort of confidence problem here, that they say that basically it's important to do things prudently so that you don't risk finding out what happens.
Peter, you think it would have been a disaster if the tax cuts didn't get extended?
And you also point out that it's saying you're blowing out the deficit by not including. Okay, if you didn't pass the tax cuts, how much of the $3 trillion that is forecast would we not be talking about? Not passing the tax cut. Most of that is not if you hadn't passed the tax cut. So you're adding in something that everyone assumed was going to happen. So it's almost a faux addition to the debt that we're talking about here. It's almost like the Medicaid cuts. A 20% increase over 10 years in Medicaid is not a cut, and that's what we're talking about.
Exactly. All we're doing is extending existing tax rates, and we don't have a tax problem. 17% of GDP is tax revenue, and it's been that way, give or take, for decades. It's that spending is now 24% of GDP versus 20.
Right.
That is the big problem. And that's why the CBO, I know it's very easy for people to say, okay, well, the CBO says, yes, if the tax cuts weren't extended, this is what would happen. But if they were not extended, the economy would tank. Because right now, what I see in the first half of this year, the economy has slowed on average in the first 2 quarters. And you've got to merge Q1 and Q2 together because of the sort of timing impacts of tariffs and the behavior pull forward and thereafter. And we're only growing around 1%. And therefore, having those tax cuts expire would have been a mess.
Is there, and we're going to have Scott Besson on. I know he's ready. I'm going to ask him the same question, and it's heads explode when I ask this. But is there any way that there's a better deficit, that one deficit is better than another? And the point I'm making is, if it's a tax cut caused deficit, is that better than a spending caused deficit? And I think at least there's hope that there could be some growth spawned by the tax cut. And neither one, I don't like either one. I wish we could cut a lot more spend, but is there any way that this could end up not being a $3 trillion add-on to the debt?
Yes, and yeah, the growth key part is the most important. But on the spending side, 85% of government spending of the $7 trillion is all the non-discretionary stuff, and then you add in obviously interest expense and defense and stuff. It's all about just slowing the rate of growth of spending. There's no cuts in spending. It's just tweaking it to a slower rate and hoping economic growth on the tax receipt side. See, that's the biggest risk, is if the economy goes into recession, if, of course, not making an opinion, but I'm saying if, then that budget deficit goes to 10%, because that's when tax receipts really falter. So that's, to your point, Joe, economic growth is so crucial here in generating it.
Peter, thank you, and Leslie, thank you. We look forward to that.
I wish you, when you were doing this, I guess we would have done this report like 4 years ago,
I know.
3 years ago, 2 years ago.
Last week, 2 weeks ago.
Right. And Ruben was actually, everything that he was saying was before this latest big beautiful bill was passed.
Right, we've been working on this for about 5 months. We have a dozen of interviews for the project, so it's clearly a prescient issue and one that will exist
And
for
then
a while.
the only other thing I was saying, okay, the bond market is in wait and see mode. Bond market's pretty damn smart and pretty far out in front of a lot of these things. So is it really in wait and see mode, or has it already factored in everything that's available where we are right now, and it still puts the 10-year at 4.30, not 5 or 6%?
I think some days the Treasury market, and I'll talk about the long end. Who cares about the short end, because that's just fed and manipulated. The long end, some days it trades off what they think about growth. Some days it trades off because there's an auction that didn't go so well. Some days it trades off to future deficit concerns. I think over time, long end rates are going to go higher, but that's going to be also a global thing as well. Because some days the U.S. Treasury market's going to trade off where the gilt yield went or where the JGB yield went because of worries about their debts and deficits.
Thank you both. We appreciate it. All right, it is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin, and the futures this morning are, at this point, a little bit weaker for actually a mixed picture. Dow futures are up slightly. The S&P futures are down by 15. The NASDAQ off by 86.
And join us now for the latest on tariffs and the recently passed budget bill and more. Treasury Secretary Scott Bessent. Mr. Secretary, thanks for joining us. I don't know how much you could necessarily hear of our last conversation. We definitely want to talk trade, tariffs, and all the above, but let's keep the discussion going about the big, beautiful bill, deficit concerns, debt concerns. You have made the argument in the past that this will address the deficit, and you see deficits in future years coming down from whatever it is, 6% of GDP. How do you argue that that's going to happen? Tell us again.
Well, good morning, Joe. And look, we inherited a mess, and I'm not sure where all these deficit hawks were when Team Biden was blowing out the deficit. So last year was 6.7% of GDP, which was the highest it had been when we weren't in a recession, weren't at war. And as your previous guest said, we don't have a tax collection problem, we have a spending problem, and we are trying to get that under control. We are also trying to accelerate growth because changing the growth trajectory upward solves a lot of the deficit problems.
Mr. Secretary, I asked the question that not all deficit spending is equal. I don't think. And would you argue that if a deficit resulted from lower tax rates or from extending the tax cuts, whatever you want to call it, if it can cause some growth, is that superior to the deficit, or is it less deleterious than the deficit you get just from Green New Deals or IRAs or whatever you're talking about, the government, just transfer payments and the like?
Well, Joe, you're exactly right. Does the spending create more growth, and is the GDP growing faster than the deficit? One of the things that I agreed with Secretary Yellen on, the important number is the debt to GDP, and we intend to bring that down. We also intend we cut spending. On the IRA, there's substantial pullbacks. A lot of those were uneconomical, stranded assets. And the Trump economic agenda, as I've said many times, it's a three-legged stool. It's trade, it's tax, and it's deregulation. So, I also believe that the substantial amount of deregulation that we're doing is going to accelerate economic growth. And the important thing too is we're going to have economic growth in a non-inflationary manner, unlike we saw in the previous 4 years.
Okay, let's move on to trade, and it's amazing how quickly things move. I know yesterday you said by Wednesday we might have a couple of more deals to announce. I know it's Monday, it's not even 9 o'clock yet. Can you give us any idea whether that's likely? Is India, is that in the mix? Can you break any news for us here that something's going to happen in the next 48 hours?
Yeah, we are going to have several announcements in the next 48 hours. And Joe, I think what President Trump is concerned about is the quality of the deals, not the quantity. As you could imagine, as he started herding the cats and trying to get everyone across the finish line, when he said that there's a chance that countries could boomerang back to their April 2nd reciprocal tariff levels, we've had a lot of people change their tune in terms of negotiations. So my mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days. But importantly, too, that President Trump has said that the countries would not go back to the reciprocal rate until August 1st.
Mr. Secretary, question on behalf of a number of viewers who are in business importing things from Vietnam, and they want to know the following. They say there's 20%. Is that on top of existing duties? Is it 20% overall? What is the actual number? Because I think there's a lot of folks who are still confused or trying to do some planning here.
Andrew, 20% overall.
20% overall. So there's nothing that's not tacked on to something else before that.
No, this supersedes all the other tariffs. Now, there may still be some of the 232 tariffs for specific industries, but in terms of generalized, it's 20%.
Mr. Secretary, I think you took, or at least it was interpreted, it was a softer tone on what's going to be included in the letters that go out on Wednesday. What can we expect? What are they? Is it ultimatums and President's way of the highway with some of these, or are there details on I don't know, sort of staking out positions and letting these countries know what where they have more work to do?
No, they're pretty standard letters, Joe. It's just thank you for wanting to trade with the United States of America. We welcome you as a trading partner, and here's the rate, unless you want to come back and try to negotiate.
The one thing I've noticed that a lot of people that don't want any tariffs and are the most critical of the entire approach to trade are the ones that seem most disappointed when the president doesn't follow through on the tariffs that he's promised. So when it appears that he's trying to do deals and trying to, negotiate from a position of strength, they're the first ones to criticize him for not following through with the really draconian tariffs that we all hope doesn't come to pass.
Well, Joe, as I've said over the past few weeks, TDS, which used to mean Trump Derangement Syndrome, has turned into Tariff Derangement Syndrome. And this same group was pulling for the economy to slow, for inflation to pop up. None of that has happened. And as a matter of fact, we're taking in substantial tariff income, which I don't like the CBO scoring, but some Democrat made the mistake of asking the CBO to score tariff. And over the 10-year window, that's $2.8 trillion based on the current deals. And I can tell you that the deals that are coming out will be slightly higher than that. So again, I don't like CBO scoring, but $2.83 trillion over the 10-year window substantially eases the deficit.
Mr. Secretary, you are an incredibly busy man. I think your portfolio is more expansive than any Treasury Secretary I recall ever seeing. I just wonder, what job do you think is more important to the markets, to the economy? Would it be Treasury Secretary or Chairman of the Federal Reserve?
Look, they're both very important jobs. I am busy as Treasury Secretary. Becky, I think you're asking which is more important for me to do.
I am.
Okay. Look, I will do what the president wants, but I think that we are making great gains here at Treasury. We've had a busy 5-6 months out of the blocks, and we've got a lot to do. Passing the One Big Beautiful Bill on July 4th was an incredible achievement by the president, by Speaker Johnson, by Leader Thune, but now Treasury is tasked with the implementation.
Mr. Secretary, as you think about interest rates, we've heard from the president talking about what he would describe as too late Powell. Powell is not going to be in this job in a year from now, no matter what. And one of the conversations we had with Steve Leisman last week was the idea that maybe the market has already built in almost the shadow Fed idea that you raised about a year ago before the election in terms of how the market thinks. Do you think that interest rates, to the extent they have been kept down, irrespective of what the Fed is doing, or at least the expectations of what the market thinks, is a function of that?
Well, Andrew, I always say markets live in the future, and I think markets may be pricing in that perhaps the president's right, the rates should be lower. I would say that the market's pricing in lower, I think it's 2 cuts for the rest of the year, and then the 2-year, the overnight and the 2-year are inverted. So maybe the market's just pricing in the economic fundamentals, and sure, is a different Fed chair is a kind of forward guidance, but as I reiterate to people all the time, it's not just the Fed chair, it's a committee.
What, by the way, what are your lunches like with Jay Powell these days?
Well, it's breakfast, and we have a lively exchange. We do a home game and away game. He comes to Treasury, I go to the Fed. The Fed's food is much better, so I enjoy breakfast over there. And we have very lively and far-reaching discussions with a lot of mutual respect.
They can spend as much money as they want on breakfast at the Fed. They're printing. It's like anything goes. It's like
they're not worried about egg prices over there.
Are people actually leaving tariff offers for you on your voicemail, or was that?
they're coming in a lot of different ways, Becky.
Fast and furious.
Yeah. You're at this point you're still Treasury Secretary, so I need to ask you about the dollar. And it actually is a sort of an issue that the markets are at new highs, equity markets, the bond market has been behaved after the big beautiful bill. But people looking to nitpick or looking for something to really be concerned about talk about the dollar's behavior since the beginning of the year. I think it's the worst start of a year in 30, 40, 50 years. Was it overvalued, Mr. Secretary? Was this long due? And given the recalibration in global trade the president's trying to effect, is this to be expected and actually welcomed?
Well, Joe, I was in the investment business 30, 40 years, and more than half my gains came from currencies. So I think I have a good box to stand on here when I talk about currencies. And I can tell you that it's natural for currencies to go up and down. And what we've seen is not out of the ordinary. Maybe the speed with which it happened, but again, these days things seem to happen much faster. After the bottom in the stock markets on April 9th, we had the fastest recovery from a 15% drawdown in history. And I would point to President Trump's first term. Over the first year, the dollar went down about 7% when Tax Cuts and Jobs Act were passed in December. Then over the ensuing few years, the dollar went up. And the value of the dollar, it could mean that other countries' currencies are strengthening. The index that you're referring to is the DXY. The largest component of that is the euro. And one would expect that the euro would appreciate given the fiscal spend that we are seeing coming out of Europe, especially on defense and especially from Germany. The other thing that's happened, we have seen a substantial depreciation in the Chinese currency, the RMB versus the euro. So I believe that's down about 11.5% on the year, and it's just hit an all-time low. So, I don't see people waving their hands in the air about the Chinese currency depreciating.
Mr. Secretary, I wanted to just ask you about China. About a week ago, President Trump referred to a potential deal over TikTok in the next 2 weeks. Some people looked at that and said that's an interesting chess piece as part of the larger negotiation with China. What is the timeline at this point with China? Can you give us any sort of sense of how things are going there?
Andrew, one of the things that's not my portfolio is TikTok, so I can't speak to that directly. What I can speak to is I'm going to be meeting with my Chinese counterpart sometime in the next couple of weeks. We had good meetings in Geneva, in London. We both approached it with great respect to the two largest economies. And I think there are things for us to do together if the Chinese want to do it. So we will discuss whether we are able to move beyond trade into other areas.
Secretary, I know you have to leave. I was kind of clumsy in asking my question about just trying to talk about different types of deficits. Judy Shelton, I don't know what happens with the Fed. I don't know who's there in a year, but this is pretty eloquent. She sent this in. This has been one of her Wall Street Journal pieces. There is a difference between government overspending, which borrows from the future to pay for current consumption, and tax-cutting incentives now to spur more production down the road. Government borrowing to finance socialist redistribution isn't the same as government borrowing to invest in entrepreneurial capitalism. That's pretty well. So I might tweet that out. You're free to tweet that out if you want to.
Okay, but Joe, the other thing too is that I think in the Tax Cuts and Jobs Act, which was made permanent, is the 100% expensing of
that's not talking about
which is very powerful. We also have a 5-year window for 100% expensing for factory structures and agriculture structures. So to take a tax hit on that is really, you're really winding the spring, and you are creating high after-tax returns on capital, which increase productivity, which is what makes countries rich.
Very good. Let us know. We're here if you want to get it out I think we count as disclosure, don't we? We count as fair,
We do.
fair disclosure. If you're leaving now and you get something in your email box or something, just call us back. Will you do that, Mr. Secretary? Let us know.
After
Maybe
the
not.
president, Joe, you'll be my second call.
Right, there you go.
That's not bad. Thank you, Secretary Besant. Appreciate it.
Okay, thank you all.
Okay, coming up, Elon Musk saying he's launching a political party to compete against the Republican and Democratic parties. The announcement sending Tesla shares lower in the pre-market this morning. And then New York City Mayor Eric Adams is going to join us right here on Squawk. We're going to ask him about the surge in popularity of his opponent, Zohran Mamdani, and much more. Squawk Box coming right back.
Download the app.
Tesla shareholders not feeling Elon Musk's announcement that he would form a new political party called America Party. CNBC's Phil LeBeau is here to talk about that move and the investor reaction, which right now, Phil, shares of Tesla down by 5.8%.
Understandable, because I think a lot of people are saying, what's he doing? Where's he going with this? And Tesla investors, to a large extent, have always given him a lot of rope to go off and to do and to say whatever he wants to say, because their belief is, look, the man has come up with some incredible companies, whether you're looking at Tesla, whether you're looking at SpaceX, and has done things that a lot of people scoffed at in the past. But now that he's revisiting the idea of politics in terms of forming a political party, it raises a bunch of questions. I mean, look at his comment in terms of, what he wants to do with the American Party when he posted on X saying, when it comes to bankrupting our country with waste and graft, we live in a one-party system, not a democracy. Is that by itself going to bother a Tesla investor? No. But he wants to form a party, which then raises the question, wait a second, what are you doing with your time and your attention? You're trying to form a political party. It would, in theory, target 2 or 3 Senate seats, 8 to 10 House seats, and the goal is to have enough leverage that they could steer legislative talks, whether with the Democratic Party or the Republican Party. Not surprisingly, Donald Trump said that Elon Musk is off the rails in terms of his comments. So this is one of those things, guys, where you look at it from a Tesla investor perspective and you sit there and say, what about Tesla? We wanted you to work on Tesla. That's what we think Elon Musk is best at. And that's the reason that shares are under pressure right now.
Yeah, I mean, this is, look, his intensity and his unwillingness to ever take no for an answer, to be shut down by things is part of why he's so successful.
Without a doubt.
But
correct.
There are questions as to the limit of that and knowing how to prioritize and what he should and shouldn't be going after.
Yep.
That I think are the big issues here too.
Yeah, and I think Dan Ives summed it up best with his note that he put out. Now, Dan Ives, look, let's be clear here. He is a Tesla bull through and through. He thinks that Elon Musk is going to go much farther and Tesla is going to go much higher. But in his note, he said what I think a lot of people believe in terms of when they look at Tesla as an investment, there is a broader sense of exhaustion from many Tesla investors that Musk keeps heading down the political track. Becky, over the weekend, 4 or 5 different people in different situations, whether I was out at an event, out at a store and stuff, they would stop me and they always ask about Elon Musk. You know what they all said? Pretty much the same thing. What is he doing? What is he doing? And that is at the heart of the question surrounding Elon Musk and Tesla, and that's why the stock is under pressure, because people are sitting there saying, are you focused on full self-driving and fixing, the concerns about sales slowing down, or are you more concerned about politics?
That is the question. Phil, thank you. We'll see you again soon.
You bet.
Still to come this morning, economics professor Ken Rogoff. But next, New York City Mayor Eric Adams. That interview is just moments away. Democrat is what he ran as last time. He's going to be running as an independent next time around. Squawk Box will be right back.
Job's done well.
Welcome back to Squawk Box this morning. Take a look at futures right now. Dow up just slightly, about 5 points. So you're looking at the NASDAQ off about 83 points and the S&P 500 off about 15 points. We've got a big interview coming up in just a moment. You do not want to miss this. Making national news, New York City Mayor Eric Adams will be with us at the table. Do not go anywhere. As we head to a break, though, take a look at shares of NVIDIA this morning. CII raising its price target on that stock to $190. We're coming right back after this.
Finding insurance.
Welcome back to Squawk Box. Joining us right now on the set this morning is New York City Mayor Eric Adams, a national debate playing out since Mandami won that Democratic nomination. Good morning. We're all trying to figure out where this is all headed. We're looking at Poly Market. He is still up relative to you. I want to understand what you thought, what you were thinking. We all saw him come on, but really only come on hot 72 hours out, maybe a week out. And it sounds like you've been thinking about this a lot longer.
Yeah, and remember the Poly Markets also days out. It had Andrew above him. 6 months ago, I was in a restaurant and I heard two young people talking about Madani. And then I was in a store purchasing something. I heard two young college students saying the same thing. And I went back to my team. I said, Zohan is going to win this race. And we strategically knew that we should not be in a crowded Democratic primary. And then I decided I was going to run on the independent line. And everyone thought it was hilarious. They said, what are you doing? No mayor could win. Who's laughing now?
So, I'm curious, I don't know if you want to say it, what do you see as your own personal challenges to win this race? I can give you my own list, but I'm curious when you look at this whole situation, your own situation, and what you need to persuade New Yorkers to vote for you? What do you see the thing that you need to overcome?
No, and I like that. Number one, Andrew. Andrew spent $30 million.
Andrew Cuomo?
Yes.
Okay.
Heard his narrative. I always say he didn't have the legs to run in New York. New York is a competitive place. They want to see you. You can't come out on weekends. You have to be firm. And I think he really should do an analysis and say, give Eric an opportunity to run against him.
So you would need him to get out for this to work?
He should. And the second is, my story has never been told. People don't realize that we broke the record 11 times in jobs, that this is the strongest economy in the recorded history of the city. What we did around housing, the crime, removing 22,000 illegal guns off our street, 100,000 illegal vehicles off our street. 12 months of Broadway has been the best Broadway in the recorded history of the city. My story has never been told. It was overshadowed by that lawfare of being prosecuted because I decided to defend the city. And now I'm going to have the opportunity to go to working class New Yorkers and say, think about this, we don't want to defund our police department. We don't want to empty Rikers Island and have people go back into the communities that prosecute them. We don't want to have a city where we say we don't want billionaires in the city. I mean, just think about what we're saying.
What do you tell New Yorkers who say, look, they are anxious about the settlement that you've reached with this president? They say you're being held hostage by this president, that if you're the mayor, if you continue to be the mayor, you have to listen to whatever this president says, because the moment you don't listen to the president, he can go after you again. And what do you say about the team around you? Because the other piece of this is trying to have an amazing team around you. And there have been concerns over the years that some of the team members either now don't want to be there because of the Trump situation, and others that say you had some family members around and other things. What about rebuilding that team?
Well, let's peel that back for a moment. The deal that I made with the president, you tell a lie long enough, it becomes the truth. There was never a deal. I didn't even know Donald Trump personally until he was campaigning. On the campaign trail, he said, look what they're doing to that mayor, it's unfair. And so I thank him for acknowledging what happened. Second, my team, I just gave you a list of wins.
Right.
You know, when you looked at how we turned around this city and going through COVID, going to 237 migrants and asylum seekers, dealing with the crime that we were facing, recovering our economy. When you look at that team won. That team was successful. Now look at my team now. Randy Mastro is my first deputy mayor. Commissioner Tish is my police commissioner. Camille Joseph Volok, my chief of staff. Listen, you learn as you go on. When we started in January 1st, 2022, trying to get people to work, they say, Eric, are you kidding me? I'm getting extended overtime. I'm getting extended unemployment. I'm not coming into the office. You want to work 12-hour days. And so you couldn't bring in the talent you wanted, even if you wanted to. People got used to working at homes. They know how I worked, had to deliver for the city, and I did it in spite of what we had to go through.
What about the affordability message that Mandami has put out there? Now, look, the truth is, there's a lot of things he said that he can't actually do. Things that you have said, and I think described.
Right.
But the question is, how do you reach those voters who say, yeah, there's an affordability issue, and what are you going to do, and what are you going to tell those people that you can
Great
fix?
question. Legitimate concerns about affordability, not only in the city, in the country. Everyone can talk about the prices that we're dealing with, purchasing basic things. And we got that. We heard that message. I know we're living in poverty. He knows we're living in luxury, actually is. I know living on the verge of homelessness. I know struggling every day, going to school with a garbage bag full of clothing, afraid you're going to be thrown out. That's my story. That is not his story. He's an academic elitist that comes with these philosophies and principles that don't work out on the ground. The foundation of him paying for free buses, he wants to tax 1% of high-income New Yorkers. Mayors don't have that authority. You know who has that authority? Assemblyman. He's an assemblyman. And the governor already made it clear she's never going to do it. And so the foundation of his program is not winnable.
Right.
Now look at mine. $30 billion back into the pockets of working class people, paying off medical debt. paying college tuition for foster care children, dropping the cost of Metro cards on those low-income New Yorkers, just passed acts to tax. Low-income New Yorkers pay no income tax at all because of the partnership we had with Albany. So finding ways as the mayor to put money back in the pockets of working class people, I know how to do. He doesn't. This is a class exercise. Right now, we need expertise that we don't lose the success we made in this city.
Have you spoken to Andrew Cuomo at all?
Yes, yes.
Talk to him about the potential for him getting out?
Well, you know, there's a real history with Andrew Cuomo and particularly black elected officials. He did it to Carl McCall. He went on the liberal line with Carl McCall when he was running for governor. Carl McCall lost. He pushed out Charlie King when he was running for Attorney General after raising $5 million. He pushed out Charlie King. He did the same thing to David Patterson when David Patterson was governor. For him to see that I was on my own independent line prior to the race, and then for him to join it, he knew he was setting us up for this. He knew Madani's were going to be on the
So has he
Rooker
asked
family
you
card.
to step aside?
I'm sorry?
Has he asked you to step
Yes.
aside?
I said, Andrew, are you that level of arrogance? I'm the sitting mayor. I'm the sitting mayor of the city of New York. And you expect for me to step aside when you just lost to Zohan by 12 points. He was up 32 points, $30 million. You lost, they heard your message and you lost. Now let a fresh set of legs that has produced for this city. And that's the highest level of arrogance.
I got a different question for you. You probably saw the story over the weekend about Zoran claiming to be Asian and African American in this application he made to Columbia. I'm curious just whether you think that should matter. Whether he's made this argument that there were not enough boxes to check to represent his heritage. What do you personally think?
There was a mix. There was a box for, I believe, mixed ethnicity. There was a box. First of all, he was not American at the time. He just got his citizen a few years ago, I think in either 2018. It's not excusable. He said himself when he was interviewed, if he called himself African American, it would be misleading. During those times, you were identifying seats for particular groups to make sure you had diversity on the campus. It was the wrong thing to do. So instead of saying that I didn't have enough boxes, how about saying I'm sorry? How about saying I'm sorry that I did a video mocking Hanukkah? How about just standing up and say I'm sorry, I'm wrong? And I've said it over and over again. When I look at an analysis, what I had to put the city through, I said to New Yorkers, I'm sorry I had to put you through this, but I delivered for you. And I think the most humbling thing you could do is just say, listen, I'm sorry, I should not have done it.
How are you going to win? I mean, why does no one vote? Why do they allow this to happen with such small numbers? And can you galvanize New Yorkers that might be horrified by the prospect of an anti-Semitic socialist mayor?
And that's such a good question. 9% of New Yorkers voted. 9%. 91%, they have yet to speak. 2.5
They
million.
never speak.
Yeah, no, I would challenge that just a little. 2.5 million Democrats did not vote. 1 million independents did not vote yet. We have yet to hear from 700,000 Republicans. I think what Madani did, he had an army already built. They were already on our college campuses, angry, frustrated, anti-American sentiments. They were already walking through our streets in the thousands, protesting. The day after Gaza took place on October 7th, we had tens of thousands on our streets. He had an army that was already angry by the presidential race. So he didn't have to recruit. He took that army and funneled that anger. And as I said, that when I saw the radicalization of our children on college campuses, I was sending out the warning sign. Listen, they're radicalizing our children. And we don't know really what all of that radicalization is coming from. So now, just as he radicalized and he mobilized people who were feeling the pain of affordability, the anger of college campuses, now we're going to mobilize 1 million new voters who woke up on the day after the election on the 25th and said, "Oh my God,
Right.
let's listen to what this guy is saying."
We should mention we have invited him and Andrew Cuomo on the broadcast. But let me ask you this, just straight up, because Joe made a reference to anti-Semitism, and I talked about how upset I was that he wouldn't condemn this phrase "globalized intifada." Do you believe he's an anti-Semite?
I think if he's not, he's truly misguided. You don't mock Hanukkah. You don't mock it. You do not ridicule. You respect all faiths, and everyone knows my basis of faith. You do not lift up a group as a rap artist that talks about an organization that supported Hamas. I think that there are actions that you're seeing that if he's not anti-Semitic, then clearly there are things he needs to re-examine what he's doing.
He said that he would arrest Bibi Netanyahu, by the way, who's in Washington today, if he was in New York City. What do you think the role of a mayor should be as it relates to international affairs?
Well, it's interesting. He said he would arrest the head of Israel, but he's not willing to arrest the 27 gang members that came to the city, Venezuelan gang members. He stated that he would block ICE from doing that, as though ICE is a criminal organization and not as they are a federal law enforcement organization. So he would arrest him, but he will open Rikers Island when after bail laws, you have the most dangerous people on Rikers Island, but he's okay with letting them out and go back into the communities that they harm. So I think he has a little mixed up. The role of the mayor is to protect the people of this city and to embrace international leaders to come here. There's a reason the United Nations is on the East River in our city, because this is the place where you come in and debate issues, not use your prosecutorial or arrest powers to harm people you disagree with politically.
It is a longer conversation. We want to thank the mayor for joining us. As we mentioned, we have asked and invited Andrew Cuomo to be here. As we have Mandami, we want to talk about all of these issues, given our audience and what's going on here. So thank you
This
for coming
city's
in.
going well. Strongest economy in the history. And I'm going to tell to all those business leaders with a little tension right now, trust me when I tell you, we're going to win.
Okay, Mr. Mayor, thank you.
All right, up next, the Fed in focus. We're going to talk about Jay Powell's fate with economics professor Ken Rogoff. Here's the futures ahead of the opening bell on Wall Street, the S&P and NASDAQ at new highs on Thursday. Ahead of Independence Day, Squawk Box is coming right back.
FCC+.
Markets live in the future, and I think markets may be pricing in that perhaps the president's right, that rates should be lower. I would say that the market's pricing in lower, I think it's 2 cuts for the rest of the year, and then the 2-year, the overnight and the 2-year are inverted, so maybe the market's just pricing in the economic fundamentals, and sure, is a different Fed chair is a kind of forward guidance, but as I reiterate to people all the time, it's not just the Fed chair, it's a committee.
That was Treasury Secretary Scott Bessent earlier on Squawk Box. It's no secret that President Trump is frustrated with Fed Chair Jay Powell over interest rates. That was the Secretary talking a little bit about what he would see happening in this scenario. Of course, he's been mentioned as a potential Fed Chair replacement. For more on this, we want to bring in Ken Rogoff. He's professor of economics at Harvard University. He's also the author of Our Dollar, Your Problem, an insider's view of 7 turbulent decades of global finance and the road ahead. And Ken, first of all, welcome. It's really great to see you here. You are a chess master, and you've spent some time gaming out this idea of a shadow Fed chairman. You're not a huge fan of it. What are the problems in the setup as you see it?
Well, I don't think having a shadow Fed chair who's going to be Fed chair is going to influence the Fed all that much. I think what Secretary Bessent said about a bit of forward guidance on what the chair might do, that's correct. But also, the shadow Fed chair is having to say at every moment what they would do. And if it's not in line with what Trump would do, then he can unnominate him. And so in a way, it paints the shadow Fed chair into a corner. Trump, I think, has said he wants the rate to brought down to 1%. I don't really see how that's consistent with the growth he foresees without having a lot of inflation in this economy. So it's very clever in a way. He's going to appoint the Fed chair. He won't control them. He's seen that with the Supreme Court justices, and he's trying to paint them into a corner. But I don't know that if he's wrong about the interest rates, that they really need to stay somewhat higher, that that's going to prove a good thing for the economy or for President Trump.
You thought up an interesting scenario that had not occurred to me, and that's what could happen potentially if there is a shadow Fed chair from within the Fed, and that being Jay Powell. If he doesn't step down, he may not be chairman, but if he doesn't give up his seat, what happens?
No, that is such a good point.
That's your point.
If Powell doesn't give up his seat, if Powell doesn't give up his seat and stays on the board, and Trump appoints someone who the rest of the board doesn't respect, I think if they respect them, they'll give them a lot of rope. They'll go along with them. But if they don't respect them, Powell will be the shadow chair from within the Fed, and the Fed chair may not control the board. Again, just a few minutes earlier, Secretary Bessent acknowledged that it's not all the Fed chair. You have to persuade the entire Open Market Committee.
All right, you've got a book that's out talking about, Our Dollar, Your Problem, and we did bring this up with Treasury Secretary as well, just the idea of the pressure the dollar has been under this year. You think that weakness will continue. Why?
Well, Trump inherited a very high dollar. And I'm looking at, given cost of living, other measures of how expensive it is in a country. We haven't seen the dollar this high since 2002, 1985. And both times the dollar, not overnight, but over a couple years, came down very far, I think 40% by some measures after 2002. So sure, it's down 10%. But it's still very high. I mean, ask somebody in Japan where they've had no inflation compared to us, and yet the yen has fallen a lot, how expensive it is in the States. And I think if you look around the world, that's still the case. So sure, Trump's actions have probably accelerated, a move that might have happened anyway, but the dollar is still high. So even if Harris were president, I think it would be coming down.
And the implication of that for the economy, for the markets?
Well, I think actually it's probably fine for the United States. We're interested in having the dollar still be the lingua franca, the reserve currency. My book argues that's being chipped away at, and there are other things Trump is doing. But having the dollar come down is fine. That's one place where I agree with the president's instincts.
What you are a little concerned about is what happens with Treasury yields. Even with the pressure to lower rates, you think that yields are more likely to go up than down from here. Why is that?
Well, we're looking at global borrowing, not just U.S. borrowing. Look at what's going on in Europe, Japan. China may need to do something to pull out of its doldrums. We're looking at the need for AI in many countries for, if not stopping climate change, dealing with climate change. The global fracturing, home shoring, there's a lot of pressures on investment. And I think the real underlying interest rates going up, and real interest rates have gone up dramatically the last couple of years. And I don't think anything the Fed chair can do is going to dramatically bring that down. At the same time, interest rates, aren't reflecting high inflation expectations. Maybe they're right. But that's one of the ways this mess can end. It could also end in financial repression, which pushes down interest rates. So maybe that's what's going on. But I would see the balance of risk to be interest rates at the long end rising. Certainly the Fed rate's more likely to go down than up. But at the long rate over the next couple of years, I think it's going to continue to go up.
Which is bad news for anybody who wants to buy a house with a 30-year mortgage, bad news for longer-term debt that we're taking on, and probably bad news for American taxpayers who have to pay off the debt.
Yeah, absolutely. I mean, we would like interest rates to stay down. Mind you, just to be clear, it was much better that this tax bill, this new big, beautiful bill got passed than if it didn't. That would have been a massive tax hike. It's not really that we had a tax cut. But the American voter hasn't really come around to the idea that we need to rein in the deficits. People like me may say it, Bob Rubin, some of you may say it, but I don't think the American voter's there yet. And until they are, and that might happen until we have an inflation crisis or something, I don't think we're gonna do it.
Okay. Professor Rogoff, thank you for joining us. We appreciate it.
Thank you for having me.
Up next, we've got a check on the markets ahead of the opening bell. Squawk Box will be right back.
Dr. Squawk. CoreWeave announcing plans to acquire Core Scientific in an all-stock deal valued at $9 billion. The deal giving CoreWeave control of the 1.3 gigawatts of data center power with room to expand. CoreWeave says the move will boost AI workload scale as well as improve operating efficiency. The stock, we should mention, down this morning but ran up last month after deal talks were first reported. So you're looking at Core Scientific off by 16%, but again, it had popped meaningfully before then.
Just trying to get a calculation of whether that's more or less than back to than a gigawatt. Is that more than what was in the?
Is it a gigawatt?
You say gigawatt, but in Back to the Future is a gigawatt, and I'm not sure whether that's more energy that you were just talking about or less than what was necessary.
A gigawatt or a gigawatt?
Gigawatt is actually not a real thing, unless you mispronounce gigawatt. But you didn't.
You call it a GIF, you call it a GIF.
Yeah, that's right.
GIF.
It's almost time to go. I was just, when you say gigawatt, don't you think of Dr. Brown and Michael J. Fox?
I don't, but some people do. Some people do.
Some strange people. There's where we are. We got to go. Make sure you join us tomorrow. Squawk in the Streets next.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanillo with Jim Cramer at Post 9 of the New York Stock Exchange. Faber has the morning off. Futures fairly steady, coming off all-time highs as we set up for a deadline on tariffs, looking for more deal announcements. Got some tech M&A, 10 years right around 436. Our roadmap begins with some investor confusion around trade as President Trump gets ready to send letters to a dozen countries about imposing tariffs beginning August 1. Shares of Tesla hitting the brakes after Elon Musk says he is forming a new political party. And the pressures on Powell to cut rates begins to ramp up. Senior Counselor for Trade and Manufacturing, Peter Navarro, is going to join us to discuss his scathing new op-ed in the Hill today. Let's begin, though, with the markets as we enter a new week at record highs. Jim, a lot of discussion about how many things are kind of working. The news flow is pretty steady. We're hitting some technical levels, obviously the highs.
Yeah, it's funny you say that. I was working this weekend. I've got an annual meeting for the club on Friday. And I posited that maybe things are good and they're working. And I said, look, I know there are people in this room who are anti-Trump. Some people are pro-Trump, of course. But the fact is that there are a lot of things that are indeed working. And we'll talk to Peter Navarro. But the question is, can you keep buying here? Can you keep buying when things are good? And when I go through the research this morning, people are just kind of saying, listen, it doesn't matter. You very positive piece about GE Vernova. Let me use that. And that's the company that makes gas turbines. Well, turbines. David got me calling them turbines. But when you look at that company, you say, all right, I missed that one clearly. And it's not too late. So I think that is the theme. It's not too late. I would like to see a pullback, but just because we're up a huge amount, we're very overbought. While you're away, I just said, it's buy. Right. But we haven't. A lot of things are going the president's way, and I don't see that in the press. It is.
Well, certainly the One Big Beautiful Bill is a huge accomplishment, even though there will be some winners and losers, which we'll talk about later. July, though, seasonally, average gains is like almost 2%.
We're coming in hot, but it may not matter. We've got a lot of companies that I think are going to report great numbers. We're led by different stocks. We're not led by Mag 7. We're led by the banks and a lot of industrials, and I kind of like that. The rally is as broad as you could get. I think at any time, if you look at any time in the last, say, decade, you would say, you know what? Okay, sure, maybe there should be a pullback, but I went in because the stocks that are selling at low multiples are going higher. The trade deals are going to, the BBB is rather remarkable about what it could, it's a fire hose. And I do think that we'll listen to Peter Navarro, but the trade deals are good.
Right.
So look, I can easily criticize, and I don't. Do I like Medicaid being cut? We can go into that. No, I don't. Because Medicaid's for people who are poor. And do I like the fact that I get a big tax break? Well, everyone wants a tax break, but would I forego it in order for people to have more health care? Kind of, yeah. I want this country to be rich.
Of course.
That's how I get rich, is have the country be rich. But I think that, Carl, yes, there's $3 trillion added. Let's say you take Secretary Bessent at his word, you get a nice rebate from the tariffs. So it's not easy to spitball. It's not easy to say, look, are you kidding me? Spitball meaning like spitball at the president.
Yes.
It's not easy to do that because there's a lot of things that are good.
That said, there's going to be some uncertainty this week regarding this tariff deadline. The
Yes.
president threatening some additional tariffs on BRICS-aligned nations of 10%. The Treasury Secretary got into some of that, talking trade with the gang on Squawk. Take a listen.
We are going to have several announcements in the next 48 hours. And Joe, I think what President Trump is concerned about is the quality of the deals, not the quantity. As you could imagine, as he started herding the cats and trying to get everyone across the finish line, when he said that there's a chance that countries could boomerang back to their April 2nd reciprocal tariff levels, we've had a lot of people change their tune in terms of negotiations. So my mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days.
So will the market mind if there's a paucity of deals, or do we now like the revenue?
I think that we like the revenue. I do think that man that we just listened to has developed a level of I would say, credibility that I have not seen among Treasury secretaries, including Secretary Yellen. I think he says things, now maybe it is because he was in the, but there was one moment where he just said, look, I traded, a lot of my money was made in currencies, and it was, a lot of people feel the dollar speaking. He said, no, natural course, and I'm listening to him and I'm saying, hey, yeah, now he traded a lot, natural course. The man is totally believable. I struggle with him. I mean, when I say I struggle with him, I mean, like I struggle to find fault. I do. I mean, I'm listening to Bess and I'm saying,
you're trying.
He's a smart guy. Look, there are people I can get, the people who hate Trump, right? I defy you to listen to that man and think that he is anything other than a complete pro. He's a pro.
It doesn't sound like you would favor him moving to the Fed, for example.
He can do whatever the heck he wants. I don't care.
Really?
Yeah. Oh no. I think that this is a guy. When I listen to him, I feel very relieved that we have a steady hand on the tiller. Yes, I know that the president said, let's 10% on BRICS. I think that this is a man who is considered, and I remember speaking to Secretary Mnuchin at Treasury, and there were a lot of times when you wanted to disagree with Trump. He was very forceful. I think that Bessent speaks for Trump in a way that makes me feel like, hey, wait a second. Maybe those countries have gotten away. Enough with those countries. They can pay. At the same time, obviously, Fortune did a study that says that this is three times more punishing than Smoot-Hawley, which a lot of people feel has led us into depression. But when he says his email box is full, and then it was questioned about where is it really?
Yes.
It made me think, you know what? Do I really want to blow out of stocks if Bessent has got something under, up his sleeve? Because he has the credibility for me to think he does.
Right. That said, Jim, I mean, we did hear from von der Leyen of the EU, who spoke to the president yesterday, and they reiterate they're trying to get this done by the 9th, but they say tariffs cause pain. And do we no longer think that's the case?
No, tariffs cause pain, but they've had the run of the joint. So's Japan. And I feel like many Americans, when you see how much they've gotten versus us, maybe it's time. Now, I worry, after speaking to Andy Jassy last week from Amazon, if all these jobs came our way, we would have job inflation. But you know what? Maybe that's a high quality issue. I want them to build things here. There are pockets of this country that could use the raising of tariff and then bring jobs here. Remember Trump has forgotten when he first started. His first statements were, okay, listen, when you raise tariffs, what happens is the other country caves and builds, but that's when he used to talk about China. He's gotten off that message. Instead, it always seems very mercurial. But that was his message, and it was a message that America understood, which is that they raised tariffs, so we moved plants there. So now we're going to raise tariffs and they'll move plants here, is actually something that resonates, I think. And Bessent isn't using that analysis either. But it is one that resonates with the American people, and I think if they go back to that message, it'll work.
Really? And you think that the consumer will be able to look past whatever price effect we do get in the next couple quarters?
I do think that there's enough evidence that says that it's a one-time only, that you could say, you know, it might be okay. That does not mean that I think that Powell's wrong. I can't find the risk to Powell's prudent attitude, because the unemployment rate's fantastic. Is inflation right? Well, yeah, inflation's right, but my problem here is that, you know, we're going to get inflation from this. Now, if Peter Navarro says there's not going to be inflation, then the conversation's not going to go as well. And I don't want a contested thing against someone I've known for a very long time. I want conviviality. If conviviality is too much to ask, then I may turn to you and say, you know, that was a really good interview, but the interview might, people at home may think it wasn't concluded.
Well, speaking of that, when we come back, we are going to talk to White House Senior Counselor for Trade and Manufacturing, Peter Navarro's got a new op-ed in The Hill where he slams the Fed chair. We'll get into that, of course, and the deadlines coming up this week. Futures, meantime, relatively steady, obviously south of the flat line. Squawk in the Streets back in a moment.
Calm.
Markets live in the future, and I think markets may be pricing in that perhaps the president's right, that rates should be lower. I would say that the market's pricing in lower, I think it's 2 cuts for the rest of the year, and then the 2-year, the overnight and the 2-year are inverted. So maybe the market's just pricing in the economic fundamentals, and sure, is a different Fed chair is a kind of forward guidance, but as I reiterate to people all the time, it's not just the Fed chair, it's a committee.
Well, there it was. Treasury Secretary Scott Bessent last hour on Squawk. The White House keeping up the pressure on Fed Chair Powell, but in a very convivial way, I think, including this morning, with one advisor penning an op-ed that goes as far as to say that Powell could be the worst Fed chair in history. I question the hyperbole, Carl, but you never know. Because joining us now to explain as well as share the latest on trade talks, Senior Counsel for Trade and Manufacturing, always a strong voice for the President, Peter Navarro. All right, Peter, I'm going to give you the
Great
floor
pleasure
because
to
it's
be
a...
with you, Jim.
Thank
Great
you.
pleasure to be with you, buddy.
And the same, and you know that. And I feel
Yes.
that way. And when I read your piece, I said, okay, here's a person that has strong conviction on Fed Chair Powell, and I'm going to give you the floor to describe your view.
Yeah, well, let's start with what the stakes are. If he's too high at the Fed, let's say it's like a half point now too high. That's like anywhere from a quarter to a half a point of GDP growth that we're going to lose. In other words, we're going to grow more slowly. It's like $100 billion that costs our economy, and then when you trickle it down to the interest rates that people pay, that's about $100 billion in added debt because we're refinancing debt. So it's not small potatoes. Now, in terms of the argument, let's see if we can agree on two things, right? I claim in the Hill piece that Powell has made three major blunders. Let's see, Jim, if we can agree on the first two. When we were in the first term with President Donald Trump, and we had the tariffs and the tax bills and the whole Trump-nomics going on, Powell raised rates too high. And by the Fed's own analysis, that cost us a lot of growth. So let's see if we can agree on that. And then when he was serving the Biden regime so well in a partisan way, in my judgment, he didn't raise rates fast enough. He let them get out of control. He also kept his mouth shut. Well, the Democrat Congress was passing these massive expenditure inflationary bills, and he was too late Powell then, he was too early Powell in the first term. Can we agree, Jim, that those blunders happened? Is there any doubt that Powell was wrong twice in the earlier years?
I'm going to say no. I think there's a lot of time in between that he did things right. I totally agree on 2018. Was very against that. When it comes to what happened in terms of transitory or not, what I think it was an honest mistake. I will not give you that it was partisan. I will just say it's an honest mistake, but I think you
But it was a mistake.
in my judgment.
But it
You
was
said
a
in my
mistake.
judgment.
Okay.
Yes.
So
it was a
he's
mistake.
made two big mistakes so far, and now the third one is, the question is, Jim, which is it's like rates should be lower. The markets are telling us all of that. Powell is doing the same thing he did with the first term of Donald Trump. He doesn't understand Trump-nomics. He doesn't understand the supply side aspects of tax cuts and deregulation. He doesn't understand the importance of strategic energy dominance and the president's ability to dramatically lower oil prices. And he doesn't have a clue about tariffs, because in the first term, very clearly, we raised tariffs and there was no inflation. Most of the tariffs got eaten by the foreign countries as we expected.
Well,
Same
Peter, but
thing's
we know
happening
that
again.
These are not
so
similar
why is he
tariffs.
waiting?
These are much bigger tariffs. We know that. We have to.
We have seen absolutely no pass-through of tariffs. It's just not in the data, Jim. And by the way, what's wrong with a more flexible Fed? Why not lower rates and see what happens? What's the big deal?
Because from September through December of last year, they cut rates 4 times, and the long rates went up dramatically, hurting the mortgage rates. We don't want that to happen.
Well, that happened. Okay. Why did he cut rates? He was trying to get Biden or Harris elected. Come on.
Well, we want
Come
to
on.
just,
That's the partisan aspect of this. And by the way, I mean, look, whether he's let's look at the history. I think the Hill piece is interesting because they go back, talk about how Arthur Burns helped Nixon get elected with easy money. I talked about how Greenspan, and you and I were there, we were in the trenches when he raised rates and killed off the dot-com boom, and we had all that. That was a mistake. We saw Bernanke, slow to understand systemic risk, and he let something which could have been manageable get out of control. And look, Jim, there's no question that this stagflation that emerged during the Biden years was not just the product of the Democrats. See the picture behind me, that Capitol Hill, where all that bad stuff happened, the Inflation Reduction Act and all of that. That only happens, Jim, if the Fed accommodates that. You go back to William McChesney Martin. I think McChesney Martin and Volcker are the two best Fed chairs. McChesney Martin, when Lyndon Johnson was prosecuting the Vietnam War and wouldn't trade off guns for butter, he said, no, I'm taking away the punch bowl. That's not going to happen. Powell could have spoken up. He should have seen the inflation that just quickly got out of control that we're now tamping back down. So I'm just saying, Jim, he's a lawyer, not an economist, which is an anomaly. The two worst Fed chairs we've had in recent memory were G. William Miller, who was also a lawyer, and now Powell. So I think the case against him, and I would say where Scott Besson, the little clip you played, it's like, remember, Powell is just part of the board, right? And so I'm in some sense appealing to the board. It's like, come on, let's get with the program.
I want to let Carl in here because I think you've made your point. I think you made your point of where you feel. I disagree with the ranking, but Carl, there are other issues.
While we do have you, I've always wanted to ask you for the last 90 days about your comment on April 7th when you said 90 deals were possible in 90 days. We're almost up, and I just wonder, was your thinking at the time that it really was an aspirational number, or are you kind of disappointed in 2 for now?
I'm happy with the progress we've had because every country that we run a major deficit with is fully engaged. I think what we're learning from the negotiations is simply, Carl, how difficult it is for these countries to give up the advantage they have over us. And so therein lies the tale. I think the negotiations are proceeding well. And by the way, the tariff revenues are coming in and really helping this country. And we're able now to get trillions of dollars of investment here to build up our factories and jobs. The tariff revenues are coming in, which help pay for the big, beautiful bill. And I'm very pleased with the direction we're going. We've got Howard Lutnick, Jameson Greer, Scott Besson all engaged in these deals. And the president, of course, at the top of this.
They're your team. I want to go back just for a second. Why, if you're Jay Powell, why not wait to see a couple quarters if there is inflation? What's that going to do to the economy? You've got an incredibly strong economy, Peter. It's remarkable.
So we've already had that argument. We've waited like 2 quarters. As Scott Besson said, we're behind.
The employment's terrific.
You asked me a direct question. I'm going to give you the answer.
Fair enough.
The answer is simple.
Fair enough.
A 50 basis point lag. If we're up 50 basis points too high, that's a ton of money. That's going to be a half a point of GDP growth slower than we otherwise could and should be. And remember, when you have slower growth, Jim, you have less tax revenues and more debt and deficit, and then you got to finance the whole thing. All these synergies that work with the Trumpnomics, Powell is not allowing to happen, and that's the tragedy here. So he's costing homeowners on their mortgages. He's costing Americans with their credit card debt. He's costing us in terms of our national debt growing. So there's a real opportunity cost
We're
for
not
him
going to disagree. There are some
misreading
opportunity
this.
costs. But you know, I do want to know, as the trade person, I'm not simulating for trade. We've got some things that disturb me. You have a great American company that arguably has put 2.9 million people to work in our country, which is Apple. It seems like no matter where Apple goes, we find that they have to be taxed high. And I know that they're committing $550 billion to the country, and unless you directly contest Tim Cook's honor, what is enough for you?
Apple, look, Jim, going back to the first Trump term, Tim Cook has continually asked you for more time in order to move his factories out of China. I mean, it's the longest running soap opera in Silicon Valley. And my problem with Tim Cook is he never takes the steps to actually do that. And with all these new advanced manufacturing techniques and the way things are moving with AI and things like that, it's inconceivable to me that Tim Cook could not produce his iPhones elsewhere around the world and in this country.
But India
was
something you wanted.
Come on, it's a technological
You wanted
problem.
India, you wanted Vietnam. suddenly these are not easy decisions. You wanted us to leave China. Apple is trying very hard. They're a huge manufacturer. How about something like this? Apple's a great company, and they're our gem of our country. And what we're going to do is we're going to respect that they moved to India when it comes to us. We sure wish they would do more, but they're doing $550 billion away from that. What more do we need from this great American company?
Jim, let's simulate that. I cannot, you and I cannot solve Apple's problems today on this show. What I'm really concerned about is what's going on with the Federal Reserve today.
All right. Well, I did want to ask one more thing. We have to see Elon Musk. Obviously, he lost some things in the big bad bill. He has not been as complimentary of you. I know you too long to repeat the things that he said because I don't like that level of discourse, but obviously you must have a feeling about someone who does not think that you're as intelligent as I've known you for many years and has really, I think, used that kind of derision that I find to be not part of the discourse. What do you say back to it?
Well, here's what I would say about Elon in terms of the big, beautiful bill, which is, I think, where the discourse should stay focused on. If you look at the analytics of this Congressional Budget Office, where they come up with a $2 trillion increase in the debt, it's the same kind of mistake they made that Jay Powell made in the first term. It's like when they scored the bill in 2018, they scored it wrong. They were a point off of GDP growth, and we got all sorts of revenues instead. So when you accurately score the bill, the big beautiful bill, you get another point of GDP growth, which is a couple of $1 trillion, so the debt comes down. And then when you accurately score the tariff revenues, you get another couple of $1 trillion, and you move from a $5 trillion, it's a $5 trillion thing. You go from a $2 to $3 trillion deficit to a $2 to $3 trillion surplus. And it boggles my mind, Jim, that not enough people are talking about that in the legacy media. Because that's the number.
What should not boggle my mind is that people should listen to you and realize that you did not come back with some sort of gratuitous, capricious statement about Elon Musk, and I applaud you. You are the scholar and gentleman that I've known for 50 years. Thank you so much to Peter Navarro.
Always a pleasure to be with you and Carl.
Thank you.
Take care.
Thanks, Peter. As we go to break, take a look at the pre-market. Futures just south of the flat line. Look into some movers this morning. Got some M&A to look at. There's Oracle, there's Amazon. Of course, there is Tesla. In a minute.
So nice. Okay. June, July. What's this? What is that? Tire. Well, well. We got less than a minute. Gosh. Well, blood test came back great. What the hell happened to me there? Now, what is this here?
Let's get straight to the opening bell this morning in the CBC Real-Time Exchange. At the big board, it's code.
Big breakout right at open. Fallen wedge. Breakout. Well, what the heck is wrong with this? Talk about sensitive. Okay, we got a little pullback here, retest. SPY. I'm not very bullish, but we're going to see if we can get a double bottom here in SPY. God darn, these fuckers are expensive. Oh, I'm looking at July 31st. That could make some sense. We got some volume. 624. I'm not snotting around. U.S. dollar sinks. The economist warns 10% slide could spark new inflation spike. I think these people are really, really, really idiots. To me, the market's way overbought anyway. So we got the 624s. I'm watching them real close right here. 3 black crows off the bottom of the orb with a double bottom to boot. And they're at 84 cents. And that's the SPX calls, or SPY. .78 cents. We're at 85 right now. 86. Good morning, Randy. Back to 78 here. Blake. $89. 91, baby. Profit. $96, baby. Well. Good morning, Richard. To the 200 EMA for an exit idea. Jim, did you say 200 EMA? Yes, I did. Yeah, I did, Ethel. She was over there hanging out at the tomatoes, and all of a sudden I hollered and I said, Ethel, get your clothes on. Hey, little sister, what is going on? White wedding, yeah. May a circle be in blue. Yeah, I'm feeling better. I'm singing again. Now what the heck did I just do? What did I just do? Okay, I think I deleted my little chart. SPX looks pretty good too. Back to 93 cents, 94 again. La 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 la. Go get my coffee and I'll be right back. We're not going to listen to you people today. Kind of had a little breakout, pullback on some trades. Meta had that sell-off last week. They were pumping this one before the sell-off. It didn't pull back much, though. What's this here? Oh, this is a... Let's move this over here. Detach. So that's the 1 minute. 5, 10, 15 minutes. We've been open for 15 minutes. Okay, watch the SPY again. We're coming down to a double bottom out of a snake. 3 black crows. So watch the SPY again. Oh yeah, prepare ye in the name of the Lord. What kind of day are we going to have? 75 cents sounds good to me. $0.75. This is a little risky. Because it's kind of making up its mind. It's a double bottom today. We got a tweezer bottom on a double bottom. And I got these at 75 cents. Could be some risk here. I'm just not going to get too crazy on it. Okay. There's 81. Break it. It's got a higher low. We just broke the triple bottom. Yeehaw! Oh yeah. I got to talk to a star the other day and I didn't even know it. Come on. No, 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 no. Get out if you want, 88 cents. $93. Bam, baby, the 200. Knock on wood. Out at 99 cents, double top. Huh. Three minutes at a resistance, 1 minute's at a resistance, and head and shoulders on a 2 minute. On /ES. So we've been in Darvis box today. Northwest, another health insurer, has issued a profit warning. Well, is that good or bad? That's the question. I'm here. Okay, looks to me like Elon has pissed off a lot of people, including me. I'm starting to get a little bit annoyed with the guy. And I've never said that. Nike's down to 76, 77. Mr. at 404, even. Coin up $4.57. Boeing at 216. So Friday I was down at the IRS. They wanted me to go down there, and I'm surprised I didn't put the 2 to 2 together. So I had Billy Long was down there. He got promoted to the IRS. A Republican. But he was in there and I didn't say hi to him. I know him. But I didn't it didn't hit me until today. I said, damn, that was Billy Long. I'm gonna go get me some coffee, and I got all my invoices out. Man, last night was just one of them nights. Where you can go in there sometimes and you go, God, what the hell hit? Babylon. I gotta look at my blood test. Oh. Tesla double top. Number up back. Tesla just broke a new high. Not a new high, but yeah, I guess for the day. AMD starting to squeeze. Now they could start saying they're overbought. We got the Nvidia at the 200 on the 1 minute. We got Apple on the 1 minute off the 200. We got a squeeze on the AMD, and Meta is at double top. Day high. Okay. Take off my shoes. Get my coffee. Puss. Ugh. Well, I got lucky when I traded you. All this running around. Mm-hmm. See, the market, since we have the retail traders in here now, it really put a sprocket wrench in the spokes when it comes to the fat cats, because they had total control of the market. Now they don't. They still do, but not as much. Before retail traders sell in May and go away was the norm. People would take 3-month vacations. Now that the retail trader is in, things have kind of changed for the fat cats. They don't control the market like they still do, but they don't control it like they used to, where all they had to do was, we used to have parties back in high school, and we'd tell maybe 10 people at the most. But we had it down to where we that we didn't have to tell too many people, because if we told too many people, we'd have too big of a crowd. You know, it wasn't nothing to see 200 or 300 people at one of our parties back in high school. And I moved out when I was a senior. And got this house. But that's the way Wall Street was run. They go in the back door and 5 or 6 people would make the decision if we're overbought or if we're oversold or. Watching /ES, see if it wants to reverse here. Oh, looks like we pulled back again. Okay. We will stick. I might go 623 this time. Spy, prepare ye in the name of the Lord. $6.23. $0.94 and some risk. This is my third trade of the day. I got these at 94 cents. Randy sees a triple bottom megaphone. It's exactly what it is. So we need to hold. God, what happened here? .87 and 94. Back at 95 cents. Let's get it, Randy. Identifying restaurants that are accused of shrimp fraud? Really? Let's go. Rennie, did you get in? We're at 102. Mustang Bio are trading higher after the company was granted FDA orphan drug designation for MB101. It's up 350%. God, 82 bodies found in that flash flood. The calls are at 104. No 6. It's that. The sister body's going on. We're at resistance. We're at 110. I'm up 400 on this trade. Be right back. 108, come on! This could be resistance here. 112. Can you do a 1, 2, 3 triple top for Bobo? I asked you, can you do a triple top break? The crowd's wild here at the sports arena today. We're now at 114. I asked you, can you do a triple top? Oh. Good morning, Mannequin. Good morning, Robert. Jimmy just hitting at 119. Time to take profit. My third trade of the day. You have to leave and get your oil changed. Mine's due here in 300 miles. Well, shoot. Back down to 102. Thank you, M. Bartow. Because of your great credit history, you've been pre-approved for $50,000. For what? 50 grand. Fixed rate today. God. And at $50,000, I'll pay $2,998 in financial charges. Hey, we're coming back down again. This is the third scalp. Oh. Carl, your way is the only way. It looks like she's trying to set up again here. We got tweezer bottom on /ES on the 1 minute. We got a doji and a double tweezer bottom with a head and shoulders. Right there. And these are at 85 cents. We're now at 81 and down $40. Yes, it is.
Forward a bit in Wells Fargo shares. And as we know, the big banks surprised to the upside pretty collectively last quarter, as it did feel like the tone was maybe a bit more pessimistic than what the banks actually sort of were able to report, which is definitely good news when you're able to surprise to the upside. But then that does set the stage now with interest rates still remaining in question and the Fed's next move remaining in question. I think that puts the banks all at risk for perhaps maybe some disappointment, just because they all have traded so significantly to the upside over the past quarter or so.
Yeah, absolutely. We need some more clarity on that. Bit of a wait and see. What are you seeing on the chart there, Rick?
Yes, not much of a reaction today, despite
Like what happened to Caroline.
Here we can see that price really quite near its highs, traveling upward off of our tariff news related lows that we established here near 60, a steady climb for the most part here with a bit of consolidation in this range. We could see that price moves sideways between about 72, our light green line, which represents the beginning of this old gap and a repeated stopping point for price, as well as the 77 level. That was more of the floor of another previous range. So it came back into prominence here once again as the old support became new resistance. Eventually, we did break through it. We also broke above the 81.50 level that represented those old highs. Now, the bulls have stopped just short of 84. We'll have to see if they can continue this upward trajectory here. RSI perhaps showing a little bit of a slowdown in momentum. Our short-term, very steep green trend line has been broken here, but RSI remains in the overbought area, typically regarded as a sign of strength to come in a trending market such as this one here. So look for any kind of bearish divergence in the RSI for any clues of an impending breakdown. If we were to look at our volume profile study, we can see here that this area right around 73, our thick red line, that's where all the heavy trading is. So this could be a key supportive area to watch going forward. We can also see that our linear regression line, our line of best fit, comes in at around 79.31. Traders use that as an idea of fair value. So that could be another potentially supportive area to the upside. Plus one standard deviation channel comes in just below 88. That could be a resistance area.
Thank you, Rick. And getting back to Jenny, we've got Texas Instruments with Citi now bullish on the stock. Talk us through that.
So Citi today actually, raising its price target on Texas Instruments to 260 from 220 with a buy rating on shares as part of the second quarter earnings preview on the broader semiconductor group. And they said they're increasing their estimates, saying prior assumptions assume that tariffs would drive a slowdown to the sector, which does not appear to be happening. They do expect a sector upturn driven by solid demand and inventory management and replenishment. They do see the most upside, though, notably here in Microchip and Texas Instruments. And this name definitely more split amongst analysts, as there are 39 analysts covering this name according to FactSet. 12 buys, 23 holds, but 4 underperforms. And the average price target right now perhaps doesn't reflect some of this optimism mentioned by the analysts today. Average price target is only 184, so that would actually imply about 15% downside, while the street high is around 248. So there's still definitely some optimism there, but the concern of Texas Instruments is, I think, that it trades at a forward PE right now of 38 times, so it's gotten relatively costly. I know that semiconductors often do trade with these lofty multiples, but that does mean that we need to see growth from them moving forward. And if you look at just the last 5-year returns in this name for earnings and revenue, we've underperformed the broader tech and semiconductor sector in Texas Instruments. So that's perhaps why this analyst is becoming more favorable on a name that, frankly, yes, it has risen on the year by about 8%, but also then still does remain below the sector average right now. So it's underperformed, but also seen a decent recovery. And I know there's the broad wave of thinking that the big, beautiful bill will help incentivize further investment in some of these semiconductor names, as it will increase the various, what we're seeing from as far as tariffs. And we know that bodes well for companies here based in the U.S., but it does seem at least like we understand some of the risk of these trade headlines, and that's now being priced in, at least per city today. So optimism, yes, but this is a name that has underperformed the broader sector.
Yeah, and obviously trading down today in line with the broader market. But Rick, take us through the technicals on this one.
Perhaps down a bit today here, but really a sharp rally, 53% gains from that low point that we just discussed. April, the low point for so very many stocks due to the tariff news. We bottomed out just 5 cents below 140. From there, a big push back to the upside, somewhat propelled by earnings. We had a couple gaps up. But what stood out to me about our recent rally is the periods of where you might find the bull pennant, bull flag type patterns here, just kind of repeating. A big jump to the upside, a sideways to downward consolidation, then another push above the initial highs. So, I'm kind of wondering, will we see a similar pattern play out once again as price approaches these old highs here, 220.39, our previous high watermark. For now, price is holding on above 205, our green line that represents these old highs. You can see that was our breakout point that has been subsequently retested. So 205 to the downside, about 220 to the upside would be some very notable points to watch here. As I was saying last time, be on the lookout for bearish divergence, but for now, RSI is showing momentum is cooperating for the most part, making new relative highs along with price and remaining in that overbought area. So that's the thing to look for. Another thing for a potential breakdown would be crossing back below that 70 threshold or invalidating our green trend line as price starts to wane a little bit. So for now, though, we can see the 200 level, 200, 201. That's our volume profile point of control. So lining up fairly well with that 205 level. That's a key supportive area. Beyond that, we could see that we have a confluence of some moving averages and greater volume here near about 188. To the upside, though, if we did break those highs near 220, our +3 standard deviation channel comes in right below 225, so that could be another area to monitor.
Okay, a good overview of Texas Instruments. And switching gears now, lastly, Jenny, Autodesk are getting upgraded.
Without any sense.
Yes, further upside in this name as well from at least the sell side today, as we did see D.A. Davidson upgrade shares to
there we go, baby.
Neutral with a raised price target of 375 from 305. So some nice upside is foreseen from this analyst. They do now believe the business is on a path to achieve top decile performance, given the combination of demonstrated success growth in their businesses like ACC as well as Fusion, as well as some of these organizational
Come on, break out.
that do support further stronger execution, they believe, for Autodesk. Transaction model changes will create the significant noise around margins, but they still believe that Autodesk has room to drive some efficiencies supportive of this substantial profit
hike.
So further upside here that they definitely see for Autodesk, a name that, again, has underperformed this year as we've risen about 7% year to date, pulling back about 2.7% from recent highs, while also remaining relatively elevated from lows, about 42 and almost 43% from those recent lows, and still actually is higher on the year, up about 28% on a 12-month basis. So a lot to like from some of the improvement story of Autodesk, but again, finding some of these opportunities in tech names that have underperformed just historically on the year seemingly is the theme of some of our analyst coverage today.
And a little bright spot in what is otherwise a down market today. Thanks, Jenny. And what is the chart telling you, Rick, about this one?
Yes, another one that's seen a pretty strong recovery here off of these April low points. This wasn't necessarily our 52-week low. We did hold on at a previous low from all the way back here near about 223 was that intraday mark. But from there, we have rallied. We have taken out our downward sloping trend line that began with those highs, our blue dashed line here. Then price moved sideways for in a pronounced narrow range for a couple of months here between about 293 to 300 or so, this very narrow range, this period of low volatility. Oftentimes, a situation like this can be a precursor to high volatility. When one of these two increasingly entrenched boundaries does get broken, now we're seeing the push above that level. We are starting to climb once again. We are holding on above these old double top highs near about 312. White short-term upward trend line still in play. RSI re-entering the overbought area after invalidating that downward sloping trend line as well. So things could be shaping up to be a fairly interesting week for this name here. If we were to look at our other studies, we can see volume profile matches up with our range bound area near about 297 or so, also quite close to our linear regression line. So this could be a support area. To the upside, the +1 channel, 321, the old highs, 326, 327. Those are the obvious places the bulls would want to break above.
Awesome stuff, Rick and Jenny. Really appreciate it. Thank you so much for that. Really good to see both of you. After the break, we will discuss the day thus far with our market meetup panel. That's next on Morning Trade Line.
I think I'm gonna go down and have a solid meal today. Let's go.
What's up, Coral Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab.
Schwab.
A modern approach to wealth management.
Come on, we're waiting. I'm down $50. Do 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 do. Might double down on these two.
Whether you're
an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages,
and being in the now,
and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Okay, I need to move around here.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live. Time now for the Market Meetup panel. Joining us now is Senior Markets Correspondent George Tillis and Joe Mazzola, Director Trading Services at Charles Schwab. I suppose I'll start with you, Joe. I mean, what do you make of today's market action, given all the headlines flurry of those that we got out over the weekend? I mean, is what we're seeing this morning pretty justified given some of the uncertainty?
Yes and no. I would say yes in that we continue to see equity inflows, whether it's at the ETF level or whether it's at the single stock level. There is a bullish sentiment that's underlying this move in the market. Yes, we're down a little bit today, but I think overall what we've seen in the last couple of weeks is just a continued move up, setting all-time highs. Where I think it might not be justified is I just think that the market is
You're invited to a free dinner.
Past the radar a little bit in terms of the way it's looking at volatility. We're really seeing that options markets aren't pricing in big moves. Given all of the news that's coming up in the next 30 days, whether that is the expiry of the new extension to August 1st, whether that's some of the inflation data that we get next week, whether that's the next FOMC meeting, we're looking at the VIX and we're looking at some of the skews on the options, not pricing in much downside hedging at all. So it really is a calm market that's just kind of expecting a grind higher.
Yeah, and I suppose, on the tariff front, you could look at it from so many angles, or whether this is goalpost shifting, feet dragging, cans being kicked down roads. George, I want to get your take on all of this. I mean, how are you assessing what we're seeing in the market today, given, of course, what Joe was saying with regards to a bit of a lack of a catalyst? Obviously, we've got earnings around the corner, a bit some economic data light this week. So how are you assessing things?
Well, I think all else equal, outside of maybe some other additional headline risk, we may end up having just a quiet week, absent, like you mentioned, just an oh-my-go catalyst. Nothing really from an earnings standpoint to make note of. Economic data, we've got some FOMC minutes coming out on Wednesday. We have Treasury auctions on Thursday, but I think that fears about, the budgets and, of course, the big, beautiful bill.
That ain't working right.
The higher rates, that seems to have been overblown. With rates essentially just in a trading range, if you look at the last 3 years, around between 5 on the high side and about 3.75 on the low for the 10 years. So not really big movement in that regard. I think the markets too.
I'm going to have to add here for sure.
If you look at the volatility term structure, Joe alluded to the 30-day VIX. If you look at the 3-month VIX and you compare that to the 9-day volatility, we are seeing some elevated 9-day volatility, but all else equal, the next 3 months, volatility term structure is still in contango. We're seeing a little bit of a move higher in the 30-day VIX or the traditional VIX, as everyone's used to. But there may be some headline risk going on that may manifest into short-term volatility spikes. I think there's a little bit of complacency, to be honest with you. This market seems to be getting a little bit exhausted, but it doesn't mean it can't just grind higher slowly in a low volatility environment. So be mindful of that. But I think some of the sector rotation is where there's opportunities going forward, and even stock-specific opportunities. I've noticed some of the China-exposed U.S. companies like Wynn Resorts. That stock seems to be hitting about a 52-week higher, getting close to. Nike, for instance, is trending to trending higher as well, quietly moving to the upside. So I think there's opportunities in rotational aspects of the equity space. Industrials also from a defense spending standpoint moving higher. There's some pickup in materials as well. Some of the underperforming sectors over the past 6 months.
Yeah, that's certainly interesting given the China-exposed name, given all the bets and expectations of stimulus certainly coming from the world's second biggest economy. I do want to pick up on that word you mentioned, though, George, and that is complacency. It was something I was talking to Liz Ann about a couple of weeks ago. Joe, let's bring you back into the conversation because it seems like the narrative has switched from somewhat durability, resilience in these markets to a bit of complacency. Is this a bit of a risk? I mean, you know, I was listening to Besant this morning, trying to sort of clarify some of the commentary out over the weekend with regards to the tariffs. You know, sort of seems like they're trying to buy themselves more time to hammer out some of these negotiations around these deals. He was talking about how it's natural for fluctuations in currencies, which, as my last guest pointed out, is perhaps code for it's going down. So, I mean, what do you make of all of this?
Well, I mean, if you look at the multiple countries, whether it's Japan, South Korea, India, others that are supposedly coming to the table right now to secure some trade deals, that's the dialogue that we're hearing coming out from Treasury Secretary Besant, and then Trump sending the letters out to 12 to 15 countries. So they're supposedly motivated to get things done. I would say, one of the reasons I think there is some complacency, and maybe this moves away from some of the macro, maybe a little bit more to the micro. I know that you had mentioned we kick off earnings next week. I think one thing that's
I got to add on here to these.
Whether it's Q2, Q3, or Q4 earnings, expectations are really, really low, and they have not ticked up. And so if you look at the hurdle that companies are going to have to beat for Q2, and remember, Q2 is not going to incorporate that much in terms of tariffs. If you look at maybe the effective tariff rate worldwide, it's maybe around 4 or 5%. So we're not even close to the potential 10 to 15% that could be kicking in the next month or so. And so a lot of these names that really start next week with the financials, they're probably going to do very well, especially the financials given the steepening of the yield curve. And with expectations being as low as they are, that could give an additional leg up to the market. What'll be interesting to me, and this kind of goes back to that complacency theme, is are we going to start to see analysts start to move up those projections for Q3 and Q4? Because we haven't seen that yet. Basically, they've been kind of stuck in this downshift, really based on what the tariffs could mean. But, if we start to hear positive guidance from the companies, we start to see analysts maybe revise to the upside, that could cause a little bit of trepidation going into Q3, Q4, because now that hurdle rate's a lot lower.
Okay, focusing on the micro. Gentlemen, it's been an absolute pleasure. Thank you so much for joining me on today's show. Thanks for joining us on Morning Trade Live, Trading 360 with Diane King.
Right about now, I'm going to give this a shot. God, come on, phone.
Schwab Bank
0.55 is my add-on.
Built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide. No overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Let's get it. Oh, no, that's wrong.
Hey, Dad.
question for you.
How come Grandpa don't sleep with me no more?
First start investing.
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me.
The only good thing about this commercial, I hate to say it, is when they changed that music and put that upbeat music in there. I mean, that, besides having to hear her about, why can't I sleep with Grandpa anymore? Dad, I miss my times with Grandpa in the middle of the night. What happened? This one might be one of them things where I get out even. We've got a triple bottom here, resistance. See, looking for the old resistance right there. So somewhere right in here. Unless it decides to break on up and hit the 63 or the 50. Nicole, can I come work with you? Diane, where is Caroline?
Close of last week. Again, it was a holiday shortened week last week, but again, the focus right now on tariffs. Coming up in today's show, in our 360 Spotlight, we'll dive into the state of the market after the S&P 500 and NASDAQ 100 hit those all-time highs. Where do we go from here? Today's disruptor is Autodesk after G.A. Davison upgraded shares to a buy. And in our 360 round, we'll discuss Apple and what's next for its AI offerings. What's next for Apple in general? We've got different sides of the coin perspective on that one. Let's take a quick check on where the broad market action again. Once again, you've got the S&P 500 coming off of those records that we saw at the close of last week, down by a little bit more than 0.5%, despite indications from the Trump administration that there are new trade deals coming. But at the same time, you have deadlines in front of us, July 9th, August 1st. First, which one matters more and what will we hear by then and before then? You also have President Trump sounding off, saying that there will be letters going out with regard to tariffs today at noon Eastern. We've got the NASDAQ 100 pulling back as well after hitting those records at close of last week. We've got the NASDAQ 100 off by 0.75% right now. Down 0.5%, matching the move on a percent basis that we're seeing in the S&P 500, down 245 points. Over in the small caps, Russell 2000 down by just shy of 0.9%, the biggest laggard when we're looking at the benchmarks there. Taking a look at other asset classes, yield on the 10-year up by 4 basis points right now. We've got 10-year auction coming up this week. We'll be paying key attention to what demand looks like there. Dollar right now a little bit better, but still, dollar's really been in this range, sitting near 3-year lows for some time now. Approaching 97 against a basket of currencies. Gold a little off, even though we've got risk off today. Gold under some pressure. Gold down by just shy of 0.5% there. Crude oil a little bit higher right now, up by 0.75%. Above $67 a barrel for West Texas Intermediate. We've got Bitcoin pulling back, down 1.5%.
per se below 109,000.
God darn it.
Look at one of the top moving stocks in today's market. I'm joined by Alex Coffey, senior equities contributor here on Schwab Network.
Alex.
All right, Alex, I know you're across Netflix. You've got a downgrade in focus today. You've got earnings coming up. What matters more?
Well, in the short term, probably the downgrade. In the longer or medium term, obviously the results the company poses to the street is going to be more important. But for today, this note really highlighting something that I think many are toying with on their own, which is this stock's run a long ways. Is it perhaps short term, maybe a little bit overvalued? Netflix under pressure today.
Well,
down by about 1%. David Joyce over at Seaport Research downgrading Netflix to neutral from buy. No price target is given. And this is probably seen as the culprit for at least some of the weakness today. Now the overall market is under a little bit of pressure.
Well, it's overbought anyway.
That's
Jeez.
also gonna factor in. But looking at this, the firm...
I wouldn't buy that dang thing at that price.
And the time needed to execute against expectations for the downgrade. They say they now see less than 10% of upside in the shares. They say that there is plenty of the long-term opportunity factored into the shares at current levels, and Netflix needs time to execute against expectations in advertising, aggregating, launching experiences, and expanding its share once again. So, if I were to play translator, we're pricing in a lot of the things that Netflix is still yet to do, and that set of things may take years to really see come to fruition, of which we've already priced it in, perhaps, as at least this analyst thought, and perhaps at these levels, time may be needed for the correction, less so than a price reset, although a price reset can accelerate that timetable.
Yeah, that's a good point about that. Could it accelerate the timetable? And of course, as you mentioned before, in the long term, earnings may matter more. What do you think is going to be the focus when it comes to earnings, Alex?
Yeah, I think obviously whenever they provide their metrics, particularly their growth figures internationally, those are going to be things that are in focus. Perhaps pricing strategies, continue to add rollouts are going to be important. But, I was seeing this article last week from Wall Street Journal talking about Netflix and Spotify discussions to partner on several projects such as music award shows or a live concert series.
Might take a loss on this one.
And it also brought me back to a conversation I had on Market on Close at some point last week, in which one of my guests was talking about how coveted the eyeballs on the phone screen are. Netflix really dominates the TV right now, but companies like Spotify and some of the social media names dominate the phone time. Movement into games, movement into podcasts, movement into things where Netflix can start fighting for those mobile digital ad experiences and eyeball time and screen time is going to be critical. So that's perhaps something to watch alongside their movement into continued live events, as we know how important things like NFL games are for ad dollars. Is watching the NFL game an hour after it's already happened, just not quite as as useful as watching it as it's unfolding. So live sporting events still some of the most coveted ad space that there is. So those are the things I expect Netflix to focus on going forward, and perhaps additional plans on that from the company's leadership during the conference call will be critical.
That's a great point about live events, especially given the growth of sports betting and sports books. All right, that's our Alex Coffey, senior equity contributor and co-host of Next Week. So get some insights on the news that's shaping markets for that. We want to welcome in Jimmy Lee, CEO of Wealth Consulting Group. Jimmy, thank you so much for joining us and starting out the week with us. The last time you were on, you talked about buying the dip. That proved to be a very timely call. That call aged well. So we've made it through the first half of the year. What's your take as we go into the second half?
Diane, thanks for having me on. Yes, I think that if we get more volatility as we did in the first part of this year, I think it's a chance for investors to put cash to work, but we still have a lot of cash on the sidelines. And in the second half of the year, while I may sound like a promo bull here, I'm really not. But we've got some huge potential tailwinds with lower interest rates and less regulation that could help pick up activity, on the deal front, where we've seen now a few IPOs that have been very good in terms of appreciation of their stock prices, but also more deal activity in the private marketplace, whether it's private equity, or private debt, and I think that lower rates will help that activity pick up. I also see the potential for consumer confidence rising right now as we speak. I think there's
Jimmy's right about being bearish today.
Retail investors, anecdotally, I talk to people all the time that tell me about their investments in some stocks that have gone up a lot, so that worries me just a bit. But I think there's a lot more.
We've got a fallen wedge right here.
Than maybe the worry that we had in the first half of this year.
That exuberance that you mentioned when it comes to retail investors, especially, look, we know that the buying the dip was led by retail investor, and institutional money is still, in some ways, playing catch up. So, do you think that this
Did you hear that?
enthusiasm is healthy?
Well, and I think you made a great point that it was really the retail investor that part.
The retail investor has been buying the dip, and the institutional trader is still trying to catch up because they didn't buy the dip back when we hit the 200 about 3 months ago. They missed out. I mean, that was just a freaking bull signal if I ever seen one in my entire life. Hitting the 200 on the weekly. And nobody called it. Nobody. But me. I'm going to go get something to eat. Try to get my money back here on this one. So I got 1875. Give me 200. Ugh. Okay.
Small cap and mid cap stocks that you were just talking about that will catch a bid as we get interest rates coming down. And so I think that, on the path, on the more positive side, what could happen, earnings could potentially continue to do well. The AI revolution, as my friend Dan Ives likes to call it, I still think there's a lot of investments going into AI. And now we're starting to see what we talked about a year ago, which are the second derivatives of the investment in AI really starting to pick up. I'm just worried about a little bit about some of the, big run that we've had in some of those names. I think we'll get pullbacks. But ultimately, I think the cycle of AI investing will continue to happen. It'll be a good story for tech. And as hopefully the geopolitical risk comes down, I think that's the path to 7,000 if we can get there.
Jimmy, really quickly, I know you mentioned potential for small and mid caps, or mid caps essentially, catching up. But what about sectors that you like? I know you're talking about AI, but what sectors do you like in the second half of the year?
They're definitely talking bearish today.
Long industrials, financials. And by the way, that call on 7,000, we were still believe it or not, in April when we were at the lows that there could be a path back up. We saw the April lows as a short-term potential opportunity like COVID, and thank goodness it's played out so far.
Okay, all right. We'll leave our conversation there. That's Jimmy Lee of Wealth Consulting Group. Thank you so much for your perspective, I should say, and your forward-looking calls. It's got 7,000 target on the S&P 500. We've got a little weakness today on the S&P 500, off by a little bit more than
7,000.
Got a lot more to come on Trading 360. Next up is the big three stocks, 3 charts and 3 trades. Rick Ducat goes through the technicals, and Mike Shore takes us through the trades. On his list today, Builders First Source, DoorDash, and Reddit. That's next on Trading 360 here on Schwab Network.
So I had to go, I gotta get paper towels. I can do that tomorrow. I hate when they turn that up like that.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Diane King. All time now for the big three. 3 stocks, 3 charts, and 3 trades. Rick Duquette will take us through the charts, and here to take us through the trades is Mike Shore, Director of Trading Education.
I'm still in these calls.
Academy. It's great to see both
It's
of you.
65.
Mike, let's start out with a big picture take from you on the market. We had those records
Not looking
close out
good.
last week. We've got a pullback today. Does it make sense to you?
Yes, and it actually makes me pretty happy. You know, whenever you get a market that goes straight up, straight down, it's just not healthy. So, you know, I continue to be in this buy the dip type of scenario. And like I said, I think it's a good thing. It makes sense why we pulled off of the highs, given geopolitical and tariff stuff. But I think that that's ultimately healthy.
Okay, so talk to us about the first trade on your list. You've got Builders FirstSource on your list. It's underperformed the S&P 500 year to date. Are you bullish or bearish on this?
So this is, I'm bullish on this. I'm looking for a run up to that 200-day moving average. I need us to break out and take out those highs at 129.31 though. So, you know, I'm letting the market do kind of the heavy lifting. If it doesn't, if we don't get those type of rebounds and push-ups, then, you know, it's just a no trade for me.
Okay, all right. So, Rick, take us through what you're paying attention to when it comes to this chart.
One of the first things that stands out about this chart is that we formed what looks like it could be a fairly significant lower area. So if you were to backtrack a little bit, you can see that price was trending down here, here, after failing to take out those old highs near 203. After this decline now, we can see that price seems to have found a floor near the 106 level, our green line here. But notice at the same time, though, that even during this period as well, price was making lower closes. From here, it sort of stabilized. We saw bullish divergence on the RSI, a very steady uptrend in this momentum indicator. Now we are seeing price break above this repeated ceiling here near 123, also a floor previously as well. Old support becomes new resistance. Now we are brushing up against this trend line that we mentioned previously, starting near those highs. So if we were to break out above that level around that 130 point or so that Mike was describing, the next stop could be that 137 area that we mentioned. That represents an old gap, a low point, another low point, and then a breakdown, and then resistance point here. Lines up fairly closely with our purple 252-day exponential moving average that comes in above 140. If we were to look at our other studies here, volume profile and standard deviation channels, we can see that our volume profile study shows the point of control is down at these lower levels. So we're seeing very heavy trading at what looks like it could be a notable low point. We also have a confluence of two of our moving averages coming together right around that same level. So 119 looks like a key supportive area. Breakout point would be 130 and then 137.
BLDR.
Mike, I'm going to send it back to you. Given those levels that Rick pointed out to pay attention to, tell us more about your trade for this one.
Yeah, so I'm just looking. You know, this is a breakout. If we break out, we should expect it to move quickly. So I'm going to go with a little bit shorter time frame here, just out to the 18th, regular July. And I'm looking at the 135, 140 call spread. If we get up there, that thing should be trading about 110, which means that we're risking 110 to make potentially 390, and that puts us at 3.35 to 1 reward to risk. We got to take out new highs to get out of that, though.
Okay, you have to take out new highs to get to that. All right, so Mike, let's move on to the next trade on your list. You've got DoorDash on your list. It has outperformed the S&P 500 year to date. It has outperformed it on a year-over-year basis. What's next? What's your view?
Yeah, so actually, DoorDash is breaking out, and so I was looking for an entry this morning at 236 and change, 236.22. We're trading 242.63. So I didn't get that. We got the breakout that we're looking for, and then I'm looking for us to at least target that nice round 250 number, which is a little bit higher than 52-week highs.
Okay, Rick, the floor is yours. What do you notice about the chart for DoorDash?
Yeah, so for this one, we saw a notable pullback down here to our purple 250 two-day exponential moving average right around 160, but the bounce off of that has come pretty quickly here. Earnings also, after an initial gap downward, seems to have been a catalyst to the upside. We can see this 215 level, those old highs at that green line came back into focus here after the breakout point. For the most part, price held on to that supportive area. Now we can see prices well above our moving averages that we follow. Yellow 21-day, orange 63-day, purple 252-day exponential moving averages, all of which are continuing for now to diverge farther apart from each other, which suggests the trend is still continuing to the upside. Look for that slope to start to change, or for the trajectory of those lines to start to flatten out a little bit for signs of slowdown. We can see that RSI is in right on the money, basically, with our upward sloping trend line here in green, just a hair below that overbought area once again here. So what the bulls would want to see would be for RSI to re-enter the overbought area and to make new relative highs above its previous peak, and for price to pretty much do the same thing. So we could draw a channel here. We could start with this low point here, go across these lows, duplicate it, put it across these highs. That is about where we topped out recently, near 249. That would be another similar boundary to potentially watch going forward. So if we were to consider volume and standard deviation channels, well, we're trading right around here at these levels. Traders may be establishing a foothold near that 240 level. To the downside further, volume starts to pick up once again near 220. 215 was that old high that we mentioned previously that we held on to. So 215 to 220 looks like it could be another supportive area. Our volume profile point of control all the way down here near about 190 or so. If we did keep moving higher, 258 plus one standard deviation channel, one standard deviation above our blue linear regression line, our fair value line, could be further resistance there, just below 259.
Okay, interesting. All right, so Mike, tell us a little bit more about your trade, especially given the levels you were originally looking for.
I'm going to run down to the IRS and drop off a paper towel.
236.22.
And I'm going to hold on to these trades.
I was looking at, give us a little bit more time, July 25th, 245, 250 call spread. If we got to that 36.22 level again, that should be trading about $1.60. So we can make 340, we can lose $1.60. That's 2.13 to 1.
Okay, all right, let's talk about the last one on your list. It's in the social media world. It's Reddit, so a younger company here. So far this year, it has underperformed the S&P 500, but if you look at it on a longer-term basis, it has outperformed on a year-over-year basis. So what's your view on where it goes from here?
Yeah, so this is another one on the breakout, kind of a little bit undervalued when you look at it on a longer time frame, but we are above all of the major moving averages. We've had a nice move up here. The problem is, the pullback bias is for me is all the way back down at 136. So either it's a no trade, or I'm looking at the breakout here, and that breakout would be at 165.55. Obviously, we're about $13, $14 below that right now, so we need to see that go. And that's the way that when we get these kind of trending markets like this, either you're looking for support, or you have to let the market do the heavy lifting for you and take that breakout.
Okay, so that 165.55 level, I think that's the number that you said that you're looking for. So Rick, take us through then the technicals on this chart for Reddit.
Yeah, so this one looking like it's perhaps staging a bit of a breakout to the upside here. You could draw this white trend line going across the lows, duplicate it, put it across these highs. For now, price has pushed above it and is staying above that level. Moving averages diverging farther apart from each other, price above all of them. But 159 stands out as well. Take a look back here, an old high point, a repeated floor once again, then a breakdown. So now that's about where the bulls are stuck once again. So this level 159, 160 will be key to overcome. If we were to move beyond that, 181 also stands out. Our pink line here, because it was the corresponding ceiling to this old floor that price found here. So we had this range bound area. We re-entered it briefly, but never really tested those highs again. And now that's kind of where we find ourselves with this potential resistance zone to consider. So if we were to look a bit to the downside as well, our green line here, a ceiling several times here during our low point for our price activity, 125, looks like it could be another downside area traders may have their eye on. RSI giving up a bit of its ground here, falling below not only the overbought area, but also this shorter term green trend line here after only just recently breaking this very long term downward sloping red trend line. So a bit of an interruption here, not necessarily an impending collapse, but something to take note of. So we can see though that our volume profile point of control, our heavy trading area, comes in here right around 113, lines up with our long-term purple 250 two-day exponential moving average, as well as our -1 standard deviation channel and our shorter-term trend line. So that area could be quite another confluence of factors to consider there, around 113 or so. To the upside, volume picks up once again here near that 160 point, and then our boundary that we discussed,
getting back
81, that would be the next step.
Okay, all right. So, Mike, I'm gonna
back to 50.
yield the floor back to you to tell us a little bit more about your trade, especially in the context of the things that Rick just pointed out when it comes to that chart and some of the levels he was looking at to the downside.
Yeah, well, this is a bullish play, and I'm looking at that same level, that same level of 181. So I'm doing the 170, 180 call spread again for July 25th, a few weeks in there, 70, 80 call spread, buy it for 250. So 250, we can make 750. That is 3-to-1 reward to risk.
Right.
And we need to take out those highs at 165.55.
Okay, that stuck out to me as you mentioned the 155 level, and then some of the levels that Rick pointed out that doesn't. It just seems like it's a cautionary point to pay attention to there. All right, we'll leave it there. That's Mike Shore, Prosper Trading Academy, and our very own Rick Ducat, lead market technician here on Schwab Network. Thank you both. Coming up next, we're going to spotlight the current state of the market. What's next for stocks after hitting all-time highs last week? Trading 360. We'll be right back. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I had a pretty big profit last week.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Trade 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time to spotlight the current state of the market. What's next after hitting all-time highs? Joining us now is Larry McDonald, creator, the Bear Traps Report, and New York Times best-selling author. Larry, it is so good to see you. I hope you had a wonderful holiday weekend. All right, I want to start out with one of the takeaways from your most recent newsletter. You say we've moved from peak Trump pessimism to extreme Trump optimism. So what does that signal now in terms of where the market is?
Well, it's, always be careful around month end, quarter end, where you got positioning and you come into the new quarter and people will kind of rebalance portfolios. That's what we're seeing. We run an institutional chat behind me with hedge funds, mutual funds, and pension funds on Bloomberg. And we're seeing kind of a rotation out of some of the things that worked in the first half, out of high beta things. In other words, high beta sectors move more than the market. And so right now, if you're at peak Trump optimism, you want to be taking down high beta names. In our trade alerts in the Bear Traps report, we were big aggressive buyers of high beta equities, Cameco, Freeport in early April in our trade alerts that go up via WhatsApp and on Bloomberg. Now we're taking down those high beta names as we've reached really peak Trump optimism. And at the end of the day, Diane, Trump views higher equities as dry powder to really force his agenda back into our trading partners.
Okay, and then, so you've been vocal about market extremes. When you think about, a lot of our audience is retail investors, retail traders. What are consensus
We're
trades
54, let's go, break it.
retail investors that they should be cautious about, especially given the institutional knowledge that you have?
Well, one of the things I'm really proud of, and thanks to you, our book, How to Listen to Markets Speak, back up at number 1 in the recent days on Amazon and finance. And one of the things we talk about in the book is the bearish dollar thesis. And when you talk to global investors, this bearish dollar thesis has gotten very, very crowded. And what we're hearing in the chat is that Treasury issuance, because we've been at the debt ceiling for so long, and for almost 7 months now, we're at the debt ceiling. All that means for people watching us right now is something very important. There's been no new debt issuance. Now they passed the big, beautiful bill. And what that means for people, everyone should know that now they're going to ramp up Treasury issuance. And so we have to
big, beautiful bill.
Calculate $1.7 trillion between now and December. It's $600 billion more than last year of Treasury issuance. And what that's going to do, it's going to drive up T-bill rates, 1-year T-bills, 2-year bonds, 2-year notes. And so the front end of the curve is going to suck dollars suck cash back into dollars, and that's probably going to get you a counter trend rally in the dollar here. So if you have dollar trades on, or if you're exposed to commodities or some of these high beta commodity names, we expect a counter trend rally in the dollar over the next couple of months. So a lot of things that we're working in the first half, gold miners, uranium equities, copper, they could have a rough couple of weeks if we get a nice counter trend rally in the dollar.
Okay, all right. And let's talk about another thing that we're watching. Earnings season coming up. Big banks obviously going to be in focus because they're early in the earnings season. When you think about all the noise around regulatory landscape, loan growth, et cetera, I know you talk about this in your Bear Traps report. What's the single biggest thing that you're going to be watching for in the earnings season?
Well,
Think of Jamie Dimon. He's taken down his personal JP Morgan shares by 25% over the last year, and a lot this year. It's trading at 2.4 times book. A 5-year-old knows the bullish case for bank now in a Trump regime with the chief regulator being a Trump appointee at the Fed.
What?
Literally a 2-year-old knows this. The
2-year-old
between JP Morgan and the regional banks is the widest it's ever been. Again, 2.4 times.
I don't think so, buddy.
JP Morgan has never traded there, and their CFO, their CEO, is dumping shares at the fastest pace he's ever dumped them, right? So you have to be selling your big banks here, buying some of the smaller ones, and as you come into earnings, the bar is very, very high for these banks.
But the bar is high, but everyone always, points out, and we see time after time that, JP Morgan Chase has this fortress balance sheet. Do you think that there is something, under the hood coming up?
Let's go.
The biggest thing is just sentiment, and I think that, are we at peak?
Anybody stuck in the
optimism right now
stock?
for the economy? Yes.
Anybody stuck in the stock? Nobody stuck in the stock? I'm going to go run to the bank real fast and they're coming in Monday and they're all talking bearish. All the fat cats are. Earning warnings. Retail traders are buying the dip. Institutional traders are chasing. They want this market down so they can buy it, so they can load it up again. But I don't know. I just wish I can get my meat back down to where it was normal. It's hard to, once you raise prices, it's hard to bring them down. That's a fact. I'll go out and I'd buy a mat board, a 32 by 40 inch mat board, which is museum grade. Run you about 25, 30 bucks. And I want to cut 4 16 by 20s out of it. Mats, double mat. So I had to buy 2 mats. I take over there and I cut my mats up. So I paid $64 for these 2 mats. Let's just say 50 bucks. And I got 4 mats out of it. I was able to, and then once I cut the 16 by 20s out, I got the inner cores of them mats. So I take and I put them on over there in my bin, my mat bin, put on the number on the back of the mat. Then I get a knock on the door. Customer comes in and says, I got a 5 by 10 or I got an 8 by 12, an 8 by 10 that needs matted. And I was wondering if you still had that acid-free 1032 in. And I say, yeah, I got it in. I got some innards for it, but they're in great shape. And I'll cut them out and I'll cut you a mat for your picture. So I've already profited 4 different times off these 2 mats that I paid $50 for. And the markup was 100%. So I was able to get 4 mats out of 2 mat boards, which means I would have charged them probably $50 for a mat board for the 2 mats each. I already paid $50 for the initial 32 by 40s. So I cut them in fourths, and I'm charging each customer $50, which is now $200, and I only paid $50 for my mat board. Plus, now I've got inners. I've got a good, 8 by 12 or a 11 by 14 innards, and I got 4 of them that I can use now. So another customer comes in, wants a mat cut for 11 by 14, and I've already made my money plus 300% on my 2 mat boards. So I stick the mat boards back in the bin, and another customer comes knocking on the door. Jim, I got an 11 by 14 certificate that needs framed. I need to get it out, and could you do it right now so I can bring it to class? And I say, yeah. And that'll be $20. So now I've got 4 mats left, right around 12 by 16, and I've already chopped up 2 of my innards, which gave me another $50 profit. So now I'm up 400% profit on these 2 mats, and I still have 4 more pieces left for a double mat or 2 mats. And then finally I got a card in, and I want to frame this 5 by 7 card, so I decided to go ahead and use the rest up the mats. And I put it in the window, and I'll say, this is for sale for half price. And customers come running in, I heard your mats are half price. And I said, yep. Only got 2 left though. You better get them while you can. Till I order another whole sheet of mat board in. But when I first started my picture frame business, I was so freaking anal that I logged everything. Every dollar I made, I logged it in. And then I got audited twice. I said, fuck this. I ain't not logging this shit in anymore. I'm just going to start logging in the 2 mats and then get whatever I get out of them, because I'm not going to show the profit that I'm making on the rest of these mats. Because they're taxing the hell out of me. So we're back down again. But yeah. I wish I was still doing that in a way. Always clean. This is Washboard Jim with a sneaky snake trading strategy. How may I help you, darling? The free kissing booth is back there by the pool. George. I was going to write a song about Billy Long. I forgot all about that. So did everybody enjoy their math lesson today? Jim, I got a question for you. What does Met cutting have to do with stocks? Technical analysis. Jim, we liked it better when you didn't say much. Woo! Okay, this ain't working out too well. It's my last support on the /ES. Pretty dang close. I mean, this is it. It's got to hold here. And I got to figure out what I got to do to get out of this trade. Okay. We've got to find out if it's going to hold or not. We got more room to go down on the 30-minute, but we're at 3 support levels on the 5, the 2, and the 1. I'm going to go and get my thing, go to the bank. Oh, this ought to be pretty. This girl can't play guitar. Pretty spot there, Dan Dan. I've been watching her for about 4 years. Used to be a big dancer.
Product, it sounds much more like a third party, which kind of removes their edge here, right? So I think those are really the major concerns for us. They haven't really shown anything yet that they're able to deliver.
I hear your point, Ivana, about, not leveraging their consumers. But for instance, the consumer here, I'm just one consumer. I've got a phone, a laptop, AirPods, etc. They may not be leveraging, but it seems like their customer is sticky at least. Because
100%.
Once you're in the ecosystem, it's hard to get out.
100%. However, what I would caution investors is when you have these disruptions like AI, this is the time for a new entrant to come in. We don't see anybody yet, but their penetration level is very, very high, as you highlighted, right? So if they're not able to deliver and somebody else is, it's kind of at a peak level of penetration. So we're not...
Peak level of penetration. Ooh. Oh, my alert went off. Shoot, I missed it. Oh, I missed it. I missed it. So this is how I charted this one out. This is a Fibonacci setup. So we had to break out here, and I always look for a 50% pullback on the breakout, and that's right here. And it respected it right here on the yin yang right at open. So she came back and she hit that 50%, and I could have took that trade and run it 20 cents. And I didn't see the alert until 5 minutes too late, 6 minutes too late. 50% pullback on them big breakouts. Now this is Mustang Bio, which is a low float. We got 5 times rotation, and we have an orphan drug destination for cancer treatment. So we could have a continuation on this one. I missed my opportunity there. It's hard to say where this thing's going to go. Yeah, that had me a trade right there. AMD reversed. Jimmy was talking about it this morning. We're about to resistance 135.44. NVIDIA just hit the 200. We've got a double top on Apple with a double bottom, higher low. And we're at 36 on my options here on SPY. I'm just going to hold on to them. See if we get a second half run here. Let's go. There's a big old boost right there. We got to break to 63. Well, let's break the 63 and get it on. I've got quite a few contracts before I finish my song. We gotta break the 63 right now. I want to go to the bank and buy my girlfriend a cow. Blake it. Can we break the 63 for me? Okay. Burl. Hey, let's go. We're at 52 now. 53. 54. Oh, God. Hello. My name is John Watts Holmes. May I help you? Who's this?
My name is James. How are you?
Your name's Jim?
Okay, yes, Jim.
Wow, my name's Jim.
Wow. Your name is John and my name is James.
Oh, okay.
Okay, well, the reason we are reaching out to you because you have marketplace health insurance right now.
I have what?
Hello?
Yeah, I'm here.
Do you have any marketplace health insurance right now?
I'm sorry, man. I ain't got time for games. I have no time for that. Okay. Well, I'm down quite a bit on this at one time. Now I'm not. Maybe that's 26 to 46. Got quite a few contracts.
His voicemail was full, so maybe some progress there, even though they did extend where they're not going to start those tariffs until August 1st. But let's expand this conversation, bring in Alex Coffey, senior equity contributor here on the network. Alex, we've got all 11 of the S&P 500 sectors in the red today, but as I told Kevin, maybe we're warranted for maybe a little bit of consolidation, maybe a little bit of a pullback after, the biggest snapback rally that we've had, V-shaped recovery from those April lows since about 1950.
Yeah, due for a little bit
1950.
of a pullback right now to cool off even of the rally, but you start.
See, that pullback wasn't necessary, for one. But it was, in a way, because we had a 40% run-up in the last 2 years.
Reacts and trades off what it feels the direction of that risk is going. So when things were escalating and getting hotter and hotter geopolitically, that's going to be net negative for the market, at least until it takes an off ramp. It's starting to take that off ramp. When you look at interest rates, when they start bubbling up and start going higher and higher, and you start to see what looks like a treasury market that's in free fall, like you saw in March and April, that starts to scare the equity markets. The same goes for whether or not a bill is going to get passed, that's seen as important. The same goes for these tariff discussions. And so when it looks like the risk isn't accelerating, the market tends to drift. You combine that with what's one of the seasonally strongest parts of the year, a heavy vacation time, people looking to take time off. You kind of have a recipe for a quiet drifting market. Now, this one just happens to be drifting sideways to lower today.
Right.
But in the context of the last couple weeks, I mean, if this is your down day, bulls are ecstatic.
That's right. Maybe just a pause. And, Kevin, to Alex's point here about wins, I think that's what, a lot of investors are focused on. Alex mentioned the geopolitical risks. We got through the Iran-Israel conflict relatively quickly. That could pop back up, but we got through it. The tax bill got through, even though there was some consternation on that front. And then you start taking a look at, maybe crude oil's back below $68 a barrel, consolidation in the yield market at this point, even though we've got yields a little bit higher today. Kevin, it just feels like the more wins we get just kind of propels the optimism here for the equity market.
Interesting.
Yeah, it's hard to it's getting harder to find things to be concerned about, right? And if I thought Thursday morning's jobs number was really solid, right? The revisions were all high or higher. The number was good. Unemployment was lower. The wages data that we were worried about in terms of inflation was a nice, solid beat. I still don't think that July is anywhere in the close to being real and live. But I think there's a scenario now setting up where the Fed, Jerome Powell, and the Fed speakers, some of them have already started, are starting to
right
guide
now I'm green.
a September cutting of rates. And then you get to that 2 rate cut this year scenario, and that makes markets feel a lot better because, rates have been very quiet lately. They went from 4.4 down to just below 4.2. Now they're 4.3. They're still lower than they were 10, 15 days ago, but they've come back slightly higher. Just not a very volatile.
Francisca's here.
Anymore, and it looks like
We missed you, darling. She said hi. That made my day.
I expect them to do it again. I don't know which direction, but the market will probably move on some of those announcements. If there's announcements coming, that'll move the market. Tom, it's the middle of summer. It's hard to get my heart rate up with anything significant right now in July. I've seen too many of them, Tom, and it's just hard to get too serious about it right now when we're in mid-July.
No, it ain't.
And if you take a look at it, the last 10 years, the S&P 500, even
It's
though
not.
it's records, last 10 years, the S&P 500 averaged over 3% gains in the month of July. So one of the stronger points, but Kevin mentioned yields right here, Alex. So we got yields up a little bit today, 4.38, I believe, is the 10-year at this point. Are we getting into that scenario where the job market's still robust, as Kevin mentioned, that data, 4.1% on the unemployment rate, it was supposed to be up a tenth of a percent, it was down, where, hey, growth might get spurred here, this wealth effect, people are employed, they'll continue to spend. We've got the Prime Days starting, Target Circle Days coming up here, so the consumer's going to be out there spending. Are we in this scenario where, hey, less than a 5% chance of a rate cut later this month, right? And then in September, it's gone down from over 90% last week at the beginning of the week. Now we're at about 65%. That's about the cutoff line of where estimates are for maybe a confirmed rate cut in September. What if GDP starts to ramp up here a little bit, people are employed, where the Fed doesn't have to cut? Maybe inflation ticks up a little bit. I don't think it's going to explode by any sense of the imagination that maybe Fed Chair Powell's worried about. But we could get through this without any rate cuts at all if the economy is booming and the job market stays robust, right?
Yeah, in theory, no doubt. I mean, that's a good outcome also.
Yeah.
That's the outcome of the last several years. But what I would say is if you were to look at kind of the Treasury yield curve, it's a far healthier curve than what we've seen. But if you were to plot the Fed funds rate on that, it would be the one thing that's out of line. You could make the argument that the Fed funds rate, if it was set by market conditions right now, would be closer to 3.75 or 3.5, not, where it's currently sitting. So with that in mind, you may argue that, it's more of a normalization of rates to get in line with where everything else is than it is even.
This is something I mentioned earlier. We have the triple bottom right here. And we went ahead and pulled on back. And then we had a 1, 2, 3 reversal back to that triple bottom. And that's what I called as a resistance. So we got to see if we can bust that triple bottom there. That's a major resistance line right here. Make it blue. And I'm going to go do two things. Go to the bank and do three things. Bring the paper towels up to the IRS. I still have time. And I will be back. I'm still in this trade. I should have probably sold it at even, but a little bit above it because I was getting ready to go do something. But I think we'll just have to watch. We've got to break that major resistance level. 622.32. $622.32. Got my water. I got 50 contracts of these, 60 contracts of the SPY. Okay. I'll be right back. Well, shoot.
But Alex, to Kevin's point here, are they going to be late? Or, as an investor or trader, you're looking at this market going, okay, is it going to be higher by the end of the year? Because that's what you want. Everything's forward looking, right? But at the same time, we're at extended levels for equities at this point on a technical basis, maybe even on a fundamental basis with the forward PE pretty elevated.
Yeah, regardless of what they say, I think it's pretty clear over the last few years that they kind of do have a path and a plan, and they try to guide towards that. And unless something tremendously off script happens, they generally stick to it. They want to operate a cruise ship, not a speedboat. And so I think, like Kevin said earlier, they're sort of guiding to this kicking back off in September. What I would like this, comment on, you kind of brought up the dissonance where the disagreements that you're seeing within the dots. Yeah. But the actual truth in my mind is that's reality. The reality is things are going to be really good, and you're not going to need rate cuts, or you're going to need very little rate cuts, or things will start to slow down, and you're going to need the Fed to do kind of a lot. And so that's why it's always tough, especially the further out you go, if you're looking at Fed funds futures or the CME watch tool, is it'll say, hey, the market's pricing in, 8 cuts for the next 2 years. Really, it's pricing like interest rates are going to be significantly lower, or you're going to get very little. And that's just because that's the nature of the game. You're sort of looking at the direction of rates as a reflection of the direction of the economy. And sometimes you're right in terms of it slowing down, and sometimes it doesn't slow down. Sometimes it gets faster, and you actually might need to see rates go higher.
Yeah, and that was my point earlier when I stated that, hey, what if the economy starts to expand at a faster pace, that GDP estimates start to go up here a little bit? That could be what could offset any potential rate cuts, because if we're doing well, you don't need rate cuts. Market can go up in a rising interest rate environment, or at least a stable one.
You would like to see the 2-year yield start to catch up then to Fed funds, and it's got a long ways to go for that to happen.
Yep, for sure. All right, great stuff, guys. Let's take a quick break here. When we come back, we're going to take a look at Tesla. The EV maker stock is under pressure today on the downgrade, and the fact that CEO Elon Musk is getting back into the political arena here. Shareholders not liking that. Let's stick around. We're coming right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking Tesla. Stock's down over 6% in today's session. Still in bear market territory. Still down on the year over 20%. Kevin, when you look at this stock, you know, we talk about it all the time. It's a love-hate type of relationship with investors at this point. But, you know, people that own the stock probably don't want to hear that Elon Musk is getting back into the political arena. Stock got downgraded at Baird today. So, you know, it keeps piling up for this this company that, you know, was hitting all-time highs in December about 7 months ago, Kevin. So, you know, this is another, you know, headwind for investors in this stock.
You know, Tom, the headlines are so important in this name, and the headlines keep dripping negative on this name. Now, the deliveries, 384,000, that actually wasn't bad in terms of expectations. Was 387. That number's okay, but they're lower, right? You could say they're retooling the factories. They are good, okay, but these numbers are still coming in lower. And now today's headline, besides the downgrade, a distraction away from the businesses that Tesla shareholders want Elon Musk to be paying attention to. Tom, take that all. We want cybercabs and Optimus robots. That's what Tesla investors want him to be focusing on. Cars as well, buckets of income that he can derive from, and 2 new ones on the way. Robots and cybercabs, they want that pace to pick up. And what are they getting? They're getting third party. Look up Ross Perot. Look out what happens to third parties. They can get as much as 19% that Ross Perot got, but all they do is get someone else elected, Tom. It's a great aspirational view that just never works. And so that's what frustrates people with Elon Musk's clear frustration. They want him to concentrate on the business and cars and cabs and robots, and he's focusing on a third political party. There's the problem with Tesla today, guys.
Yeah, not only today, Kevin. It's been an ongoing dilemma here over the last couple of months here. But Alex, when you talk about this, you know, we cover this stock all the time, and it's a tradable stock, right? Because it moves. It's choppy. There's good headlines. There's bad headlines. But it just feels like, you know, that you've got to be prepared for volatility in this name, no matter if you're bearish or bullish in it.
Yeah, no doubt. And right now you're going to see volatility because it looks like the president's talking. There's some announcements on tariffs regarding South Korea and Japan, 25%. Looks like effective, I think it said August 1st. Yeah, August 1st. So that's why you've seen volatility the last, you know, few little minutes. But to your guys' point regarding Tesla, it's already a stock that trades with a really premium valuation. It's super momentum driven. It's got a lot of cool things it's working on. But if you're investing in this stock, you're investing in the future. And right now that future is distracting. And right now it's a little bit more of a negative momentum surrounding the name. And so, you know, all things considered with Tesla, you have to, you know, be willing to weather these kind of storms if you're going to look at this particular stock. And so traders like it, investors have to have thick skin, and they got to have, you know, pretty, you know, what do they call it, diamond hands, because the stock just tends to move a lot.
Yep, when you look at this, Alex, it's got the higher beta, right? We always talk about that because it moves more than the S&P 500 beta of over 2.1%, so nearly double on a percentage basis of S&P 500 moves is equatable to Tesla. How do you want to look at this one from an example trade?
Example trade, going with the momentum, Tom. It's a bearish strategy, buying a put calendar, trying to define the risk a little bit, selling this Friday, buying next Friday, and looking at the 280 strike, looking to spend $3 on this particular trade. And if you do that, you limit your risk to $300. and of course you would be benefiting from a move lower in Tesla shares to around 280. Now it can overshoot. This is customizable, but I wanted to structure a trade that kind of gets down to the next potential levels of support on the chart. This stock ran into some volatility a few weeks ago on similar news, and 280, kind of 275 to 285, it kind of started to get a bid. If you think that same level could hold again, it's not a huge move from here.
Right.
Perhaps that could make sense for a place for it to run out of gas. To the downside, at least short term, and then this one maybe expands from $3 to something greater.
Yep, let's break this one down. Really short term positioning, going out to that July 18th monthly options that expires in 11 days, buying the 280 put, selling that same put in the near term July 11th, weekly options that expire in just 4 days. 1 week wide put calendar here, you're paying roughly about a $3 debit. Probably trading closer to 310, 320 right now, but the debit you pay is going to be the risk, as Alex mentioned. But you look at this risk profile and it kind of gives you an indication. Yeah, you want it to go at or near 280, but you've got a good wide range between maybe 295 on the upside and maybe 267 on the downside, where you can still be potentially profitable on this type of trade. Kev, give me your assessment here. Really short-term positioning, but it gives you exposure to the downside.
IV percentile still right at the 25 percentile, which means the bottom fourth in terms of implied volatility. So Alex doing a very short-term bearish play, only 6 deltas, but Tom, it's got about 8 Vega. So if Tesla's implied volatility were to pick up over the next 3 to 11 days, this is gonna look okay. It's gonna get the directional play of short deltas plus the Vega play of higher implied volatility. So it's collecting, theoretically about $32, $33 a day, and you're just looking for a move, like Alex said, following the momentum down towards 280 is his play here.
Yep, and you've got some assignment risk on that short option over the next 4 days, and time decay is in your favor on this one, because as you get closer to expiration over the next 4 days, that the price of the put that you sold contracts at a faster pace than the one that you bought a week out. So really short-term positioning gives you some exposure to the downside. You just don't want maybe a 2 or 3 standard deviation move to the downside. You don't want the stock to go higher either. Just grind lower towards that 280 strike within the calendar. All right, that's going to wrap up this block. Let's take another quick break. Thanks to Alex Coffey, Senior Equity Contributor. Coming up next, we're going to be joined by Andy Swan from Likefolio for a look at sentiment data in Netflix. The streaming stock is lower after downgrade, but is still just below those record highs that we hit just last week. Stick around.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. It's going to be Andy Swan. He's a co-founder of Likefolio. Happy Monday, Andy. Welcome back to the show.
Yeah, happy Monday.
All right. So, Netflix got downgraded today. Stock's not even down 1%. The market's kind of weaker here too. But this almost gives you an opportunity if you're a bull on this name. Do you guys have data that kind of supports this analyst downgrade, or is this just going to be another opportunity to buy the dip because it seems like that has worked out for the last few years?
Yeah, I think the answer actually could be both. We do have data that supports the analyst downgrade, and I think Netflix kind of downgraded themselves earlier this year. They stopped reporting subscriber numbers in the first quarter of this year. And, we're really seeing that was just as web traffic, engagement, subscription intent, all the things we track at Likefolio started to decline. If we look at web visits versus stock price, we're really seeing a sharp divergence. Netflix stock up, over 40% year to date, but web traffic has collapsed 14% year over year. And we really attribute this to, a breakdown in the consumer signal around Netflix. The stock is priced as a platform that's still growing, but consumers are just kind of finding other options is what, kind of our big takeaway here is there's a lot of competition, and especially in the live sports and live event segment, Netflix just still hasn't found, their footing. The other chart that I really think from Likefolio that's very instructive here is, app engagement. Again, down 10% year over year. Sentiment around Netflix originals is falling pretty fast. We really just think that the core user, the core excitement for Netflix is slipping away a little bit. There's really not much buzz. There's no breakout content, no must-see content, must-share content, and, unfortunately, no real visible innovation in sight. And I think it really comes down to sports. Disney Plus has Wimbledon, Amazon's getting NBA rights, and YouTube is dominating Gen Z with creator content. You just kind of Netflix there, kind of sitting on, resting on its laurels a little bit. So I think, this is a great company that has shown the ability to execute really, really well. And, lulls like this have historically been opportunities, and I think that's probably the case right now, but they definitely have a lot of weakness to sift through, and a lot of headwinds to get through here, especially from the consumer perspective.
Andy, I have a page full of notes and questions that I could talk to you about when it comes to Netflix. But one of your charts, the streaming trend chart, really jumped out at me because we talk all the time about Netflix being the leader in streaming. And then I see your breakdown of streaming, and you look at YouTube, and it's really lapping the field, and it's almost lapping Netflix. I mean, 12.5% of all streaming versus 7.5% for Netflix. What is your data? What is that data saying? Most Google Alphabet traders and people that are watching this name, YouTube's almost an afterthought. It's something we throw in after cloud and search and all these other great companies that Google has. Very quietly, Andy, they're dominating streaming, aren't they?
Yeah, and streaming's dominating the landscape, I think, is the other big takeaway there. Streaming is now officially surpassing both cable and broadcast television. And so I kind of think of it as this kind of waterfall effect, where it used to be that the only people capable of creating truly great content were networks and some cable providers that had the means and the resources and the distribution to get that done. And then it shifted, and the digital players came along, and Netflix dominated that because, again, they had a great amount of resources. It took less for them to distribute, so they were more profitable. And now this kind of third level of that waterfall is the, independent one man, one woman creator. And they're on YouTube, they're on TikTok, they're on X, they're on Instagram, and they're creating really great stuff, really compelling stuff, to the point where, the guy that was I forget his name, but the guy that was in the outdoor YouTube channel and created great content for families about being an outdoorsman. When he decided to step away, the world mourned. And it's different than a Netflix. You feel that personal connection with a lot of these people, and I think that does create extreme engagement across thousands, if not millions, of niches. And so that's what Netflix is up against. They're up against millions and millions of creators that are creating very specific, very unique content in an experimental way, and the best ones of those are winning user engagement, whereas Netflix is trying to create the next big series that everybody's going to love. It's a very difficult game. So YouTube definitely in the driver's seat as far as content creation, and eventually something on their platform's going to hit a bullseye, and it happens every day.
Yeah, Andy, Kevin mentioned the one graphic that you guys had about streaming trends with YouTube outperforming, but then your other two, that kind of surprised me. The app usage down 10% year over year, and then the gap between, web visits versus their stock price is probably the widest I've ever seen it. And you guys are typically, relatively bullish on this name. I mean, when you look at those, is that a trend, or is that seasonality, or is it something that can flip relatively quickly if they have a couple new hits? Or is this just maybe a trend that is just beginning?
Well, we have to kind of wait and see on that. Yeah. There's been many times where we've had the opportunity to declare the top on Netflix from an engagement standpoint, from stock price standpoint, from a just corporate standpoint. And all of those have turned out to be dips. And I think that it's most likely that this turns out to be a dip as well, because historically this is a company that executes extraordinarily well, that innovates a little slower than everybody else now, than the YouTube creators by the millions, but innovates really well, and tends to find the customer where they're at. And so we're going to continue to bet on that team, that history, and that ability to execute and distribute, but with the caveat that this time might be different. We won't know for 6 months, 8 months, because that's the general cycle where Netflix comes out with new content. But we could be sitting here in December or January talking about the new runaway hit or the new sports league that Netflix has created and totally changed the landscape. Neither one would surprise me. I think right now we just say, let's sit back, watch, let's see what Netflix does, and use the opportunity on serious down moves to pick up some shares to add to our position, because we're certainly not giving up on this company yet because of a little bit of a lull in the data.
Yep. And those valuations elevated also on a forward and trailing basis. All right, great stuff as always, Andy. Have a good day.
Thank you, you too.
All right, that's Andy Swan, co-founder of Likefolio, breaking down for us. Kevin, I think that was, maybe the least optimistic data that we've ever gotten from Likefolio, but at the same time, you can't bash against what the stock's done. Andy mentioned up 44% so far this year, up 86% from year ago levels. So it's still been on a run. How do you want to look at this? Because they report earnings next week.
Right, and there's one of the questions on how you want to approach it. That's why I brought two trades today, Tom. And so if you look to the July 17th earnings event, and therefore look at the July 18th earnings or series, right? In terms of expiration, you can look at the $104 expected move. Go inside that, Tom. I sold the $1,211.90 put vertical, Tom. So $88 now? $88 lower out to net to next week because there's an elevated level of implied volatility. Now, maybe you want to stay away from that, right? And give yourself more risk. So, Tom, I looked at that as trading around $2.50. Why? Implied volatility is elevated, right? And you're slightly inside the expected move at that round number 1,200. But if you go out another week to the July 25th, you go down another $15 to the 1185, 1175, and collect almost 240. I've got it in there at 230, but it's trading almost 240, Tom. So this is how you judge risk and make decisions. Do you do a short put vertical into the earnings event that right now the implied volatility is elevated and possibly going higher? Or do you go further out, give yourself more of an expected move, another $15, but you also give yourself more time, Tom? There's the discussion trade-off that we want to have today.
All right, yeah, let's break down. The first one we're going to look at is that earnings event cycle, the July 18th that Kevin mentioned here. We're going to sell the 1,200 strike put, buy the 1190 strike put. So a short $10 wide neutral to bullish put vertical that you're going to collect roughly about 250 credit on it. It's trading right around there right now, but if you collect that 250 credit, it takes your break even all the way down to $1,197.50 on that one. So you do have that big cushion to the downside on this one. Kevin mentioned selling a put vertical on a 1,200 strike that's $88 out of the money means that 1,200 strike has got about a 74% probability of finishing out of the money in a higher implied volatility option series because it captures that earnings event on the 17th on next Thursday after the close. So take that into consideration. But on that trade, if you collect 250 credit, your risk is $750, but that's all the way below 1190. So basically $100 below the current share price in there on that. Break even, as I mentioned, 1197.50 on the nearer term one that expires in 11 days. Now let's flip it and look at, not flip it, but same type of spread here, but this is out in the July 25th weekly cycle that expires in 18 days. Giving yourself an extra week of duration, right? And Kevin went further out of the money to the downside, selling the July 25th weekly options, the 1185 strike put, buying the 1175 strike put, collecting roughly about a 230 credit on that one. So you're collecting just a little bit less than the other one on that trade, but it takes your break even down to 1182.70. So you've given yourself a bigger cushion to the downside. And why is that? Well, you've given yourself 7 days extra in that position where the stock could actually go lower than that. The 1185 strike, the probability of finishing out of the money is nearly 76% on that one. But positive time decay on both of those examples. But it's a good look at what you can collect versus duration versus the cushion that you give yourself on these positions. Now, on the second one, if you collect that 230 credit, you got $770 in risk. As I mentioned, that 1182.70 break even to the downside on that one. Kev, real quick before I let you go, these are the things that you start looking at when you're looking at duration, what your outlook is for a stock, what kind of probabilities, right, versus what you can collect on those.
Yeah, you always worry about selling volatility while it's going up into the earnings event. But if this stock were to move higher too, the overall value will go down. So it's always something worth watching and learning from is when's the right time to put on the trade, right? And so it has a lot to do with your opinion on the trade. So it's always a good exercise time to go through this and see when do you do it. Do you do it based on the price of the stock, or do you time it right in front of the earnings event? Always a fascinating discussion.
Yeah, and one of the things is volatility in that July 18th option series on the first example that we looked at on the 1200, 1190 put vertical. That should stay firm, volatility, but at the same time, as you get closer to expiration, time decay is contracting the price of that, so you probably won't collect as much if the stock's staying right around here and vol levels are about the same. So keep that in mind also. So good look at two different ways to trade Netflix with those two examples. All right, coming up after the break, we're going to take a look at Applied Materials. The semiconductor equipment stock is up about 17% so far this year, but was downgraded today. Coming right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Applied Materials, let's get a quick market update here because stocks are near session lows after those headlines from Truth Social came out where President Trump sent letters to Japan and South Korea saying you got to pay 25% tariffs starting August 1st. That put a little bit of a bigger dent in equities, which were already in the red from those all-time highs that we had last Thursday. So headline risks once again rear their ugly head here for equity markets with all four major indices deep in the red, led by the small caps. All right, let's get into a discussion. There's a heat map there, kind of reflective of a lot of red out there. All 11 of the S&P 500 sectors in the red in today's session, led by consumer discretionary to the downside, but small caps getting hit here also. All right, let's get into a discussion about Applied Materials. The stock was downgraded today from Redburn. They put a price target on 200 from 225. But then on the flip side, Citi raised their firm's price target on Applied Materials to 220 from 190, keeps a buy rating, and they've added it to its U.S. focus list. That's why the stock's relatively flat after a downgrade. Let's bring in George Tillis, senior markets correspondent here. George, it seems like a battle of the analysts on this one, but stock's up 17%, but still in bear market territory from those all-time highs last August.
Yeah, if you do look at the stock price action, like you said, it was trading around $240, $250 going back to last year's August level. It's actually been down in the last year about 22%. Year to date, it's starting to inch higher, particularly off the March, April lows that we saw in the overall markets. But I think the price action today is a little bit telling, particularly because it's not moving down in sympathy with the SOX index. It's underperforming, or it's better performing to the downside. Let's put it that way, than the SOX index. But nonetheless, I think if you look at the analysts, it's like splitting hairs here with Citigroup, like you said, moving their price target higher to 220 from 190. They maintain a buy rating, and then Redburn, Rothschild actually downgraded the stock to a hold from buy or neutral. And they brought their target down to 200 from 225. And there's a couple of things that I find interesting about Applied Materials that I think might create some clarity here. But I did notice that last year, if you look at sales growth was close to 7% for the last sequential 4 quarters together. But if you look at their capital expenditure growth, in the last 4 quarters, it was up 52%. So I think that suggests why perhaps the stock was down. Now, the company has done some things to ameliorate some of that CapEx that was quite high in the past year, and that was to buy back shares. That may have supported the stock price to the best degree possible, but they're running out of capital, I suggest, or cash to potentially continue the share buyback program that they have put in place. This year, they're still expecting about $10 billion in share buybacks, but they've got about $6.7 billion in cash left on the book. So I think what's happening here is the expectations for the company are to lower their CapEx, maybe in the next couple of quarters, save some money, and use that to continue their share buyback program. But I do think at the same time, if you look at the earnings growth estimates for the fiscal 4 quarters going forward, they are still expecting essentially around 19% earnings growth. So that's still pretty good. And I think that a couple areas of weakness that we've seen in the stock represent their markets. One, 25% of sales are in China. And we know that China is really encroaching on the semiconductor stack, whether it's competing from a equipment standpoint, technology standpoint with Huawei, and of course, trying to develop their own CPU and DRAM chip technologies as well. Applied Materials is one of the larger, if not the larger, player in the DRAM and NAND flash memory equipment manufacturers. The other thing is the capital expenditures last year have a lot to do with the secular trends in AI and data centers. So they've had to spend to essentially broaden out their equipment offerings to multiple semiconductor companies, perhaps even NVIDIA going forward, but it's cost them money. And I think that's really reflective of what we've seen the price action in the last year, because it's significantly underperformed the markets and even really underperformed the SOX index. So there's something telling with the semiconductor equipment manufacturers, because they typically provide some leading indications of the CapEx cycle. And I think that's maybe played out here and why Citigroup is upgrading the stock. At the same time, Redburn, I think, is a little more cautious, perhaps, on the ongoing tariff issues and ongoing geopolitical issues in China, because, like I said, AMAT's exposure in China is still quite large, around 25% of total sales.
George, when you look at a company like Applied Materials, they're in the semiconductor, they're involved in the megatrends, they should be benefiting from it, but they're not as sexy as some of these AI chip companies, right? They're more, they're more of a recurring revenue. They're more of a stable cash flow because they make the equipment that makes the semiconductors. So they're in this business that they should benefit from, but they're not exactly the same, are they?
They're not, and that's the thing. I mean, the sensitivity I suggest in the semiconductor area is really dealing with inventory gluts. That doesn't seem to be the most concentrated, best case scenario for the equipment manufacturers, but they do typically lead the semiconductor cycle. I mean, if you notice Micron, for instance, AMD, both these stocks have really picked up this particular year, but even AMD and Micron are still down over the last few years because of inventory gluts, pricing erosion, and then changes in technology. I think Applied Materials, when you look at this stock or consider it, you have to consider that it's a low growth, stable, cash flow producing participant in the semiconductor vertical. The other thing is the display markets, whether it's smartphones or TV display markets or adjacent display markets, they've been relatively weak, handsets and so forth. I think that's weighed on Applied Materials. And I also think that, it seems to me that they're evolving in what their offerings are, but that has cost them quite a bit of money, because when I looked at the sales growth for the last year, 7%, that's still down relative to their 5-year averages. So revenue was already down in the last year relative to the 5-year average, but at the same time, earnings contracted quite a bit in the last year because of the heavy CapEx demands that have been placed on the business. They have offset, like I said, with their share buybacks, but it looks like to me, this is my evaluation, that in the next couple of quarters, they're probably going to demonstrate some capital effectiveness in terms of what they're spending, to let the last couple of quarters of spending manifest into the forward a couple of quarters, and maybe we'll see a continuation of this trend, which, albeit again, it's not the most sexiest or fantastic looking trend, but albeit it's been moving slowly to the upside on very low volume.
Yeah.
But nonetheless, if they come out next quarter when they report earnings, or the upcoming quarter, they may demonstrate that they're cutting back on their CapEx, and that might actually be rewarded by institutional shareholders as well as analysts.
All right, great breakdown for us. Appreciate it. That's George Tillis, Senior Markets corresponding here, breaking down AMAT. Battle of the analysts on this one. So I looked at a strategy here, Kev, that's relatively neutral. It's short iron condor. We sometimes call it a short iron butterfly, with the expectation we're going to see some consolidation in the shares. I went up to the July 25th weekly options that expire in 18 days. We're going to sell the 190 strike call and the 190 strike put. So we're selling that straddle at the money, where stock's currently trading about 190. And then against that, to make a risk define, we're going to buy the 175 strike put and buy the 205 strike call. So short $15 wide wings on this short iron butterfly, collecting roughly about a $9 credit on it. That's what you can make, $900 with $600 in risk. That's below
hell, did I leave that up there?
Or above
Ain't
205
cool.
is where your risk is. But Kev, you got break evens about 199 on the upside, 181 on the downside. So you definitely need some consolidation on this one.
The simple theory about selling options is, in most cases, like this one, you want it to go to the short strike. And so any trade that hovers or stays around the 190 level is profitable.
How do you know what short strike is?
Selling the 190 straddle, collecting that credit, and then hedging it by buying the 205.
Maintains a buy rating.
205 call, 175 put. Collecting about $9, you're looking for it to stay in that range and buy it back for as cheap as possible.
Yep, and you'll have some assignment risk on that. Those you might need to close that early if the market's open. Keep that in mind also. All right, that's going to wrap it up for us today here on Fast Market. Stick around though, right here on the Schwab Network. Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account for investors.
Okay, we got a double bottom on the SPX.
No politics, no noise, from bell to bell and beyond.
That looks like the first setup right there.
On any device for free. Schwab Network.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its
Always
finest.
clean, this is Jim.
Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
The Church of J called me. Wonder who that is. The Church of J.
Welcome to Next Gen Investing. I'm Jenny Horn, joined as always by Alex Coffey. And Alex, as we do kick off this trading week, we are looking at some weakness today. I mean, as we did get some positive developments, especially following some of these tariff announcements in Japan over the weekend, but also some degree of I'd say, optimism expressed after we saw that big, beautiful bill signed. But now the latest economic and overall, I'd say, just political risks still trickling into this market as we're lower today pretty substantially in the Russell. Also weakness in the Dow, about 0.9% lower in the S&Ps, and NASDAQ down about 0.8%. So this is the steepest day of selling we've seen now in several sessions.
Oh yeah, definitely. We'll see if it holds. The opening bell on Morning Trade Live, I talked about this being kind of a week where you're going to be sitting around waiting for headlines, as headlines are going to drive the action. And so far that's rang true. We got some headlines on the tariff front from the president in the last hour or so, which did see the market take this leg lower that we're experiencing right now. It's trying to stabilize, trying to stage a bit of a recovery, but very much right now at the cause and the effect of whatever the latest is when it comes to tariffs and other, I guess headline-related items. But right now it does seem the trade policy is front and center.
It definitely does just feel like that, especially as we are still in a very earnings-light period. I know we have about a week or so, about 2 weeks before we get that next leg.
Yeah.
Anxiously awaiting those, as banks will definitely set the tone for the rest of the second quarter. But as far as economic developments, still a lot to watch from headlines right now. As we keep saying, it's a very headline-driven market as it stands. So we'll dive through some of those headlines on our show throughout the next hour, as of course we'll kick things off with some of these movers to keep on your radar. We'll also be charting two auto-focused names with very different price performance today, Uber as well as Tesla. Two very different stories, but very different charts that will compare and contrast. We'll also be looking at Nvidia, which today now is lower by about 0.75%. As well as discussing the latest with TikTok, as it has been a while since we've been able to discuss anything positive, really, as far as developments regarding the social media app and its ownership hopefully coming here to the U.S. We'll also be looking at Prime Days, of course, as we kick off Prime Days tomorrow. And last but not least, Core Scientific being purchased by CoreWeave, and both names are lower after we did hear some confirmation from both of those companies. So a wide variety, as always, to get.
Okay, we got 1, 2, 3.
We have a very equity-specific focus as we kick things off. Not really a theme for our top movers.
Yeah, very stock-heavy show as always. Tons and tons to get through. If there are updates on the macro front, we'll be sure to bring them. But right now, it does seem to be a bit of a lull. Let's get to some of our movers
40s.
here for this first segment, starting with Netflix. Kind of a downbeat note from Seaport, but when you listen to him, it kind of makes sense.
It does kind of make sense. So to dive into some of this note, Seaport Research downgraded shares to neutral from buy. Did not give a price target. Neutral, though, not saying, head for the hills by any means, but they did cite valuation and the time needed to execute against expectations behind this downgrade. They now see less than 10% of upside for shares at their current levels. and said there's plenty of long-term opportunity factored into shares at their current price. They did note that Netflix needs time to execute against the expectations in advertising, aggregating, and launching experiences, as well as expanding their overall share gain. So they definitely do fall more in the minority camp as a neutral rating, because there is still a ton of optimism in this name. But mentioning the valuation, so of the 50 analysts, there right now are 14 holds, and then you see 26 buys. But valuation, forward PE right now is 48 times. So yes, it is, historically speaking,
let's
even
hold this,
expensive.
baby.
Yeah, and I think the big thing to me was that this highlights something we talk about a lot, which is stocks can correct in two ways, or a combination of the two. But it's really, they can correct in price, or they correct in time. And the argument that this analyst making is more of like, hey, you've priced a lot of the future in already. Time now needs to pass, and they have to live up to that hype and those expectations. And then at that point, maybe this becomes more attractive down the line. Basically saying, what else is there to price in at this level? We only see 10% higher in upside, Seaport that is. And so when you're looking at it from that perspective, it's not necessarily a bearish note. It's just saying, hey, there's maybe better opportunities elsewhere.
Yeah, and I think that's understandable, because right now we've seen Netflix, reach pretty strong levels, as we've seen the rest of tech really be a huge part of this recent overall market recovery, which also fits the bill for our next name here, which is AMD. Citi actually raising its price target, though, to 145 from 120, also with a neutral rating as part of this broad second quarter earnings preview for the semiconductor group as a whole. Now, they do see increased estimates saying that prior assumptions that tariffs would drive to a slowdown in the sector does not appear to be coming to fruition. They expect a sector upturn driven by this solid demand and inventory replenishment, but they see the most upside, notably in microchip and Texas Instruments. Not so much AMD. AMD down 2% today, and while we have seen a recovery in shares, we're off of lows here by 76.5%. We're still off highs in this name by about 28%, and we do remain down about 21% on a 12-month basis now.
Yeah, we talked about the disappointment surrounding this particular company. I don't know how many times, but it's a lot. And you start looking at how far they've fallen behind some of their key peers in the industry. It's disappointing. I've talked about it a lot. When you look at it over the last so many years, it's underperformance. Now it's starting to improve again as time goes by. But you go back, let's just go back in time here a little bit. You can go back to the end of 2021, and this stock was trading at 150, 165. Well, right now it's 135. So in what's been one of the biggest booms for semiconductors, maybe since .com or maybe ever, one of the key players in terms of growth in this space has had its stock price go down by 10%. To me, that's unacceptable.
Yeah, to me, it's yet to really prove that it is a competitor in the AI hype cycle. We have not seen it really play out. Even the announcements of some of its latest products, it really failed to enthuse, as it does have these various days where it unveiled the latest series of its M100 chips. Doesn't seem to actually come to play for price, at least to the upside. Our next name today, though, is Chipotle. A very different story for Chipotle here, as it's not obviously as tech-centric as our other two names, but down today the most substantially of the group, about 3.4% after BWG Global downgrade shares to mixed from positive. And right now they are highlighting the fact that this is a name that has seen, again, some increased upside here, as we have just seen perhaps valuation play out as optimistically, at least for the time being, as they would expect. But Chipotle has traded in a way that felt typical, because they've seen relatively difficult comps on a year-over-year basis. There is still a lot of conviction, I will say, to the upside. So there are right now 25 buys and 10 holds and no sells in this name or underperforms. But again, carrying right now a PE of 44 times. This name has also become relatively stretched for the lack of growth catalysts that many see, at least for the foreseeable future.
Also, an example, a good example, I'm glad we have an example, that, stock splits, price didn't go up. It basically has never been as high as it was since splitting its stock back in June of 2024. So about a year ago at this point now, it was around, split adjusted, let's call it the mid 60s. It did test those levels in sort of the mid December timeframe post-election, but selling off in the first quarter, trying to recover, but doing quite a bit of technical damage today, falling below its 1 week EMA, taking out almost a week's worth of price action just in today's move alone. So maybe one to watch, but to your point, elevated valuation, not elevated stock price, and one that, hey, buying the split just didn't work.
Buying the split did not work, unfortunately. That's a strategy many have tried, I know, with some of these stock splits. And to close things out here, we'll look at a name that's seeing at least some optimism on the session. That is Wynn, which is just...
Right now, I'm looking pretty good on these. I'm $65 a contract.
To note, though, this is not a 3-year or an all-time high. As
well, actually more than that.
It has traded with some volatility, really,
75.
since we've seen the situation develop in Macau. We got some positive news last week regarding some really strong trends from Macau specifically. Goldman today, though, with initiation of coverage with a buy $122 price target, saying that the company has best-in-class Las Vegas assets with a resilient consumer base and lots of tailwinds for 2026. They also said their Las Vegas assets are less cyclical than it might seem at first glance, given the company's high-end consumer demographic. It's also diversification away from gaming and significant reinvestment into its properties. So more of that U.S. exposure, actually, they see as favorable for this name. As we always joke, some of the most, I'd say, like ill-named companies are like Las Vegas Sands, which is really primarily now outside of the U.S. And Wynn, they actually see some of their Las Vegas specific operations being now some upside for Wynn shares.
Yeah, Wynn's in an interesting spot, right? Because when you look at its position in Vegas, I think few would argue that this is perceived as probably the top resort location in Vegas in a time where Vegas has become more than just gambling. It's the experiences, it's the club and restaurant space, it's the
prostitution
rooms. They're well positioned to succeed, but they're going to need
the prostitution
to hang in there, as it is still a very, very sensitive space to the economy.
That is true, and so definitely still sensitive to some of the trade turbulence that we still are seeing unfold.
Alex, coffee?
We'll leave it there for the top of
Why
our
didn't you
show
bring
today.
up prostitution?
It's time to look at the technicals in 2 auto-focus names. We'll be looking at Uber, which is now about 1% off of its all-time highs, as well as Tesla, which is taking it on the chin a bit today, down about 7% and some change.
We're at 275. Woo! 63. Richard. 7 more bucks if we want to improve. I'm at up $100 on this trade. I've got some contracts and I want to sell them. They're up $100 per contract. Take some profit. Do it while you can. Take some profit. I woke up in the morning and I grabbed me some coffee. My baby said, "Come here," and I said, "Hey, let me put these eggs on the fire first, baby. I'll take my eggs over easy." Okay.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support.
Can't say I didn't call reversal on AMD today.
The Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex.
Is anybody still in the SPX?
24/7 live help and access support by phone, email, and in-platform chat.
I'd say if we break the 63 here,
Brilliantly with Schwab.
62. 27.50.
Trading the
We can go
games
higher.
every day. I'm Tom White, host
We
of
could
Fast
get us a
Market.
nice couple $100
Ready
bucks
for
more
you,
a contract.
Ready to go at 12 p.m. Eastern on the Schwab Network.
Man, I'm hot.
Welcome back to Next Gen Investing. It's now time to look at the technicals with, of course, our chart master himself, Rick Ducat. And today we are diving into Uber and Tesla. I guess instead of even maybe an auto theme, we have like an autonomy theme going for both of these names. But Uber today up about 2.5%. We pulled back about 1% from those all-time highs touched earlier today.
285.
So walk us through the latest here from a technical standpoint for a name that is on a really nice run as of late.
Yes, pulling back maybe a touch from those highs, but staying above the previous highs here. What I mean by that is this area, this red line here, 93.60, for the most part, was the top.
Well, I'm gonna hold this trade a little longer today. Can you give me $4 so I can buy me a bale of hay? My dog is cold outside and my crick is froze. Let's watch this SPX as it starts to go, go, go. Well, I woke up beside you and didn't know your name. Some of my best songs that I ever wrote come from a Cracker Jack box or a joke. Branches of my old magnolia tree up past Window Cemetery. Always clean. This is James Howard. May I help you? Now, if you're gonna call, say something at least. You don't sound like some guy from India. I'm still in them because I want to win them. We're above the 63. The 9 crossed the 21. Our goal is to get 62, 37, 50. I want to take this to $5. My ex-girlfriend really sucks. 285 now, 290. $3. Keep going. $3.40. Okay, here we go. I got in these at $2.75. Actually, got him in a lot cheaper than that. What the hell's wrong with you? Got him in at $1.75. Let's get him, Richard. I'm up almost $200 a contract, and I got 5 of these babies at $1.75. I got the, what do you call that, the stock market blues. How are you? Let's take this thing to 5. That'll be 3 1/4 profit per contract. Times 5 will be about $1,700. I'm still in them. Okay, breaks over. I hate when that happens. Kind of wanting more out of it. We'll retest to 63. If that doesn't hold, I'll sell them. Back to 290. Let's go. Starting to get weak. It's 12:26. Yeah. God darn it. I just threw all that away. Go. What just happened here? Richard! Richard! How did that happen, James? Well, I'll tell you what, little fella.
Continues to lead this market higher, but it's like the perfect stock to do it. It's the biggest one, it's volatile.
Okay.
So, looking at a call vertical spread essentially at the money. It's slightly out of the money, but it's structured this way because unlike what we looked at in Tesla, unlike what we looked at in Uber, where we risked a little bit more than we could make, in this strategy, Jenny, we're risking a little bit less than we can make. In this case, we're doing a $7.50 wide call vertical, July 25th. Towards the end of the month, 160, 167.5, so it's $7.50 wide. Looking to spend $250 on that. That'd be 1/3 the width of those strikes, which means we're risking one with a chance to make two, or in this case, we're risking $250 with a chance to make $500. So for those who are believers in NVIDIA, think this will ramp up over the next month.
Heck
They
yeah.
control how much they have at stake. Don't give up too much of the upside. This is a strategy that allows you to risk 250, but a chance to make 500. Now you need some help. The market needs to get to 162.5 just for it to break even. But if it does get running towards some of those optimistic targets, 500 is a potential profit out there.
Yeah, and I mean 190. I think also obviously the analyst's price target today would be a great place for us to be. But looking at more short term, some more of the near term realistic price we could see for Nvidia, I do think there's seemingly definitely that appetite for some further upside. So we'll leave it there. Appreciate it, Marley Caden, for the insight as well as the example trades today. Now coming up next, though, we will shift gears and look at the latest with right now some maybe some more social trends. TikTok, the latest right now with talks with the U.S. and China, as well as Prime Days as we do kick off Amazon Prime Days starting tomorrow.
How many does she have?
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right.
Okay, we got hour and 20 minutes. Well, MBIO did pull back more. 38%, 68, 62. The SPY hit my support, 619.64. We are going to find out. Get ready to get back in these again. $1.25. Come on, let's hold. We need to hold here. So we got a 1, 2, 3, 4. We got 2 1, 2, 3s. Break it. I mean, we got to hold this support line no matter what. $62.19.05. Mandatory. Better I get out. It's kind of descending now, though, so I got to be, I guess, a little more cautious. Go. We're still waiting. It's taking its sweet time.
But CoreWeave down 3.2%. Obviously, Core Scientific down a lot more than that. Down over
KORZ, cores.
Well, I think the first thing you got to look at is, on the top line, it looks like this deal is actually good for Core Scientific shareholders. I mean, looking at the acquired amount of $9 billion, that was significantly higher than the close on Thursday, which is around $5.3 billion.
What the heck is that?
Capitalization, but the reaction is baffling some, and I can explain why I think is what's going on here, but.
Oh, CORZ.
We talked about this potential synergy and this potential partnership that may manifest in acquisition. I think it was at least a week or a couple weeks ago we talked about it, but it looks like it's coming to fruition. And so CoreWeave, in a nutshell, what they do is
it's up too much.
A GPU as a service company. They provide a GPU infrastructure, major installations. For
it gets a downgrade.
Basically lease on demand.
To neutral from buy.
GPU technologies for AI computations. And the other thing is, if you look at Core Scientific, this was historically a digital.
God, this ain't working out.
Company, which now is becoming a larger player in the digital infrastructure space to help, of course, alleviate the workloads needed at the marginal level for companies like CoreWeave, which they need, spillover demands to actually make these computations possible. Now, I think what's happening here is it's a really interesting situation because on the face of it, $9 billion is a significant premium to Thursday's market capitalization price, but you're actually seeing the acquired company stock performance worse than the acquirer. And I think the reason being is the financials are stretched. If you look at the aspects of CoreWeave, first off, the company's market cap as of close on Thursday was around $79 billion. They have about $12 billion in debt, $1.3 billion in cash. So they didn't have a lot of cash to work with to begin with. This is from what I understand, is an all-stock deal. The challenge with CoreWeave, before they even made this acquisition, is they were already financing the capital expenditure needs for Core Scientific. But at the same time, that debt that they have is actually collateralized by the hardware that they actually lease out to their customers, which are NVIDIA's GPUs. Now, if you think about the nature of technology, technology becomes antiquated very quickly. So on our assumption that these GPUs have a 2 to 3 year lifespan, the debt that CoreWeave has is staggered in terms of maturities, and the interest is quite high. If you look at last year, they generated around $2.7 billion in sales, but almost $600 million of those sales had to be serviced by interest on the debt alone. So that's quite large.
That's quite large.
What I want to point out is
that's huge.
Think about the numbers. $9 billion is a tremendous amount to purchase for a company that's generating 84 million in trailing sales. So CoreWeave was already stretched financially, but at the same time, they paid more than 100 times sales for Core Scientific. So you put it all together, and there's share dilution. And that's why we are seeing both companies move lower. In particular, that's why we're seeing Core Scientific, which was the acquired company, move on a meaningful percentage.
I am still in, Richard.
Which is also down.
Okay, so George, before we let you go very quickly, I mean, as far as improving some of these debt levels and their financials, I mean, do we see the path for that in the coming future, or are we going to be more in a wait-and-see story here?
So I think, look at the market reaction. I think the market is telling us sort of wait-and-see situation because, ideally speaking, these two companies were working very well together as strategic partners. But now, essentially, they're going to have to find ways to mitigate expenses. So if they can demonstrate.
What happened? George! Where'd you go? We're having technical difficulties. We're now having technical difficulties.
Schwab Bank Investor Checking, the checking account built for investors,
God.
named Hyatt.
Shut up. We want a big bounce off this baby. Don't we, Richard? Now I'm going to be a little corny right here. I said corny, not horny. See right here? This is a higher low than what this was. So that gives me a little encouragement that we're going to break this triple top. And 62.30 would be your second resistance. And your third one would be 62.33.56. Oh man. We have 3 minutes until 1 o'clock. Let me see here. Ooh, how'd that happen? And Jimmy's up a whopping 50, well, he was $50. He's gonna go get me another chocolate. There's 130. Let's go. I need a buck. Give me a buck. We're at the 1-2 free bits. The first one. Yay. Hope I get over this head cold. I've been miserable all week. Oh, looky! Well, tape looks good. Always clean this gym. May I help you? Hello? Yeah, what's up? What's up, baby? Hello?
The stock has run a long way, and there's not a meaningful genesis for another leg.
CrowdStrike
They don't
downgrade.
think you should necessarily be selling CrowdStrike here, but they take it to a neutral and say they wouldn't add up at these price levels. They still have a long-term, very positive view of CrowdStrike, but because the stock has rallied, because of its recent performance, they are taking a more of a pause, taking it down to a neutral. So not as negative, just acknowledging how far the price of the stock has run.
It's only up 500%.
A bit of a breather. It does seem like
It's only up 500%. Everybody has a different perspective on how they want to look at things. Now I'm pulling up the 3-year chart. This was at 92 bucks and it ran all the way to 517. That's a 500% increase. 520%. I'd put a freaking neutral on it too. I've been here 20 years. I haven't seen stocks run like this. So personally, me, I got to be more cautious. What the heck happened to Caroline? We're back to 120. There's that freckle right there. I can't find nothing about where the heck she happened to her. Let's go ahead and get her on up there. Let's get her done so I can get in a new trade.
Exxon just recently told the street that even if oil went as low as $55 a barrel, which is well below where it is today, the company would still generate $125 billion in excess cash flow over the next 5 years.
Oh, yeah?
That's after paying their dividend and after investing in business. That's about a quarter of their market cap, so a pretty staggering number. And as we think about investors considering or starting to worry more
Sounds to
about
me like they're
inflationary
overpricing.
scenarios or stagflationary scenarios, Exxon's exactly the kind of company you'd want to be in that type of environment. They would benefit in the sense that in an inflationary environment, typically oil prices would rise, so their earnings would go up. And from a portfolio perspective, it would really provide a powerful portfolio hedge because most other names would be suffering in that kind of environment.
Right, obviously good to find opportunities in that environment, as you say, where we've got this prevailing narrative coming back of this supply-demand dynamic, and particularly what we got from OPEC over the weekend with regards to upping some of that production too, as you say, going to have an impact on prices. And just lastly, I think you mentioned real estate too. You have a name on your mind?
Yeah, we have one of the names we like a lot there is Avalon Bay. Avalon Bay is the largest apartment REIT in the United States. Avalon Bay, we think, is best in class. They have a terrific balance sheet, a terrific portfolio, and the best track record of creating value over the long term. And what we like about Avalon Bay here is a couple of things. So first off, from a valuation perspective, it's got a 3.5% dividend yield and about a 5% AFFO yield. That's sort of the free cash flow metric in REIT land. And what we like about them is that if we think about the outlook for apartments these days, the employment situation is good, right? Unemployment is low, so people have jobs and are able to pay their rents. But then when you think about supply-demand dynamics for apartments, they're quite favorable. So from a demand perspective, because mortgage rates have gone up over the last couple of years, it's much harder for first-time home buyers to buy a house. So people are staying in apartments longer. There's less competition from sort of buying versus renting. And then within the market, within the apartment market, there's very little new supply coming on. Because interest rates have gone up and because of inflation, the replacement cost of their assets and the cost of bringing on new capacity has gone up dramatically. And so that should create a favorable supply-demand balance and at the same time provide a powerful pricing backdrop for the industry.
Okay, good stuff. We have to leave it there, Michael. Thank you so much for joining us today and giving us some of your stock ideas for today. That is Michael Clarfield, Managing Director and Portfolio Manager at Clearbridge Investments. Appreciate it. Well, coming up, Options Corner, Tom White joins us to highlight unusual options activity from the day and how investors are looking to trade on recent news of AMD, Eli Lilly and Wells Fargo. Stay with us.
No. Do.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you.
Spy's about to hit that with 619.64 again.
Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages,
and being in the now.
And much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. It's time now for Options Corner, where we analyze unusual options trades seen throughout the day. Let's welcome in Tom White, host of Fast Market Schwab Network. And so let's start with AMD. You've found a bit of a bearish trade there.
Yeah, Sam, this thing rebounded about 76% from those April lows, so it's had a good run here. It's still far below, over $90 below its all-time highs that we saw in March of 2024.
But if you looked at their last earnings report, they saw 57% growth in their data center business. That was a positive, and actually they saw big growth in their basic computing, so their legacy segment of their business. So they're seeing some better growth. It's pulling back about 2% today, still up about 11% so far this year. Citi came out with a note today. They raised the price target on it to 145 from 120. They said the negative impacts from tariffs that a lot of people on the street expected aren't coming to fruition. That's a bonus. And then if the trade deals work out, especially the one with China, that could also be a positive. And I think if you take a look at the way that it's underperformed maybe some of its competitors, especially NVIDIA and Broadcom, maybe it's got some room to run. But I saw some unusual option activity in here. I was kind of bearish and maybe taking advantage of this 76% run that we've seen over the last 3 months or so. Trader bought 5,000 July 18th, the monthly options that expire in just a couple weeks. The 130 strike puts paid an average debit of about $1.60 for these puts. So this trader needs the stock to go below 128.40 to break even over the next 11 days. That's about 5% below the current share price. So this could be a trader that's just speculating to the downside, or it could be a trade where they're hedging maybe some of the gains that they've had since those April lows, but definitely some bearish activity here.
Okay. Tell us about the bullish trade, on the other hand, you have found for Eli Lilly.
Yeah, Eli Lilly's
Eli
now
Lilly.
in market territory, right? It's pulled back about 21% from
I like
the
how she
all-time
said
highs
that.
we saw last August of about $972. They just released Manjaro in India, and they said that's doing well right now. And they just had some released some studies at the end of June that basically said their new oral pill for weight loss to compete with Wegovy and Mounjaro and there are others in this space, Zepbound, that the results of those trials were actually pretty positive here. So that's a bonus for this company, but it has pulled back. They just acquired Verve Therapeutics, $1.3 billion. That's going to open up some of their cardiovascular disease receptors there from that company. So that should be accretive relatively soon on this one. And the stock, as I mentioned, is pulled back pretty significantly. So a trader repositioning an existing position they had. They bought 10,000 the August 15th, the 850 strike calls. They paid an average debit of about just over $16 on those. So the break even of $866.35 over the next 39 days. That's about 13% higher. That's where this trader needs the stock to go to start profiting on this one. Call volume, about 8 times normal daily average volume that we've seen over the last 5 trading days. So some bullish activity, even though the stock's pulling back again today. And I mentioned this is a reset of a position that they have because this trader sold out of 20,000 of the long July 18th 850 strike calls, gave themselves some duration on this one, but they definitely need to move to the upside of at least 13% to get above that break even.
Down alongside the broader market and the sentiment there, but as you say, a lot of optimism around some of those developments. And lastly, a bearish trade you found for Wells Fargo.
Yeah, they report earnings next week. We'll get a lot of the financials reporting, including JP Morgan, Citigroup, and Wells Fargo next week. And Wells just settled at record highs last Thursday on the close. So it's had a great run, up about 16%. So far this year, even with the pullback. I mentioned that earnings on the 15th. Raymond James double downgraded Wells Fargo to market perform from a strong buy without a price target, saying that the stock's been up so significantly that maybe it's getting a little bit overvalued ahead of that earnings event. And then if you take a look at maybe the yield curve, the 2-year, 10-year yield curve, that's about 50 basis points positive. So that's improved quite a bit. Net interest income expected to be pretty robust. But I think if you look at some of the commentary around the financials recently, as stock markets are hitting all-time highs, pretty optimistic at this point, even though we've seen growth rates start to slow. But the consumer has jobs, and they're still out there spending, maybe just not as much. But I think this was an earnings setup here. This trader out in the July 18th monthly options expire in 11 days. They'll capture that earnings event. Trader bought 4,000 of the 81 strike puts, paid an average debit of about $1.33 for those. So the break even for this trader when they start the profits below 79.67 over the next week and a half. That's about 3% below the current share price. That's about what the option market's priced in as far as a move goes also. So like I said, this could be a speculative bearish play from this trader or maybe an existing long stock position where they don't want to give up some of those gains, just buying a little bit of protection.
Okay, all eyes on that earnings. July 15th is the date, and obviously we're keeping an eye on what's going to happen with that trajectory of rate cuts, if and when they come. Thanks, Tom.
Thanks.
Awesome stuff. Tom White there. Well, coming up, we'll preview the upcoming earnings season and the state of the AI trade as tech looks to lead the market higher. That's coming up next on the watch list.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Yeah.
Welcome back to the watch list. I'm Sam Bartis, live from the floor of the New York Stock Exchange. Let's take a look at a few movers in the market right now. Autodesk was upgraded to buy from neutral at DA Davidson. The analysts are raising their price target on the software stock to $375 from $305, believing in the business and that it is on a path to achieve top decile performance, given a combination of demonstrated success in growth businesses. DA Davidson says that transaction model changes will create noise around margins, but it believes Autodesk has room to drive efficiency supportive of substantial profit growth. And Netflix was downgraded at Seaport Research to neutral from buy, the firm citing valuation and the time needed to execute against expectations for the downgrade. Seaport now sees less than 10% of upside in the shares and believes plenty of the long-term opportunity is factored into shares. Seaport says Netflix needs time to execute against expectations in advertising, aggregating, launching experiences, and expanding share gains. Well, let's welcome in our next guest, Lisa Martin, research analyst at the Futurum Group. So we're talking about the earnings season, which is just around the corner. What are you expecting? Because I've been talking to some analysts who do expect to see continued strength from what we saw in the previous quarter. Do you think that has legs?
I think it does, Sam. Great to be with you. Thank you for having me. Overall, if we look back at the first half, the tech sector
Last week was a good week.
Positive. We saw resilience, especially in AI and cloud computing. Q1 was a little sluggish, but the sector really did rebound in Q2. We saw some major players, of course, we have to talk about the Mag 7, NVIDIA, Microsoft, and Meta. But there were some other non-Mag 7 notables that also helped drive first half growth that we expect to do well in second half as well. Palantir jumped an impressive 70%. That's thanks to government contracts, AI-driven defense solutions, though it's a bit controversial. We also saw Cloudflare, AI-powered cybersecurity, rise 70%. And that highlights what we'll see momentum in second half is this growing demand for AI-driven security solutions. And then in the cloud side, we saw Oracle report a big jump in cloud revenue, with OCI growing over 50% in the first half alone.
And when we talk about guidance, obviously that is what everybody pays attention to, and why we obviously see movement in the stock on the day when we hear those report cards. I mean, it was a quarter in which we saw a lot of companies actually holding off on giving, some of those outlooks. But in tech specifically, they seem to generally, while they don't have a lot of visibility right now, suggest that they're going to be able to sort of weather the storm there. I mean, what's your expectation then for the second half as far as some of that guidance is concerned?
Yeah, I'll share some of the headwinds because they're still there, but also a lot of the opportunities that we see in the second half where tech is concerned. On the headwinds front, trade tensions, tariffs, still big issues there. We're also seeing some shifting customer relationships. For example, Qualcomm, it's facing the loss of Apple as a handset customer. And what that highlights for Qualcomm is that it needs really further diversification. But I will add that Qualcomm saw first half growth in automotive, in IoT, and QTC chips. So that's indicating that its diversification away from its core handset business is succeeding. Of course, the China export restrictions affecting companies like NVIDIA. But from a tech perspective, what we're seeing in second half as opportunities are cloud and edge, so think Snowflake, cybersecurity and data protection, think Palo Alto Networks, CrowdStrike. In the 5G and wireless semiconductor phase, we're looking at Broadcom,
Come on.
Qualcomm, AMD, of course Marvell, of course NVIDIA, and we're following these companies very closely to see how they perform in the second half.
Yeah, no doubt, as you mentioned, some of these companies have a China problem on their hands. NVIDIA has proven to be pretty adaptable, getting around, circumventing some of those export controls. And no doubt, we've also seen the headlines today about the administration cracking down on potentially exports to places like Malaysia and Thailand. They want to sort of plug some of those loopholes where there has been some leakage, I suppose. But this is obviously a space to watch. But as far as some of the earnings are concerned, what are you watching and listening for as to what some of these companies are going to say about not just obviously tariffs and export controls, but the domestic market as well, as far as demand is concerned?
A couple of companies that we're following very closely include two that I just mentioned, CrowdStrike and Palo Alto Networks. Why we're watching CrowdStrike so closely is because it's only been 1 year after it experienced that massive global IT outage that was caused by a faulty software update.
Exactly,
what
baby.
We're seeing for its cybersecurity products is really
We
robust,
remember.
and that momentum is likely to continue into 2026. And I should also note, CrowdStrike's revenue is tied to its cyber AI products significantly above where it was a year ago. Palo Alto Networks is also really evolving as the cybersecurity landscape does nothing but evolve into very sophisticated attack surfaces and vectors. But Palo has gone from really a next-gen firewall supplier into what now is a security operating system that spans network, and it spans cloud and endpoint and identity. So the AI trade in 2025 is looking really strong. This is probably the biggest technological paradigm shift of our lifetimes that we'll see, and it's still only in the early innings.
Yeah, and I mean, as we've been talking about this morning with a number of my colleagues, is the fact that, when it comes to cybersecurity, when you look at the CrowdStrikes of the world, I mean, this is not optional, particularly as we see the rollout of AI. There certainly is that need, and the budgets are there as far as the spend is concerned when you think about IT. But you mentioned the AI trade, and it was interesting. I was talking to another guest earlier today who said that we shouldn't be calling it the AI trade. It's a structural change and shift that we're going through right now. So where do you see where things stand right now?
Well, as I mentioned, this boom represents the biggest paradigm shift that we'll see in our lifetimes. We thought mobile was big, we thought internet was big, and they are. But the thing with AI is it's still in the really early innings of transforming everything. We're talking from how we work, how we communicate, how we travel, how we play. I mean, even how we eat. We're seeing things like humanoid robots, self-driving cars. If you come to San Francisco, which is just up the street from me, you will see Waymos everywhere. There's more complex inference models, but ultimately, the scope and the speed of AI economic transformation, it's only going to accelerate over the second half. I mean, even the talent war we're seeing, escalating competition between those big tech giants hunting for the best and the brightest talent with billions at stake.
Yeah, it's interesting you mentioned that. I just want to pick your brains about where you see this whole CapEx narrative, because at the start of the year, it seemed like that was being brought into question, particularly off the back of the DeepSeek breakthrough, which had rattled everyone from Silicon Valley to Wall Street. And then now it seems like that whole idea is sort of, I don't know, being swept under the rug or something, because I mean, you're seeing some of these companies coming out with sort of eye-watering announcements as far as, you know, splashing the cash, and it doesn't matter how much.
Yes. That is a really interesting phenomenon that's going on right now, Sam, is that we're seeing companies like Meta and OpenAI really battle for these top talent with Scale AI as well, and Meta, for example. We're seeing a lot of other companies come into the forefront here that are really attractive for investors right now. I'll mention a couple of them from a spending perspective. Nebius. This is an AI infrastructure firm that really popped at about 80% in first half. And why it's positioned to benefit well is because higher server infrastructure spending in IT is going on. So from a cost perspective, IT is doubling down on AI investments. And that's because the breakthroughs in AI keep happening. We're also seeing companies like Cloudflare, I mentioned, the new traffic cop of the internet. Its growth remains robust. It's quietly powering much of the internet. And it's doing things like offering a global edge network with products that span multiple areas like security and content delivery. And of course, NVIDIA, that remains strong from a spending perspective, because at the end of the day, its moat is just getting wider and deeper, and it's simply unmatched from an AI full stack ecosystem perspective, making it one to watch, one to spend on, and one that is going to be difficult for a competitor to get in there and replicate.
And, you know, when we talk about the AI arms race, I mean, who do you think is best positioned right now as far as that's concerned?
I think those in the Magnificent Seven, specifically NVIDIA, for example. I think Meta is as well. We're seeing a lot of momentum there with Alphabet as well. Something else that was interesting about first half is the non-tech stocks in the energy sector being affected by tech, because we're seeing companies like Alphabet, Amazon, Meta, and Microsoft really lean into nuclear energy to power these AI data centers that are super, super power hungry. But we also see some of the smaller players, like I mentioned, the Nebiuses, the CoreWeaves, also, for example, the Cloudflares, also being really active in this space and having a tremendous amount of momentum and spending opportunities that they're bringing into second half.
It's hard to pinpoint when you've got such a huge ecosystem and some of the secondary effects, as you mentioned. I mean, someone's got to power all of it, and nuclear obviously has the reliable base load there, so it's a no-brainer as to why some of these companies have been teaming up with some of the energy companies as well. So, yeah, I mean, hopefully it will start to see some breadth there as well as it starts to broaden out too. It's been an absolute pleasure speaking with you today, Lisa. Thank you so much for your time, your analysis and insights. Lisa Martin there, research analyst at the Futurum Group, for joining the show. All right, well, still ahead, we will examine the current volatility levels in the market as the tariff deadline approaches and how you can use options strategies to mitigate some of that risk. The watch list, we'll be right back.
just one of them days. Been like that for the last 3 weeks. I got 5 trades in. The last one not too hot.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Welcome back to the Watch List. I'm Sam Vardas. Let's welcome in Bob Lang now, who's the President and Chief Options Strategist at Explosive Options. Thanks for joining us today, Bob. It's a pleasure to have you here, on the trading floor in the studio. So, what's your assessment of what's going on today? I mean, we took a leg lower, particularly off the back of Trump's announcement about the letters that we were wondering where it was going to go and who was going to get them and what they were actually going to say.
Well,
Is it any of your business?
A little bit of payback from last week, Sam. So what happened last week? We had a short trading week, only open 3.5 days, Monday, Tuesday, Wednesday, part of the day, Thursday. Markets were up most of the day. For the Russell 2000 especially broke out, the Dow Industrials broke out, and we saw volatility retreat as we normally do in front of a holiday. So what ends up happening is when we come back to work like today on the 7th, we're going to pay it back with higher volatility and a little bit more selling, because a lot of people were trying to buy stocks heavily into the holiday, reduce volatility and so forth. So some of that selling is happening today and may overflow into the next couple of days as well too.
Okay, so some of it perhaps justified today, and we are looking down the barrel of a pretty quiet old week, you could say, on the earnings front, on the economic data front. No doubt we're going to be hearing a lot of sort of noise as far as tariffs are concerned, particularly around that July 9th deadline, which has now been pushed out. So what are you watching? What's your sort of outlook now for where we go from
I'll
here?
sleep good night.
I'm watching some levels in the markets right now, Sam. Looking at about 6,100 on the S&P 500, maybe even down to 6,000, which is a round number. NASDAQ down to about 22,000. If we get down to there, it probably would be a good spot to start dipping your toe in and adding some exposure. Right now, though, as we ended last week, oscillators, which is what I follow, is one of my momentum indicators, very overbought. And you don't really want to be careful. It was really flashing a red flag on Thursday as of the close. So I think buying into this market right now is a little bit dangerous right here. You want to wait for a little bit of a pullback to let the dip buyers step in there and add some exposure.
Okay, well, what do you do then? I mean, do you just sort of sit on the sidelines? Or?
So what I'll do is if I have some long positions, I'm adding some puts. I'm adding some short-term puts, because even with the VIX at 18% right now, protection is still really inexpensive. Now remember something, when volatility is down, it means option prices are cheap. And it doesn't mean just put options, call options are cheaper as well too, because not many people are expecting large moves up or down the markets. Now, today has mostly just been a one-sided move to the downside. We started opening down and we rallied back a little bit, but again, as you said, we've lost a lot of ground all day long today.
Yeah.
Only down 1.5%, right? But I mean, it's the quiet 1.5%. Nobody's screaming and threatening to jump out the window on a day like today, which is interesting because we've had days like this in the past where people started to get really concerned and nervous and worried and fearful.
Yeah.
But we're not having that today.
I suppose the markets have sort of got used to some of the uncertainty, particularly around the tariff headline risk as well. I mean, you talk about, seeing a mild correction typically before earnings season, that being around the corner.
Yes.
As we look at the next sort of catalyst now in the market, many do say it will be the next earnings season, particularly if we see continued strength there. Do you believe that will be the case?
I think so in certain groups, certain sectors. I think,
next week we will start hearing from the banks, the financials. We'll hear from J.P. Morgan, Goldman Sachs, Morgan Stanley, Bank of America, and a few others. I think that those names are going to hold up pretty well. I think they're going to produce some really strong earnings, and they're going to talk about some good growth coming over the next 2 or 3 quarters. I think there's some other sectors, though, however.
Okay, we're back to 45.
I'm looking at technology right now. I'm looking at NVIDIA. I'm looking at, although NVIDIA doesn't report their earnings until August, I think some of these names have gotten a little bit over their skis right now. And I think that that's a ripe area for them, for investors to start taking some profits. You see some good numbers from Microsoft or from Meta or from Apple, and people are going to use that as an excuse to start taking some risk down off the table.
Okay, so I mean, how are you looking for some of that protection and sort of diversification? Where are you sort of casting the net?
So I'm looking at the SPY as the SP 500 ETF and the QQQ, which is the NASDAQ ETF, as a way of buying some protection. And I'm looking out about 3 weeks to 3 months. I'm looking at anywhere from the end of July all the way out to October and buying some protection. I'm buying some at-the-money puts, and even though they seem like they're very expensive, when in reality is volatility is starting to rise, those instruments are getting an increase in value every single day. So last week, as the market closed on Thursday, before the holiday, I did buy some puts. They were somewhat expensive, but you know what? I bought some puts that expire at the end of this week. I will be rolling them later on this week. I got to have some keep protection on until we get a situation where the market gets somewhat oversold. We got super overbought last week.
There we go.
I can't
even.
emphasize that enough, Sam. Super overbought last week on Thursday as the market closed, and which tells us that a lot of investors are in. Now, what happens?
We got a head and shoulders
coming into the markets. All there's left is what? Sellers. So if we have some sellers coming into the market, it's going to take the market down quite a bit.
Okay, so you've spoken a lot about sort of protection, how to sort of diversifying the portfolio, your approach to the markets right now. I do want to get some of your stock ideas, what's on your radar. But first and foremost, I mean, we've talked about the next catalyst potentially being, obviously the earnings.
Right now we're at a neat
the banks, but,
resistance.
with regards to all the other headlines
2 of
that
them.
we got out over the weekend, I mean, who are you listening to right now? As far as Fed Chair Powell or Trump?
Yeah, if I had to choose one or the other, I mean, each one has their own catalyst for moving the markets. I think when President Trump comes out there and starts talking about tariffs, people are taking it seriously. Although not as seriously as they did from back in the early part of April when the VIX skyrocketed from about 16% all the way up to 60%. Now today, you get a day like today where he's talking about tariffs with Japan and so forth. The VIX is up a little bit. It's not skying high out of control. Jay Powell, on the other hand, here's a guy who's got a real steady hand managing the monetary policy, and I like what he's doing. I like what he's saying, even though President Trump doesn't like what he's doing with interest rates. But keeping a steady hand, paying attention to what inflation is doing, paying attention to what the growth market and the economy is doing. Job market was really strong last week. It's remaining strong. And why do they need to cut interest rates right now when the economy is strong and inflation is starting to come down? So I think that listening to them both, you can get some good clues on what to do.
Okay, and then there's the whole other sort of dynamic of the taco trade. I think an HSBC analyst said too many tacos gives the market indigestion. So.
Isn't it interesting that where the taco acronym came from was right here?
Right.
Came from right here, from Wall Street. So it's, too many. I like that. Too many tacos gives you too much interest. But of course, tomorrow we've got Taco Tuesday.
That's
right?
a pretty stupid quote.
It could be happening.
If you want my opinion, for somebody supposed to be so sophisticated.
Well, some of the things I like, some of the names I like. So I really do like Meta here, and even though it's come back quite a bit, I do like them coming into the quarter. I think they're going to post some really strong numbers. I do like Microsoft, but it is a little bit frothy right here. And one of the names that I'm really favoring here, Sam, is Chime, which is a recent IPO. CHYM is the symbol, and they're in financial applications services, much like a name like SoFi and PayPal. They do compete with the banks, but I think this is a name that's going to do extremely well over the next several months. It's a new recent IPO, much like CoreWeave and Circle, which obviously those two names have gone crazy over the past 3 months. And I don't think Chime's going to do that, but I do think it's got some upside.
Okay, so you mentioned Meta and Microsoft. I was just having a fascinating conversation just before we came to you about the whole AI trade, and some say maybe it shouldn't be called that. It's just a real structural shift that we're seeing. I mean, how are you sort of watching that broadly speaking?
Well, I was just talking with somebody earlier today and talking about NVIDIA. If AI was a planet, NVIDIA is the core of that planet. It's touching just about every technology company that's related to AI. Anything, it all comes back to NVIDIA, right? So I think that some of these names have gone off and drifted way too high in a certain aspect. CoreWeave is one of them. But, you pull back the onion a little bit on a name like Marvell or a name like Broadcom. And these companies certainly are taking this AI initiative very seriously, and they have some growth there.
Marvell, MRVL. It's one I haven't traded much.
Strong, and they said,
I'm close to even.
Strong revenues as far as the eye can see.
I just want to see if we can get a break.
Right now, and I think that some of these companies,
Marvell's pulled back pretty good.
Gone up quite significantly over the past 6-7 months.
Yeah, and I suppose the narrative very much has been show us proof of all that spend right now, and I think we are starting to see that the productivity and efficiency benefits are coming through, particularly in the labour market, which we're going to be talking about later in the show. It's been an absolute pleasure to have you here. Thank you so much.
Great to meet you.
Hopefully the AI doesn't replace our jobs too soon, so let's do it again. All right, thank you, Bob. Okay, that was Bob Lang, who's the President and Chief Options Strategist at Explosive Options. Still ahead, we will bring in our panel to discuss, as I mentioned, the state of the labour market following last week's employment data. That's next on the watch list here.
We're waiting.
Carl Nation, it's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages,
and being in the now.
And much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Yeah. I'm winning. Let's get it bounce.
Hey, Dad.
Dad.
I have a question for you.
How come Grandpa doesn't sleep with me anymore?
My dad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Okay.
Welcome back to the watch list. Let's bring in our panel now to discuss the labour market. Andrew Brenner, Head of International Fixed Income Securities at NAB Alliance Securities, and Patrick Healy, who's the President Chief Investment Officer of Caliber Financial Partners. Thanks so much for joining me, gentlemen. It's a pleasure to have you here. Let's start with Andrew. I just want to ask what your takeaways are from last week's data, particularly because it did seem that the data points that we got, the figures were conflicting, but perhaps not enough evidence yet for the Fed to move. Perhaps the argument in the market right now is that they'll sit on their hands.
Well, thank you for having me. What we discern from that is July is absolutely off the table. September's still got good odds. I mean, Goldman just came out and said they still expect a September cut, and we're kind of in that camp as well. But, it kind of screwed up the bond market or sent the bond market higher and steeper, and that's what we're seeing today. 10 years are well above their 200-day moving average. It looks to me like they're going to probably break the 440 level sometime this week and go on close to 450. So the labor numbers were much higher than expected, much higher than the ADP numbers indicated the day before. We're still skeptical of the employment numbers, but we don't have a real good leg to stand on because everything seems strong. I mean, we listened to a Stanley report this morning saying a lot of that was education from schools that were really should have been counted the previous month. I'm not really sure about that, but you know what? I don't believe the labor market's as strong as indicated, but I think for now, interest rates are going to go higher because of that fear.
Okay, and I'll bring Patrick into the conversation. I mean, do you agree with that, or do you have any other ideas?
I definitely agree that the data last week was mixed with a much weaker ADP private payrolls, and then coming in on Thursday with the much stronger number and actually
50 cents.
From the prior 2
Keep
months.
going.
If I'm the Fed, and they're probably scratching their head looking for direction here, but I am also in the camp that we don't see a rate cut until September, but probably for a slightly different reason than Andrew. I actually think, just given that now we have August 1st as the deadline for tariff and trade negotiations, that's a couple days after the Fed meets, I think they're going to wait for confirmation and having those deals announced and finalized before they're willing to move on rates. And so that pushes us into September.
Okay, but I mean, if we look at the labour market as a whole, I mean, away from what it means for the Fed, obviously, and some of those.
Well, what the heck
cuts,
have I just done?
Andrew, have you got any thoughts on, if we look under the hood, lift the lid on what it's actually telling us, sort of the lack of dynamism within those reports as to what that's actually saying about what we're seeing when it comes to the jobs out there?
Yeah, I'm going to be a little bit more controversial on this. I really think the labor market's much weaker than the numbers indicate. What the hard data has been very clear. Every time we think it's going to be a lower number, it comes out higher than expected. I mean, Nick Timrose of the Wall Street Journal had a good piece in the weekend saying that corporations are refusing to hire people anymore or with very strict guidelines, and they're trying to cull the number of people. That doesn't seem to be showing up in the data. And of course, the reason that the unemployment rate went down had to do with the fact that 1.4 million people of different countries, of foreign countries, that would be considered part of the immigration issue, just stood out of the labor force. So instead of a 4.3 unemployment rate or a 4.4, which Citi was intimating, it came in at 4.1. So I think that we're going to see at the end of this year the same kind of revisions we saw at the beginning, at the end of last year, which is 900,000 revisions. I just don't think the Labor Department's that strong. So when I look under the hood, I don't see very good things. I'll give you one indication if I haven't gone too long. My nephew was up visiting. He's a Naval Academy graduate. He works for a semiconductor company making chips. They just gave him the last 2 weeks off because the order book was so bad that they felt they had to take off, and try to reduce inventory. Now, I'm not going to name the company, but nonetheless, I think that gives me another indication. The things are
60 cents.
The hard data is indicating right now.
Right, and Patrick, 30 seconds. Can you sort of give us an assessment of how you see the big, beautiful bill, but also the other headlines around tariffs are going to potentially affect the labor market?
So let me just take a slightly rosier picture. I do think passing that bill will give clarity and the ability for companies to plan a little bit more out into the future. There was some big growth and tax incentives in that bill, and having that in the rear view now is a good thing. I think if we can get past some of the trade negotiations, some of these deals, if you believe Secretary Bessent, are within days of being announced. If you get some of those deals done and inked, you have more clarity. And then if we start to see the Fed accommodate later in the year, I think it's tailwinds. And I actually think it's a stronger economy than is being reported in a lot of the news.
Okay, interesting, and particularly in terms of what that's going to mean for the dual mandate.
70.
No doubt something's got to give, but there's also this trend of companies that potentially holding off on letting go workers because they know that history has told them from COVID how difficult it is to rehire them again, particularly to find some of those quality workers as well. But it's been a really fascinating chat. We have to wrap it up there. Short but sweet today, guys. Thank you so much. Andrew Brenner, Head of International Fixed Income Securities at NAB Alliance, and Patrick Healy, President and Chief Investment Officer, Caliber Financial Partners.
Tell me more.
Here at the Watch List, download the free Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. I'm Sam Bardas. Thanks for watching. See you later.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward
Find the next trend.
from every click to every kick.
There's no fear of missing out on Next Gen Investments.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Give me a buck. It's held that bottom of that megaphone.
Powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
It is now Power Hour. My option is at 55 cents. And I got 60. I got quite a few of these contracts. I got 50 of them. And if I could get a buck out of this, that would be 50 times 50 would be $2,500. There's 75 cents right there. Richard? As we approach resistance, I've got to ask myself a question. And the question will be, when's the first time you ever waxed your eyebrows, James? I did it once, and I didn't know what I was getting into. She was sitting there playing with my hair and my ears, and I looked around and back at her, and I said, she looked at me and she says, "How would you like to get waxed?" I said, "What? Waxed?" You want to take this outside? And she looked at me and she said, no. When's the last time you got waxed? And I said, man, baby, I've never been waxed. I mean, the fight of 72, I almost did, but I was able to pull out a win. What do you mean by waxed, baby? You ever want to get clocked? I said, what? You asking me if I want to get clocked? I said, what the hell's wrong with you? No, man. You got it all wrong, Jim. Tesla moves lower after Elon Musk says he's launching a political party. You're a piece of shit, Elon. Hello, Jenny.
About their long-term trajectory and narrative.
Where's
but
Caroline?
Musk right now doesn't seem to want to stray.
Are you telling me she's taking a whole month off?
Doge, as we want to put it. So I think that this is unfortunate because it does bring this drag down on shares where nothing fundamentally has changed from last week. Just commentary over the weekend really is, I think, the leading contributor to the weakness today.
And we did see another downgrade from them as well. I think a lot of investors are hoping that Musk is going to focus on the company as a tech company, not just a car company. And he even said so himself. He gave a whole press conference about how I'm going to focus back on the company, and now we're back into politics, and now William Blair has downgraded them.
Yeah, and this is also an interesting note because it mentions, I think,
I'd downgrade him too.
The Big Beautiful Bill, which was the beginning of course, his backlash between Musk and President Trump. But the removal, William Blair did mention, of that $7,500 electric vehicle tax credit right now really also drags the elimination of the corporate average fuel economy, which they says requires a reset in expectations in their opinion. So they do believe the combination of a demand headwind from the tax credit removal and Tesla's over $2 billion in profits from regulatory credits being at risk may be too much for investors to bear. And as a result, they do expect now this reduction in regulatory credit revenue to result in a...
I'm liking Lulu here. I got to keep an eye on Lulu. This could be a good $60, $70 swing. Do you hear me? Well, well. Well, well, well. Go get my coffee and I'll be right back. So. We'll pull back.
He's the head of equities and portfolio manager for Aptus Capital Advisors. Now, thank you so much for being with us today. We appreciate it. We're seeing some weakness to start the week, but in your latest note, you say that we need to follow what the market is telling us. What is it saying this week?
Yeah, Marley, one, thanks for having me back. And, you know, that is one of the most key things I can tell any investor in this world, and it is to follow the market. I mean, if you look at this past quarter, the academia-inclined investors, they just got their face ripped off because they were following everything that they could from a soft data perspective. Well, that soft data throughout the entire quarter, it never transitioned into the hard tangible data.
Academian trader? Who in the hell is that?
Data itself. So this term I have, a follow what the market is telling you, and that's the best way to find alpha because you mitigate risk. Is one of the hardest lessons
institutional
that you
traders
learn as some type of investor, because you kind of got to throw that academia book
academia
out the window, what you taught in school, because it doesn't always translate to actual market movements. And we didn't see that soft data transition to hard data, as I mentioned. And right now, that data was really good in all the tariff snapshots that we saw from Liberation Day on April 2nd. Well, they haven't come to fruition just yet. So the best way to win over longer periods of time is to be a rational optimist, and I think that's how you won over the past quarter.
I think the concept of throwing out the academia and throwing out what people learned in school is something that's probably really difficult for a lot of people on the street, and particularly anybody investing from home. You know, how would you encourage them to go against what they're taught, especially when traditionally the soft data does line up with the hard data, but you're saying it hasn't in recent months, and I don't disagree with you there either, but how do you stay the course?
Yeah, you know, I would say maybe I'm not the best person to listen to on this, too, because I got my academia at the University of Kentucky and not some type of Ivy League school in its own. But I think over longer periods of time, you have to listen to, like, look how the market's reacting today to the tariffs. And look how it's reacted to, you know, the one big beautiful bill, or how it's looked at the earnings per share that we witnessed just, you know, a quarter or so ago. Like the data remains very strong. And I think this liquidity bazooka that really came out, whether it's from monetary policy or fiscal policy, what came out of the financial crisis has really made you throw this playbook out the window, because, you know, whenever the market sees some type of decline of 20% or greater, like, someone is stepping in to save the day. Here more recently, it's been more on the fiscal side of things than the monetary policy side of things. And I think that's kind of this new dynamic that investors have to realize, that we're kind of in this new world of investing. Like what we've been accustomed to in the 60s, 70s, and 90s, like that's just not the playbook that is going to continue to work into the future, because, you know, this idea of quantitative easing and kind of the water spigot of fiscal policy that continues to get injected into the market, whether it's from the Democrats or Republicans, just really isn't going away anytime soon.
So, David, in your opinion, what is the current state of our economy?
You know, Martha, I don't just like the current state of the economy. I actually love it. You know, at the end of the day, I think people want to focus on the short-term noise of tariffs. I think the market's looking through that. I think the market is focusing on, you know, the upcoming earnings season that we're going to have for Q2. And it's
get ready, Robert.
The labor market data that's going to be coming out over the next month. But if I were to ask a lot of our clients and investors, like outside the stock data, if you look at the hard data, like what
The SPX was a perfect trade.
to us right now? Maybe you get some ISM manufacturing data that looks negative, but
So let's look at something here. I'm going to show you why I like this trade. What I was thinking earlier, I don't think I mentioned it. Well, I got in it, you know, and I had to add, but so you had a symmetrical flag. We had this big sell-off. Snake breakout, pullback, newer low. What was there? Something about something else. Oh yeah, the 200. So I'm sitting here looking at this thing. 200's way up there. I had two different resistances to break, plus this one here. So we had snake, breakout, pullback, triple top break. Now this would have, no, it could have just been a little oversold right there, but I'd rather see this here candle be above this one to be a lot more bullish. So once I already got in the trade, I had to add, and I just waited. Patiently. So we came up, and we had the head and shoulders right here. And once you break that, you got a double top. It's right there. That's where that candle hit right there. 65.20 hits the 200 SMA and EMA. A double top. Exit idea. So 1 minute time frame. So I liked it, thinking that we were going to hit that 200 for sure. We got 16 more minutes to go. Hey, y'all down here, we got 17 more minutes to go. Oh, fudge. What's wrong with that guy? Well, Jim, we know you're not perfect. In every way.
historical context, like the window of growth for consumer tends to be from like 3.5% to 6%. So you're kind of still within that healthy range, but you're on the higher end of the range. So the consumer does continue to spend, and I don't see that slowing down in the near term.
Great insight, David. Thank you so much for being with us this afternoon. Again, that's David Wagner from Aptus Capital Advisors. And coming up next, we'll talk AI with the CEO of Veritone, a company that designs human-centered AI solutions and recently announced it's raising capital in a direct share offering. We'll dive more into the company next on Market on Close.
Hope you're taking good advice.
The Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
She's serious.
Hey, Dad. I have a question for you.
Oh no.
Sure. When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
At least Grandpa ain't sleeping with your daughter no more. This thing could break to 237.43. Who knew? But I ain't trading it. 'Cause I'm getting ready
Whether
to.
you're an experienced investor or just
I'm debating what to do here. I've had one red trade today out of 6 trades. That's about my average here lately. I don't like that average. I'd rather have 0. But that just tells me we're at a frothy place. Jim's moving his calls up to the 6230s. Do you have a problem? Do you have a problem? Not really, Jim. Okay. July 7th. $0.75. Okay, I grabbed a position. 6230s. This is trade number 7. Hey June, where are you now? To be here. Oh my God, they're at 105. Come on. This ain't looking too good.
$2026. I know that you also just issued
No. Mm. "35 minutes left." Okay.
We do, right? Like our end users, our end customers use AI-powered applications. We do support and leverage and orchestrate hundreds of different AI models. But at the end of the day, what is making that redaction so effective is making that application, that piece of software, run so efficiently. So again, I think Veritone is in a great position as a leader in software. We've been doing it for over 10 years, and we think we're going to continue to accelerate and lead the market.
And Ryan, just a personal question for you. How does it feel to be helping law enforcement do their jobs more efficiently? You know, certainly a difficult job that they face, and to help keep people safer in this country.
It's really exciting. You know, I've been in this tech industry for a long time, since the mid-90s. You know, had some great successes with different companies. But you're right. You know, us applying AI for good to help our federal government and police agencies and other sectors gives me a lot of pride. And again, we're doing great works out there. It's one of the many examples where AI truly can be applied for good, bringing more efficiencies, opening new opportunities for new jobs. And so I'm very, very pleased about it.
Well, we appreciate it. We appreciate your time this afternoon. That's Ryan Steelberg, the CEO of Veritone. And coming up, we'll have Options Corner. Rick Ducat will join us with the levels that we're watching as we come into the close. We're back right after this.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. It's 3:30, and that means it's time for Options Corner. Rick Ducat is joining us today to keep a look at some of the levels that we've been watching as we head into the close. Now, Rick, we did see a pullback from all-time highs on the S&P 500 today. What's standing out to you specifically on the chart?
Yes, certainly a bit of a pullback indeed, but one that stayed above a key level. I'm referring to that 6,200 level. I believe
his little rocket ship
so far on the SPX was 6,201. So a critical level for the bulls to hold. And as we look at this short-term chart, 20-day, 1 hour, we can see that for the most part, price had been traveling within the boundaries of that upward sloping channel between our two white dashed lines, one going across the lows, one going across the highs there, just mostly kind of a pretty steady trajectory to the upside. Now, however, that trend line up to the downside seems like it's being broken here so far. Yeah, the day is not over quite yet. There's still a little bit of time left for things to change. But for now, it's seeming like that trend line may have been broken for this time here. So we can also see that we did fill that short-term gap. 62.2742 was that exact level from Friday's session, or Thursday's session there. So now that gap has been filled as well. The next potential short-term downside level to watch, 61.80, our light green line there, matching up to that series of lows. And if we could move to our next chart here, a 1-year daily look at the S&P 500, we can see now that price has moved beyond the boundaries of our channel. We are above our +1 standard deviation channel here. So price is at a relatively extreme point versus its own price history here. Our linear linear regression line, our solid blue line there, that would be our fair value line. Our +1 channel, 6180, could be now a supportive area to watch out for. Beyond that, our old highs, our green line, 6130, that could be another area to watch. If price does start moving to the upside, our +2 channel comes in around 6430 or so, Marley.
64.30. It's crazy to think about us thinking about us getting that high, but in this market, you just don't know how high we might go. And as we talk about options market, any trends you're seeing there? I know I saw a note earlier that we had very heavy volume today.
Yeah, and just to kind of add a quick thought to what you said, the high points often are more disorderly than the low points here because it typically is a time of either extreme enthusiasm or some kind of price shock or whatever. So the highs can often be more out of control than low points here. Just food for thought in general.
234.
But if we want to think about potential ranges here, if we move to our next chart, once again, this is a 1 year, 1 day candle chart here. But what we're seeing in this case is the expected move for the July 18th monthly expiration here. So we can see there that that's about the general range that we would want to be expecting there, between about 60.50 to about 64.50 or so. So about ±3% there to give us a general range. You might notice that that +2 channel that I mentioned earlier, roughly that lines up with that high point. The low point also roughly lines up with a gap down that we saw from a gap up from late June there. So a couple natural boundaries lining up with that expected move here. But anyway, after that long tangent though, you are right. Volume is very heavy today. The sizzle, which is the amount of volume versus the 5-day moving average of volume, was about 11. So about 11 times right before this segment here. So a heavy day. Much of the volume, of course, is in those very short-term options here, but a lot of the trading activity in general concentrated between about 6,200 to 6,500 in terms of our strike prices. So open interest, that's another interesting thing for us to look at here. Open interest very high at all those even strikes, 4,000, 5,000, 6,000, but then it drops off really significantly. You don't see a similar pattern at that 7,000 level at all in any expiration month here. So another interesting thing that caught my eye. To think about that July 18th monthly expiration specifically though, open interest much more skewed toward the put side. About 600,000 calls versus about 1.2 million puts, about 2 to 1 there in terms of our put call ratio. 5,000 and 6,000, as I said, by far the highest open interest on both the call and the put side there. But beyond that, calls mostly range between about 5,500 to 6,500, whereas the puts are a little more even, widely dispersed, going down, seeing heavy activity as far as 4,000 and then ranging up to 6,000 there as well. So, so those would be some kind of boundaries to watch out for. Still heavy put or call activity well within that range that we talked about earlier for our expected move.
And Rick, what do you think's driving that we're looking at a 2 to 1 ratio of puts to calls here?
It could be just protection, people looking for a simple way to hedge some positions here. Maybe it could also be just interest in those downside areas, being able to collect premium for perhaps selling puts or finding those supportive areas here. Really, it's hard to say here, but certainly an active day to start off this trading week for sure.
Well, Rick, we appreciate it. Again, that's Rick Ducat. And coming up, we'll switch gears and head over to commodities, take a look at gold, crude oil, and what had the dollar spiking higher earlier today. Market on Close. We'll be right back. Stay with us.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab.
It's funny.
Schwab, a modern approach to wealth management.
Binge watch the market with the Schwab Network. Tune in
in 24 hours a day, 7 days a week on SchwabNetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, Wednesdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern.
Woo!
Network.
We got 39 minutes. 21
Whether
minutes.
you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader?
Yes.
Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Market on Close. I'm Marley Caden. Now it's time for us to discuss commodities, and let's bring in Scott Bauer, the CEO of Prosper Trading Academy, to help us do that. Scott, I want to kick things off this afternoon talking about the dollar. We saw it spike after the tariff news. What are your thoughts on that?
It's first off pretty oversold. So RSI is so low that really it was looking for a reason to rally. But sure, the comments from President Trump that he's gonna start announcing, which he did today, some of these tariff raises. That was a good thing for the dollar, more so because some of the other currencies, the euro, the yen, etc., were weaker on that. So it wasn't so much the strength of the dollar as it was weakening of other currencies.
And do you think that some of last week's payroll data that we saw, did that have any added support for firming up the dollar?
It did, but I think that the more we look into those payrolls, if you looked at it 20 times, you could probably interpret it 20 different ways. So I'm not so sure that the strength there was really as much as when the report first came out. When you broke it down, it didn't seem to be quite as strong.
And we're seeing that small bounce now for the dollar, but do you think that sort of fundamental dollar downtrend that we've seen remains intact?
It definitely is the path of least resistance for now. Again, I believe it's really oversold, but I think we're in a situation right now where you sell any rally. So it's not necessarily buying the dip, but you sell any rally.
So what level specifically are you watching, Scott?
96, I think, is really important. And then, if we really break 94.5 on the downside, would be a really, really big level to watch.
All right, now let's move to gold. We saw gold have a pretty quiet start to the day, then fell to a 1-week low, and then seems to have pared off its losses now as I'm looking at the chart. Thoughts on that movement?
Yeah, I mean, precious metals, gold, silver, they were under pressure because of the stronger dollar today. Also seeing higher global bond yields put a little bit of pressure on precious metals as well. But, as you just said, we saw gold down, quite a bit this morning, and it's now actually, I think it's up on the day. So, as some of the tariff news has come out a little bit, and we've seen the dollar actually go from that rally backing off a little bit.
Yep.
We're seeing gold also rally back. And so
Lulu back to the 200.
dollar, I believe it is a sell.
Jimmy
rally.
called it.
Gold is absolutely in this area, then it is a buy the dip.
And gold is still up more than 25% despite that drop off this morning. Now, it is in the green right now. As I look right now, we're up 0.2% on the day so far. Do you think that that is a direction that's going to continue for gold?
I do. Again, you have to buy any dip that you can. And, I'm not sure what level or where or what news might come out that may, stop this rally. But for now, while all of the tariff uncertainty is out there, while the whole rate uncertainty is out there, gold's trajectory is absolutely still to the upside.
So how far to the upside do you think? Where is the first level of resistance that we should be watching?
I mean, we probably have another, I'm going to say 2 to 3% that you have to look at in if we get a huge breakout, people like the big round numbers, 3,500, 4,000, etc. I don't think 4,000 is in the cards anytime soon, but you can't count it out. So I think the 3,750 to 3,800 areas is definitely within reach and maybe in short order.
And I want to move to oil too. OPEC making the announcement that they're going to increase oil production in August. We did see prices rise on oil as I'm trying to load them right now. It looks like we're still in the green on both of those, up 1%, more than 1% on both West Texas and on Brent crude. What are your thoughts on that? Are we still going to maintain upward trajectory there as well, or is there more geopolitical concern here?
There is some geopolitical concern, but the rally that we're seeing today is twofold. One, the increase that we got from OPEC over the weekend was kind of expected and not as high as it could have been. So even though there's more supply, it's not as bad as we originally thought. And you know what? Demand is finally increasing. Demand worldwide, not just here in the US, but even in China. So that is definitely helping the trajectory to the upside. I have to look at WTI though, and if we get to a 7 handle, and we're not that far away, to me that is just a real sell, because even though demand is picking up, it's not keeping up in concert with the amount of supply that is also increasing. So I really think that WTI, Brent, that is a sell the rally as well.
So you think that this sets a bearish tone for oil? And I saw a report today, some experts saying they expect the prices to fall later this year as the production increases. But with China's factory contraction for a third month and the services data, do you think that we have to have concerns over Asian oil demand recovery?
Yeah, we've seen this play out before, and it's been so depressed for such a long time, especially out of China. And we're seeing an uptick now, which the market likes, but I'm not buying into that. I don't think that this little bit of an uptick in demand out of Asia, specifically out of China, I don't think that's going to hold. And once we see those economic numbers continue to be weak, I think that's going to drag down the price of oil.
Well, great perspective as always. Thank you so much. That's Scott Bauer from Prosper Trading Academy. And coming up, we will close out our market session. We'll get the big picture from the team at Charles Schwab. Market on Close. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers only.
12 more minutes.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you.
Can't wait to get back here and lay on that bed.
Investor, our investing webcast series breaks down different investing styles, including growth, value, income, and more.
What, 4.5 hours sleep last night?
Ask questions by chatting
But I slept all
directly with an
weekend.
Education coach. It's interactive learning at its finest. Tune in live or on demand.
There we go.
Go to schwab.com/coaching.
Lulu.
Start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Oh, God, 55? Break it.
Welcome back to Market on Close. I'm Marley Caden. We have just a few minutes left in the trading day.
Few.
So it's time for the big
10,
picture.
baby.
We're welcoming our team from Charles Schwab. Joining us today, Colin Martin, the Director of Fixed Income Strategist at Schwab Center for Financial Research. Colin, thanks for being with us today. An interesting start to the week for us with some weakness. What are your thoughts?
Well, yeah, we see Treasury yields up and Treasury prices down a little bit. So I guess you could describe that as weakness. But I think the move up as the day progressed likely is the result of the increase in tariff rates right now.
7 for 7. I mean, 6 for 7.
That the Fed certainly holds that it should be somewhat inflationary. And I say somewhat because we don't know exactly.
We're at 65. I can get out right here.
Flow through to the end consumer.
70.
But we think there should be some sort of impact because there's really three things that can happen. The exporter can cut prices, the importer can absorb the tariffs, or they can pass them along. Given the magnitude of the tariffs and that they've been in place for a little while now, we think we'll start to see, some of that flow into consumer prices. So I think that's weighing on the Treasury market right now because inflation was and has been trending in the right direction for the past handful of months. If we see that stall out a little bit or maybe even pick up because of tariffs, that can keep the Fed on hold for a little longer than initially expected.
So first thing I have a couple questions, follow-ups for that. But the first one I want to JP Morgan put out a report earlier today saying that they see stagflation now as a serious risk to the Goldilocks narrative that we've, been seeing that's sort of driven us to these highs in the markets. Do you think that that's, a concern that's warranted with all the tariff uncertainty?
I'd say it's a concern, but we're not there yet. But when I hear the risk of stagflation, I think it's important to put some context around it. Because as it stands right now, growth generally remains positive. We got a pretty bad first quarter GDP print, but a lot of that had to do with imports and exports and not really underlying demand. And if you dig deeper, underlying demand is still there. So we still think we're seeing positive growth, although we do expect it to slow as the year goes on. But that's important because when you talk about the stag part of stagflation, if we're still seeing a positive reading, that's important. On the inflation front, yes, it's above target, but we're still generally seeing inflation rates on a year-over-year basis, say in the 2.5% to just under 3%.
8 minutes left, and I'm done for the day.
We saw in the 70s and 80s, and the past relationships when people tend to worry about stagflation. So yes, it's possible we see slower growth and higher inflation, but I think the magnitude of the numbers matters. I don't think it's going to be as bad as a lot of people are worrying about.
8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the day. 8 minutes left, and I'm done for the
And with the Fed, my second follow-up to your original answer, with the Fed in its wait-and-see mode that we're watching, waiting to see how much tariff impact there's going to be, what the end result of these tariffs are going to be, B of A put out a base case today that they're maintaining 0 rate cuts this year, which sort of goes against the majority. Do you think there's a possibility that we see no rate cuts this year?
I'd say never. There's a possibility. I'd say there's not a high likelihood of that right now. But we think over time, if we do get our outlook for slightly slower growth, we think that over time would likely lead to some more cracks in the labor market and maybe an uptick in the unemployment rate. So even if we do see inflation kind of hold where it is or even pick up a little bit because of potential tariff pass-through, it's possible we see an uptick in the inflation or the unemployment rate. And that could result in the Fed cutting a little bit. If that doesn't happen, and if we continue to see, solid growth and a labor market that's holding steady, then the Fed might not need to do anything. I think what's really interesting is how resilient the labor market has been right now. If we look at the unemployment rate, I know it's just one indicator, but if we just look at that unemployment rate, it's held between 4% and 4.2% for 14 straight months. That's remarkably resilient. If that holds for a while, the Fed might not need to do anything. So it's not our outlook. I think if the unemployment rate stays low, that gives the Fed more time to remain patient and push back the timing of that rate cut. But we do think we'll probably see some weakness as the year progresses.
And Colin, in your outlook, when do you think we might see that first cut? In the fall?
Probably in the fall. We're sticking with our September or later guidance. I know that's kind of a cop-out. We're basically saying July is really not on the table. That's pretty clear right now after Friday's jobs report. The implied probability of a cut in July is, I think, 5% or less. It could happen in September, but even those odds have come down lately because of that labor market report. It is really going to be data dependent. The Fed has this outlook that tariffs should be inflationary. They are worried about that, but if they don't start to see it in the data, and we do see that disinflationary trend come down, I think that would allow the Fed to cut rates. But for now, they're not in a rush. I think that's really the key thing to point out right now, considering that the consumer remains somewhat strong, although we're seeing spending come down a little bit. The labor market's stable. The Fed doesn't really need to tinker too much. Not that they want to wait for things to suddenly get really bad before they start to act. But right now, the indicators they see don't suggest that they need to be acting too quickly.
And I want to talk about this weekend's news, the big, beautiful bill getting passed on the July 4th holiday. How is that, if at all, going to affect yields?
There's a few things in the bill that we think could have affected the bond market. One thing I'll focus on first is the impact of budget concerns and what that might mean for the Treasury market. Because there's a number of estimates about where the deficit and debt levels could be over the next decade or so, but a number of studies suggest it could increase the debt and deficits by 3 to 3.5 trillion over the next 10 years. That could keep long-term yields elevated even in the face of Fed rate cuts. Historically, though, we haven't found much of a relationship between budget deficits and debt levels and what that means for Treasury yields. We get asked this question a lot. If our debt continues to grow, what does that mean for long-term Treasury yields? We don't have a relationship to point to suggest that an increase in X in the deficit results in an increase in Y for Treasury yields. But we do think is that as long as debts continue to grow, and those concerns about our fiscal trajectory weigh on the market, that could keep long-term yields elevated. And we might need to keep yields kind of where they are to attract that marginal buyer. So that's our main guidance for our clients right now. Even though we expect those rate cuts to come at some point, we might see the 10-year Treasury yield kind of hang out in that 4.25% to 4.5% range because of those long-term budget concerns.
So you don't necessarily see them rising much further. You think they'll sort of stay within this 4.25% to 4.5% range?
That's right. And there's a lot of concern when people, I think, get worried about the impact of our fiscal trajectory and what it means for long-term Treasury yields. I think a lot of investors worry that we'll see an increase, in percentage points. The 10-year Treasury yield rising to, 5, 6, 7% or more. That's not really our concern. We think more in basis points. So yes, there could be some upside. Maybe it even does rise to 5%. That's not really our outlook right now, but we think any rise would be relatively modest, and it's more about keeping a potential floor underneath long-term yields.
Well, Colin, thank you so much. As always, again, that's Colin Martin from the Schwab Center for Financial Research. And coming up, we've got the closing bells about to ring. We'll bring in our closers panel to wrap up our trading session, and we'll get you ready for the rest of the week. Market on Close. We'll be right back.
2 more minutes and I'm done.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Accelerate your market knowledge.
And shift your attention to the full view. Real-time example trades.
Well, not a bad day for, time, patience. I like averaging about 5 or 6, 7 trades a day. That way I'm not rushed, not constantly looking at the charts, getting burned out. And we're done. So did everybody have an average day or better than average, or did we trade, or are we satisfied? Livid Goose, have a good day. Jesse, Randy, Bug, Angel, Magnificent, O, Rob, Richard, RTP, S, Sheba.
Thank you very much. That's really nice. Thank you.
Screwed the porch today. Oh, the pooch. Well, I'm going to get out of here. And I really appreciate it. I'm feeling a lot better. Now, I was kind of, last couple, 2-3 weeks, I was mentally having an off bout, I think. I kind of didn't want to be here. I just wanted to take off for a month. It's going to be weird when it comes time for vacation and I'm not working 24/7. So right now I'm going to get out and watch little videos and just kind of relax. And thanks all. I got new strings on my guitar. I'll catch y'all later.